Good morning. We'll get started in just a minute here. I understand traffic is a little bad, and the Georgetown campus, we have all this construction going on with detours, and so people have a little bit of a hard time getting to the building, but they will. Okay, let's get started here. Welcome to the Georgetown Psaros Center for Financial Markets and Policy's annual Financial Markets Quality Conference, popularly known as FMQ. I'm Reena Agarwal, the Robert McDonough Professor of Finance here at the McDonough School of Business, and I'm the founding director of the Georgetown Psaros Center. Last year, Mike Psaros and his wife Robin and their family, they gave us a huge gift to endow the center. And this gift makes it possible for us to establish the Georgetown Psaros Center for Financial Markets and Policy. And we are absolutely on our way to becoming the preeminent destination for unbiased expertise at the intersection of finance and policy. We really are most grateful to Mike and his family for making this happen. As most of you know in this audience, financial markets are going through a real transformation. There's focus on AI and financial markets, crypto, digital assets, climate disclosure, and a lot of market structure issues are being taken another look at. There's growth of private markets, data has become a huge asset, and some of these issues didn't even exist a few years ago. So our policymakers and regulators, rightly so, are busy trying to figure out how to regulate these markets. We at the Psaros Center, we are using our expertise to help both policymakers and also market participants. So what are we doing? We are providing objective, research-driven, trusted expertise. There's a lot of information out there, not a question. But what the Psaros Center brings is something very valuable. And we are an intellectual, honest broker. We are driven by research. We are a facilitator. We are an educator for practitioners, policymakers, and the wider community. I think sometimes people forget that the work that we are doing at the Psaros Center, it has implications beyond the financial sector. The financial sector and Main Street are tied very closely together. For there to be innovation, jobs, economic growth, you need the financial sector to be working properly and efficiently. So the work that we do at the Psaros Center has huge implications for Main Street and not just the financial sector. Today, we have a fantastic program. We're going to have Senator Warner, who's going to be discussing AI and financial markets, and where does he see the legislation going in terms of AI and financial markets. Senator Lummis has been a driver on the digital assets crypto front, and she's going to be talking about the latest developments on the legislation front around crypto and digital assets. We have a fantastic panel. We have 4 congressmen from the Hill who are going to provide a perspective on what are they focusing on in terms of financial markets. We will very soon hear from Chair Behnam from the CFTC. Several commissioners from the SEC and CFTC are going to be on a panel later this afternoon. We have Robert Cook, the CEO of FINRA, who's going to lay out his priorities for FINRA. And David Schwimmer, the CEO of the London Stock Exchange Group, will provide us with a global perspective and how exchanges are transforming. It's not just an exchange business, it's much more than that. So there are going to be lots of great panels on market structure, on climate, on digital assets, very timely. and I think you're going to really enjoy this. I do want to point out, in addition to our FMQ in-person conference, we do a lot of virtual FMQs. We have a lot of programming in terms of webinars on timely topics, breaking topics, and we release research on these issues. So I encourage you to visit our website, follow us on X, formerly Twitter, on LinkedIn, our YouTube channel, and you can see the work that we are doing. I really want to thank our partners and sponsors, especially BlackRock, Invesco, and the London Stock Exchange Group. We are most grateful to all of our partners. Of course, today's event would not have been possible without the hard work of the Psaros Center team, and I especially want to call out David Vanderveer, our executive director, who has been leading this effort, along with our team, Thea Anderson, Ellie DeAndrea, Drew Devine, and they're all out there taking care of things. But a huge thank you to our student workers, our student helpers, the marketing and communications team at the McDonough School, and Chris and folks from our tech center. But without further delay here, we're going to ask Chair Behnam and Emily Wilkins, the moderator, to come in. So thank you for joining us, and please engage with us at the Psaros Center. We'd love to get your ideas about what you think we should be focusing on, what we should be doing. There's just so much to do. I've never seen anything like this in terms of policy making and regulation that impact the financial markets in such a huge way. So I think there's a huge need for a place like the Psaros Center that's unbiased and that can serve as an educator in this space. Thank you for joining us today.
Reena, thank you so much for those excellent introductory remarks, and thank you to the Psaros Center for being able to host such a great conversation like the one we are hopefully about to have. I'm going to just set the bar high right off the gate. Well, Chair Behnam, obviously, thank you for being here as well. And I know that you were a student at Georgetown with the Psaros Center, I believe, and I just wanted to start off by seeing if you can kind of connect the dots from your time here as a student to now being chair with the CFTC.
Thanks, Emily, and thanks to the Psaros Center, Reena, Mike, everyone. It's good to be here again. Always really pleased and enjoy the opportunity to come back to Georgetown. As you said, I was a student here 25 years ago. A lot has changed on campus physically. Obviously, the campus is looking a lot different, but it looks amazing. And I think the things that haven't changed are the culture and the community and the vision and mission of Georgetown, which, I said this last year, I have such a unique group of friends from my time here, and I think that's a testament to Georgetown and the community it builds with its students from freshman year through graduation. And those are the types of things, whether professional networks or personal networks, drive your success, I think, as a person on an individual level, but also on a professional level. So I say this often, folks from the outside, I've made a lot of friends outside of the Georgetown community since I left here, and they think this group I have from 25 years ago is a bit odd because we still kind of act like we're in college, which has its pros and cons, but I think that tends to happen.
It's good to have that one group of friends that you can just be a little more relaxed, be a little more yourself around.
Yeah, absolutely. But this is a great facility, and I would just say for all the students here, you are extremely fortunate. This is a great center, obviously a great university. It's going to be it is the building blocks of a great career and a personal life, of relationships and experiences that you will benefit from for many years. And this institution and this school will stay close to you, and you're going to love it and everything that it brings to your life. It'll be very fulfilling. So always pleased to be back here, and it brings back obviously a lot of really great memories.
That is some excellent, I say Monday motivation, but I guess it's Wednesday morning motivation.
Yeah.
I wanted to start off just by kind of going to the 30,000-foot view with the CFTC. Can you just talk a little bit in general about kind of what your main focuses are right now? What can we expect from the agency? I mean, we're in November, so I guess in the next month and then throughout 2024.
Yeah. So I took over as chair in 21 after the transition. I'd been a commissioner going back to 17 and coming into the agency. For those who don't know, derivatives regulator, increasingly large, very systemic, important market. It's about risk management. It's about price discovery. It's for farmers, ranchers, manufacturers, financial institutions, very global in nature. And we went through a fairly large overhaul after the financial crisis. Unregulated markets became regulated after Congress Act with Dodd-Frank in 2010. And from that point, it was structurally a very different agency. We grew in size from a personnel standpoint and obviously grew with authority. And coming into the agency, my previous job was in the Senate, overseeing the CFTC and other financial regulators for Senator Stabenow, knowing the changes the agency had been through, and knowing the importance of what it does and its mission is. Coming into the role, understanding that some things weren't perfect post Dodd-Frank, and we saw some changes with my predecessors. Our markets are working well, and I say this often. Since I've been chair, we were recovering from COVID, huge shocks to financial markets, demand destruction, huge volatility across agriculture, energy, metals, and financial complexes. Russia invading Ukraine, huge impacts on ag and energy markets, which are core to our derivatives markets, and now continued geopolitical pressure, uncertainty, macroeconomic uncertainty, and conditions changing rapidly in short periods of time. Again, putting huge amounts of pressure on markets. Huge volatility, huge uncertainty, huge demands for collateral in short periods of time. And ultimately, as I review how markets have performed with my staff and our surveillance experts, they are performing both as intended and quite well in absorbing some of these shocks. Are they perfect? No. Markets are never perfect. Regulations are never perfect. But we sort of aim and aspire to fix those imperfections without redrawing the map and creating more unintended consequences. So what I focused on, addressing conflicts of interest, addressing governance, addressing risk management. That's how I sort of bucketed some of our issues. We have a lot going on from a rulemaking perspective, but I would say they're smaller, more bespoke, more surgical changes to help elevate and fix some of these imperfections as opposed to making wholesale changes. And I'm sure we'll talk about this in the next half hour. Another very interesting component of what we've been doing and dealing with at the CFTC has to do with sort of external changes to market structure and new market registrants, whether it's crypto, whether it's climate-related issues, and whether it's new products constantly coming to the fore that I think are innovative, are interesting, but in some respects conflict with existing law, conflict with risk management, and then to some respect, a bit subjective, conflict with policy and what we want to see out of these markets, why they were built 150 years ago, and what direction are we going to take them for the decades into the future.
And that actually leads perfectly into my next question, because I know a year ago you were in front of a Senate panel about crypto, and you told them that they needed to move quickly on a regulatory approach. And I'm wondering, in that year, has anything changed?
Well, so you're alluding to a hearing around FTX. This was days after the failure. We had an interesting regulatory relationship. FTX had a regulated clearinghouse with the CFTC, and they were trying to modify the application. I think I spoke about this last year. In the end, we never approved their application, but there was a lot of discussion between the agency and FTX. And in the end, the Senate wanted to know what those conversations were, what the relationship was like, and ultimately, what did we see or what could we have done to prevent that implosion, which, obviously we've seen the after effects in the past few weeks. Ultimately, I went back to what I've been saying, I think since 2021, is that the CFTC as a derivatives market regulator, as a commodity regulator, does not have jurisdiction over certain commodity tokens. In this case, I've said this publicly, Bitcoin and Ether, two of the largest tokens, comprising easily 50%, if not more, of the marketplace. And there is a gap. The Financial Stability Oversight Council has said this. We've done our legal analysis. And we work closely with the SEC, but there is just uncertainty around which tokens are securities, which tokens are commodities. And unfortunately, if you think about the market structure of the US regulatory system, we have the SEC regulating security derivatives, security cash markets. We have the CFTC regulating commodity derivatives, but we don't have a commodity cash market regulator. So you think about 150 years ago, you had soybeans and corn, and this evolved into energy complex, and this evolved into the metals and then financials. But now we're seeing technology push markets and push innovation into a very different direction that was initially contemplated 100 years ago when the CFTC was originally created. And this is a time, this is an inflection point where Congress needs to weigh in and I think create a new roadmap. Now, your question was, has anything changed? I think there's been momentum. There's been a pause because I think there's a bit of skepticism and cynicism about the technology from some. Others are perhaps more bullish on the technology and what it might bring, both to a sort of from a society perspective, an economics perspective, and a markets perspective. But I think that friction is causing a little bit of inertia. There's obviously a lot going on in Congress these days, which you know well. And for those reasons, these bills have been caught, I think, a little bit in a holding pattern. With some recent events in the Middle East and discussions around illicit finance, I think there's a sort of renewed conversation about the merit of pushing legislation through, creating new frameworks for both market regulators and the bank regulators, and addressing some of these issues around illicit finance, market structure, and stable coins as well.
And I'm happy to get into some of those bills, but I think I most just want to ask you directly, could another FTX situation happen? Has anything happened in the last year that would sort of slow down the ability for that kind of fraud to occur again?
So I vividly remember saying this with one senator a year ago, and why didn't you do anything? And I said, Senator, I don't have authority. I don't have a view, a traditional lens into this entity or these entities through registration, through surveillance, through data reporting, these sort of core elements of market regulation. And I said, with respect, I said, look, I don't want to be back up here in 6 months. There's better uses of my time down at the CFTC than coming up here, and better uses of their time as well, having to have these oversight hearings. But ultimately, the answer to that question is no. There's nothing has changed, and we could be in a position where another FTX type event happens. That said, FTX was a large bankruptcy. The crypto market has changed significantly since a year ago, certainly a year and a half ago when some of these bumps in the market and some price declines started happening. You're not seeing as much volume in both the cash side and the future side. Obviously, we've seen a little bit of pickup, I think, in the price of the core digital assets, Bitcoin most notably. And this is perhaps related to some regulatory movement on the SEC side. But ultimately, that exuberance that existed 2 or 3 years ago around digital assets correlated with obviously the pandemic, folks being home and a little extra cash in their pocket, and those price moves, that high volatility, that excitement, that certainly is gone. Perhaps the bubble has burst. I think that goes without saying. So could an FTX type event happen? I don't want to ever say never, but certainly the market dynamics and the market environment is much, much different today than it was a year ago, let alone 2 or 3.
Sure. And when it comes to Congress and what they're considering, you did see the House Financial Services Committee go ahead and move on a digital markets assets bill and a stablecoin bill. I know the Senate has some legislation as well, but I just wanted to start there and kind of get your sense. Do you think those 2 bills would kind of address this concern that you have, that the CFTC really doesn't have the proper oversight and that there is a gap in the regulation in the market?
Yeah, so again, I kind of think about it as a 3-legged stool. You have the stablecoin issue, which is very unique and distinct from the market structure issue, which is very distinct from the AML KYC issue. In sort of coordination with House Financial Services, House Agriculture, which is the committee overseeing the CFTC, passed a bill that would give, the CFTC more authority over the cash digital marketplace. And it uses some of the legal precedent around what's a commodity and what's a security, but essentially it empowers us to regulate through registration and other basic tools these cash exchanges. So I was encouraged. I certainly know there were some issues and opposition to the bills in both the financial services and the ag side, but I did talk with the chairman, the ranking member, and other members of the committee, and I said, in principle, the bill that they passed relevant to the CFTC does, in fact, accomplish the goals that I've been advocating and requesting for a number of years now.
Sure, and I know that some of the concerns among the Democrats who did not support those pieces of legislation were mostly kind of like, who gets to do oversight? Where does that power lie? We could go into that further, but I know we only have limited time, and I did want to ask on a couple other topics, including the climate, because I know that that's been one of your focuses. Can you talk a little bit? I know the agency is drafting guidance on the carbon credits, and I think one of the big questions is, how do you actually measure something like that? If someone comes and says, I have a forest full of trees, how do you know that they actually planted those trees, that they weren't old trees, that how much carbon they're taking out of the air? How much is the CFTC wrangling with that as you guys are thinking about this new space?
Yeah, so two quick responses. One is, yes, that's an issue, and it really goes to the heart. For those who don't know, voluntary carbon offset market has emerged over the past few years. Many of you are probably familiar with the Paris Climate Accord and commitments to net zero by 2050. You can imagine large corporates wanting to make commitments to net zero. We've experienced this in the past few years with the Russian invasion of Ukraine. And the reality is that we're not going to be able to wean ourselves off of fossil fuels anytime soon. Fossil fuels through natural gas, oil, and coal will be a part of the energy complex to power the globe for probably years to come. The question is, how do we transition and have an inverse relationship between renewables and fossil fuels over the next couple decades so that we can accomplish these goals? In order to wean ourselves off, but simultaneously hit these net zero targets, you're going to need these offsets, right? You used a good example. Imagine you're a landowner, you got 1,000 acres, you plant trees sequester carbon, you generate an offset, which has value, which a corporate can then purchase and say, this is towards my climate target. The problem in this market is there's no integrity, there's no regulation, there's questions about scientific methodology and how you are in fact calculating this sequestration and whether or not it's accurate and is in fact impactful. Second point, we are not scientists at the CFTC. I am not going to begin to evaluate or suggest that we should be examining these issues. However, we're a market regulator. Naturally, markets will create price discovery, risk management, and what we've seen in this market is an ability for us to step in, create some baseline principles or requirements that we would expect of some of these registries that issue the offsets through our regulated exchanges, which list futures on carbon offsets. So without getting into the boring details, bottom line is we have registrants who list futures. Those futures reference underlying cash markets. We want to set standards for this market, elevate integrity, credibility, get more people involved, scale the market, and hopefully achieve these climate goals.
And I'll ask quickly, do you know when we could expect to sort of see more details on this?
My goal, and it's subject to commission approval, and hopefully we get the support from my fellow commissioners, is by the end of the month. But again, subject to commission approval. They just saw the document a few days ago, but hopefully we'll get a supportive vote.
All right, we'll be on the lookout for that. I also wanted to ask, because when you started as chair, you began a climate risk unit. And I want to just see 2 years on, what have you learned through that unit? How has that kind of changed the way that you look at the climate impact on the markets? And what should folks really understand about what's going to happen with our changing climate?
I think so. And I've done a lot of work on climate going back to 2020 and the Trump administration. I would say this, in this chair I have, sort of literally and figuratively, you got to pick your battles, you got to figure out what you can get support on, and you got to figure out what you can get done. The report and the work I did as a commissioner in the Trump administration outlined essentially the kitchen sink of issues as it pertains to climate change and financial market risk. What the outcome is and what I'm most proud of is we're on the precipice of finalizing guidance, which is as far as we can go with the statutory authority we have around voluntary carbon markets. If we can get commission approval, this to me will be at least a very large step in the completion of this arc of good governance, of convening individuals, institutions, academics, public interest, examining issues, asking questions, and figuring out what a regulator can do to support markets and building a coalition around that. So that's what I'm most proud of. There are things that I would love to do, but I also have to identify what's doable. If it's not doable, I have to manage my expectations, keep my powder dry, and use the capital where it's best utilized and most successful. So
Sure.
this
And
is a step towards that.
When it comes to climate and our divided government, there's certainly, a lot of some things that are possible and a lot of things that the not to say make a pun and say the climate, but the climate's not there yet in DC. I also did want to quickly ask you about Kalshi, because that's been a bit of an interesting storyline, and they're a proposal to really use the derivative markets basically when it comes to the outcome of elections and who's going to control. And I know that there's been a bit of back and forth, but I wanted to see if you could kind of talk in general about how you regulate some of these areas in conjunction with state and federal laws, and sort of how you think about that.
Yeah, so this entity, Kalshi, is a registrant of the CFTC going back to 2019. They're a registered exchange. They have proposed to list event contracts, which are essentially binary options, up or down. Does an event happen or does it not, on elections? They submitted the request, they listed some contracts, the agency put a stay on the contracts, which means we essentially halted them. The commission in September made a decision to prevent the listing of political event contracts. They've since sued us, public information in the DC circuit, so that litigation is ongoing. I'm not going to talk about that, but ultimately this goes to a larger question about the law and what it permits and what it prohibits. One particular section of the Commodity Exchange Act says you can't list a futures contract, a derivatives contract on anything related to war, assassination, terrorism, gaming, or anything that's not in the public interest or illegal. So the CFTC for many years has made an argument that election contract binary options are gaming and not in the public interest. So I will say this, and I've said this publicly, but to give you a little bit of flavor of what we're dealing with, you can imagine there are folks who think there are benefits from a data perspective and a risk management perspective to be able to hedge, quote unquote, elections. There are multiple reasons why I have concerns, and I think that's in violation of the law. But just to name one concern, and I think this would resonate with many, it has in the past, is we regulate derivatives markets, financial contracts whose price is derived on an underlying commodity. We don't regulate the underlying commodity cash market. Notwithstanding one situation is if there's fraud or manipulation in an underlying cash market, we can bring an enforcement action. We're a civil enforcement agency. We've done this in crypto, we've done this in commodity markets for years. It's a very powerful tool, and it's one that's very logical. If there's manipulation in an underlying cash market, presumably that manipulated price will have a correlation to my regulated markets. I don't like that. So in this case, political event contracts, wagering on the likelihood, unlikelihood of a political outcome. We've seen what's happened in the past decade with respect to elections, around election fraud and whatnot. This actually goes back decades if you think about 2000 and a number of other issues around elections. If there are allegations of fraud or manipulation in an election, whether it's a local district in Iowa or any other state, you can imagine we then become an election cop. Because if there's a listed futures or a listed derivative on an election and there's an allegation of fraud in that election, that fraud would presumably have affected the price or valuation of the listed future. And I don't think anyone in Congress, I certainly myself, and I can imagine maybe many of you don't think or would assume that the CFTC is an election cop. So a few things, steps down the road that I have the weight to bear on my shoulders to think about, perhaps others don't, but these are the types of things I think about when we think about our policy, our mission, and what we should or should not allow as it relates to policy.
So probably for now, just save the betting on the election to beers in between friends and not with the derivatives market.
Oh, yeah. No comment on that, but we do have a number of open litigation things going on, so we'll see how those bear out.
And I know that we do have few questions, time for a few questions from the audience. So if anyone has a question for the chair, if you want to raise your hand, I think we've got folks with mics going around. And I am squinting. Oh, great. Perfect. We have 2 mics right there, so feel free to step up because I think we'll have time for one more.
Firstly, thank you for coming, Chair Behnam. Really appreciate it. My question is around kind of the risks associated with the crypto space. As a senior here in the business school, peers of mine are thinking about entering it professionally. How should they think about the risks, the regulatory risks associated with starting full-time at a crypto or crypto-related company, specifically in considering the lack of direction from Congress?
Look, it's a great question. You have a huge amount of opportunity ahead of you. On the one hand, I would say take risk and understand that you are being trained in an amazing way, bar none, second to none globally. And if things don't work out, things have not worked out for me in 25 years since graduation, you'll pivot, you'll find your way. That said, it's a very important question, and as you sort of evaluate what's ahead of you and what's an opportunity, I would say, regulation will come in this space eventually. It may be on my watch, it may not be, it might be years down the road, but there certainly is momentum, and it's just a matter as the congressional process goes. This will take time. I would say and recommend just do your homework on the technology. There are a lot of people who passionately believe in the benefit and the future of digital assets, blockchain technology, and crypto generally. There are others who have a completely opposite view. I think sort of follow your heart, do your homework, use the institution around you, the experts. History will tell you a lot about financial markets and technology, the ebbs and flows and how things have gone through bubbles and bursts and whatnot. And I'm not going to advocate, I'm not going to take a position, I'm a regulator, but I would just encourage you to use the facility around you and the people around you who have decades of experience in finance and financial markets, and perhaps that'll give you a little bit of a sense of what's to come and whether or not this is a right decision for you professionally.
That's good advice for so many college students. Yes, sir.
Well, first of all, I'd like to thank you for being here today. And as you're well aware, the United States is exceptional in that we have a separate commodity futures regulator from securities regulation. And what are the advantages and disadvantages of this setup?
Great question. And yes, in fact, we are very unique. We're probably the only, in my experience, I'm vice chair of IOSCO, which is an international organization of security commissions, over 150 regulators across the globe. We are the only one where we have 2 representatives, one on the commodity side and one on the security side. And in some respects, it creates these gaps, right? And this is not the first time we've been in a circumstance where we have a gap. We dealt with this after Dodd-Frank and the financial crisis with swaps, security-based swaps, commodity-based swaps. We dealt with this 45 years ago with futures contracts, security futures, commodity futures. But I would say the CFTC dates back 100 years. The markets date back 150 years. That, in fact, goes farther back than the SEC. So we've been around. Our markets are key to retail, to agriculture, to the economy, and the exceptionalism of this country. So there are some issues that arise. You have 2 regulators. I'm sure the regulated community would rather go to 1 regulator instead of 2 and have it across town. I would say the converse to that is, 1, our markets here in the US are the largest, the most well-regulated, and the most successful bias in the world. And when you think about the size of the derivatives market, the risk management markets, and the securities markets, the capital formation markets, they are second to none in size. Obviously, some G7 jurisdictions come close, but standing alone, the size of my markets are so large and so impactful on the global scale that the idea or notion that we would be, and this is a practical reality. The SEC has 4,000 plus people, I have 1,000. Their budget is about 8 times the size of mine, and for good reason. This is a retail-oriented regulator. that has a huge swath of constituents, from investment managers, IPOs, broker-dealers, retail investors, and whatnot. We have a much more institutional-oriented agency, but a huge market that we oversee. So my concern would always be, and this conversation happens every time there's a crisis, 2008, it even arose a little bit last year. Why do we have 2 market regulators? We should have 1. But my experience as a commissioner and as chair, given the importance of our markets to the domestic economy and domestic success and the size of the markets, it's really imperative to have 2. The SEC has a lot going on. We have a lot going on. The idea that you would mix and mash these markets and have a single commission overseeing both, I think would create further inertia in getting policy done, getting it quickly, being reactive, and continuing, again, the exceptionalism of our financial markets.
Well, certainly a lot of fascinating things happening in this area. I believe that's it for time. Chairman, thank you again so much for coming, and thank you so much to the Psaros Center for hosting us and having this excellent conversation today. Thank you all.
Thank you.
Thanks again.
The market structure panel here at the Psaros Center. First, I'd like to start off with a huge thank you to Mike Psaros for having us here at the Psaros Center, and to Professor Agarwal for everything that Georgetown does for markets, finance, public policy, and way beyond all of that. A year ago, we sat in these seats. I didn't need reading glasses, but I do today. So I will start introductions. We have Jim Angel, Associate Professor of Finance, Georgetown University McDonough School of Business. We have Sapna Patel, Head of America's Market Structure and Liquidity Strategy at Morgan Stanley. Hope Jarkowski, General Counsel, New York Stock Exchange. And we have Jeff Davis, Senior Vice President and Senior Deputy Counsel at NASDAQ. So we could not sit here today on a market structure panel and not talk about the market structure reforms that the SEC has proposed. So there are a number of proposals out there, but 4 main equity market structure reforms. In their initial form, what do you think would have the most significant impact out of all of them? And I'll start with you, Jim.
Well, I think the real problem with the proposed reforms is nobody's really looking at how they all go together. Now, clearly, the retail auction proposal would have some of the biggest impact, and I noticed that nobody actually seems to like it. Even the exchanges that would presumably benefit from it, you have put in comment letters saying, hey, it's not really ready for prime time. Some of the things I think make a lot of sense, like the reforms to Rule 605, but it's really too much too fast.
All right, Sapna, which one do you think will have the most impact, and good or bad?
Okay, I agree with Jim. They are interconnected. You can't look at any of them in isolation. The question that I ask, though, is when you see a fundamental change, like the one contemplated by all four of these proposals, the question that I initially would ask is, what problem are we trying to solve for? And I think that's the question that a lot of us are scratching our heads on, because our markets are fairly efficient. We've heard statements like they're the gold standard, our equity markets are the gold standard of the world, that retail's never had it better, that institutions trade very well, costs have never been lower. So what are we trying to solve for? And the SEC themselves have represented that the markets work efficiently, but they want to try to make them better. So the one thing I would say is, if we're trying to make things better, and nobody's saying our markets are perfect, right? You can pick different market structures globally. There are pros and cons to every structure, and we should continue to optimize them. But if something's working fairly efficient, I think we should take a step back and be careful about breaking something that actually works for investors. And so when we talk about 4 interconnected proposals, all changing different variables all at the same time. And look, I'm not the smartest person in the room, but I'm smart enough to know that if various market participants, all wearing different hats, exchanges, broker-dealers, buy-side, academics, former SEC officials, are all saying this is not good for the marketplace, or we have consensus views on things, maybe you should listen. So are they listening? I mean, there's a comment period. There a lot of feedback has been shared. What do you think will come from the feedback that's been shared? And Hope, do you have any sense, or yeah, what's your crystal ball say? Or at least what's the consensus of how people are reacting? I
similarly, think, there's broad support for Rule 605 changes. I mean, it's hard to argue against additional transparency. So if they want to move something that's going to put them in a safe litigation posture, that would be the one I would expect them to do. The best X rule, if they go along the lines of what many have said, which is harmonize with what FINRA already has and is well understood in the industry, I think that would be a much easier the lift than where they currently are. So that would be my prediction. The other two, the order competition rules, very controversial, and surprisingly, it doesn't provide as much opportunity for exchanges to compete unless we're allowed to innovate through our RLP program. So I think if we've argued that they should stagger them and implement them in a more orderly fashion than they're currently proposed.
Similar views, Jeff, or?
Very similar, very similar. I would only add that there seems to be a consensus developing around TIC reform. And this is something that NASDAQ has been advocating for a long, long time. We have said continuously it should be done in an incremental and careful way. And there does seem to be a consensus building around a half-penny tick size, and we think that is a sensible step to take. Our concern was basically the proposal took 3 steps, right? It just went too far, too fast, as Professor Angel was saying. So we're hoping the Commission is listening. Our sense is they are talking to a lot of market participants, so we're hoping they're listening.
It actually the tick size going to half a penny actually addresses a market structure problem. So with respect to what I was saying, what problem are we trying to solve for? If stocks would actually trade at tighter spreads, but they're artificially constrained by a penny tick, maybe we should go to half a penny for those.
We had really high hopes based on the early commentary about the strengthening of the NBBO, which we think is really critical for all aspects of the performance of the market. And really, the TIC reform, from our perspective, is the only one that really focuses on strengthening and deepening the NBBO. The others, particularly the order competition rule, it's just hard to see how the market and investors are going to benefit from that.
Well, it's interesting in that under Reg MS, there were 4 major proposals that happened at the same time, and it's really hard to show what the causation was from any individual thing when so much else was changing at the same time. And here we are again.
Difference, though. So I worked on Reg MS at the SEC.
No offense.
We actually were trying to solve for something at that time. And so, you think back to 2000 and what was happening around then. That's where I started my career at the SEC right out of law school. And we were going from fractions to decimals. We had electronic trading desks pop up on the street. We had clients starting to use algorithms. Things were automating. And volume was predominantly done at the New York Stock Exchange, and NASDAQ had filed for exchange application status. And so sitting at the SEC, you're thinking, we have a floor-based exchange and we have one that's going to be automated, and you're going to have two separate sets of rules. So let's force everyone into automation to a certain degree. New York Stock Exchange created hybrid at the time. But when the SEC went through Reg NMS, which was the last major overhaul to our equities markets, we engaged with the industry. So it was 4 proposals that were all interconnected, but all the analysis was done across all of them, right? What we have with the 4 proposals today are individual proposals where I don't think there was thought given to this one and the people working on it versus who was working on the other ones. And so we not only put out a proposal for Reg NMS, we had a public hearing in New York. We got industry feedback on it. Based on the industry feedback, the SEC changed the rules, reproposed before they went final, and there was a gradual rollout process. That's not happening here, and that's part of the concern. I mean, to Hope's point, you would think the auctions would benefit, the retail auctions under the order competition rule would benefit the exchanges, but the way that the proposal is drafted, it really doesn't. It harms retail and it doesn't benefit the exchanges. But we have retail liquidity programs on the exchanges that haven't been optimal. Why not? There is a regulatory carve out for exchanges to execute in a tenth of a penny. Why is that not working? How do we optimize that so the exchanges can compete on size and price improvement?
Right. So there are so many different proposals, those that have been well vetted over the years and others coming, but it doesn't stop there. So now we have an exchange volume tier proposal that more recently just came out. So maybe not everyone has seen it. Sapna, do you want to just describe what the proposal actually says?
Sure. So exchanges have volume tier pricing, and
customers get better pricing for scale.
Customers get better pricing for scale.
Not a new concept.
Not a new concept. It's existed for a while. The SEC is looking to ban volume tier pricing for customer flow. They'll permit it for proprietary flow, but for customer flow, they believe that brokers are conflicted and are routing to the exchanges in their own interest, not necessarily the interest of their customers, and that they're pocketing the money. And I think part of the premise behind the change is smaller and mid-tier brokers can't compete with the larger broker-dealers like mine, who are the beneficiaries of this tier, and smaller exchanges can't compete with NASDAQ or the New York Stock Exchange for order flow because of the volume tiers as well. So it goes back to, it's just dispelling a lot of myths. So it's not like broker-dealers like mine are collecting these rebates on the exchanges and pocketing the money. We have something called plus billable models where we pass on the economics, the fees and the rebates to our customers. It's offered to all customers. Broker-dealers can absorb that, including exchange broker-dealers, quantitative customers, and hedge funds can as well. And we have smaller and mid-tier brokers that use us, and they get the benefit of the pricing, but they use us for scale. They're not connected to all the exchanges out there. They don't have the infrastructure. They can't take in the proprietary feeds and pay for them. They are not members of all the exchanges. They don't have the market access tools that certain folks have invested in. So because of the scale, they use the larger broker-dealers, but they are the beneficiaries of that order flow as well.
Were there conversations about how it works today in advance? Because you would think that would be having events like this and talking about the way the markets work would be helpful so that the regulators understand, like, what are the problems that are out there?
The two things we said to the commission and commission staff when they were germinating this proposal, I mean, it went on the regulatory flexibility agenda. I think it surprised a lot of people. One, volume-based pricing is a virtually universally accepted economic principle. It is rational economic behavior. Two, our volume tiers are our best tools as exchanges for creating the NBBO, for incentivizing market participants to display liquidity, tighten and deepen the NBBO. And in the absence of that sort of market-based approach to driving the NBBO, we don't know what the commission thinks is going to substitute for that, and we are very, very concerned about the broadening, the widening of the NBBO. And frankly, if we can't compete on price with off-exchange venues, single dealer platforms, and such, we're pretty confident the order flow is going to go there.
which leads to a lot of volatility in the market too when you don't see a strong NBBO and liquidity around it. So moving toward more the topics that are coming up a lot now, we talk a lot about AI. And certainly that'll be a conversation piece that is part of today's session, I'm sure, in a number of conversations. We all would agree, I'm sure, that trust is paramount to the success of our financial markets. Investor confidence is really critical to our markets functioning as well as they do. But as we see new technologies combined with social media, there is some risk in how investors can be confident that how stocks are trading is reflective of supply and demand and not news or rumors. And so tell me, I'll send this to the exchanges, how does NASDAQ solve that problem? And I'll start with you, Jeff. Like, what do you think about that from a regulatory perspective?
So we are all in on technology as a tool of market modernization. We've been on a cloud journey. Just this Monday, we launched our second market in the cloud on the options side. And we have really high hopes for AI. We had an order type approved by the commission just a couple weeks ago that has an AI feature to it called the dynamic mellow order. We use AI tools to optimize our strike proliferation on the options side. We have plans on the surveillance side to harness AI to sort of unlock data, give us actionable intelligence for running our surveillance patterns. So we have really high hopes. There is this, I think there's a legitimate concern about misinformation in the market. I think what is striking to us, over a 20-year career, is we have always heard from the commission that their rules are agnostic to new technologies, that, fraud is fraud, right? And so it is striking to us that they're kind of deviating from their general view that they have the tools in place to combat fraud and specifying around AI, particular tools. So it's a little bit of a deviation. We gave some constructive feedback on their predictive analytics comment, and we're hopeful that they're listening.
Hope, anything to add or similar?
We use machine learning in our surveillances, as I imagine NASDAQ does as well. So it's a continued area of focus on the regulatory side of our organization. I think also, when you're providing tools for investors to access the markets, that's inherently a good thing, but it also comes with risks. And so obviously the risk of misinformation creates a degradation of confidence in the markets, and that's the last thing that we want. So it's, investor education and access need to be balanced.
Yeah, when you see a degradation of confidence in the market, especially among retail, you see things that we don't expect to see, like the meme trading and meme stocks that we saw, and that retail investor activity started to spike in the spring of 2020 for a number of reasons. We saw it very emphatically in retail equity options trading, as well as meme stocks. It's starting to subside a little bit, but it's changed the profile of trading in markets in a lot of ways. How do we see that shifting and the balance between retail and institutional? So many of the SEC's proposals are in theory designed to protect the retail investor. Are retail investors better off? And Professor Angel, I'll start with you.
Yeah, well, I'm glad you mentioned the predictive data analytics proposal. A very broad proposal that tries to get into this aspect of let's protect people from being hoodwinked by all of these gamification techniques and predictive analytics. But I thought there was a very interesting step forward in regulatory thinking there. Traditionally, the whole foundation of our regulation for the last 75 years has been based on disclosure. Tell people what you're selling to them and let them make their own decisions. And in the SEC's release, they basically said disclosure doesn't work. And that, I think, is an amazing intellectual breakthrough where they realized that, hey, disclosure as we know it doesn't work. Putting something on, a footnote on page 800 of a disclosure in 6-point type really does not communicate. So we
My
really
reading glasses, I'm not sure they would see that.
So we really need to move from this disclosure, check the box, legalistic mentality into a communication-based system. Now, what that would look like remains to be seen, but it's the fact that they're actually admitting disclosure doesn't work is really a great step forward. So now the question we need to ask is what does work and how can we implement that?
Anyone else have thoughts? Is the retail investor better off? Go ahead, Sapna.
Well, I think the retail investor is better off, but what you were saying before in terms of this rise in retail trading that we've seen, I still remember the conversations we were having early pandemic, and we were all watching this, and there were a lot of conversations around whether this was a short-term bubble, and or whether it was a longer-term trend. And I will say I was wrong. I was on the short-term trend, little bubble side of the equation. I honestly thought that once we all went back to work and we didn't have the stimulus checks and we had television again and sports and all that, that it would disappear. And it was learning that we had this whole other investor base, this new generation that was investing in the market, that had different tools at their disposal, and that made it attractive for them to not only get into the markets, but stay in the markets. I think that's good for our marketplace. That's good for our country to a certain degree. And so we should be encouraging that.
Yeah, we should make sure they have a good experience,
Yes.
because we want to see the next generation of investment. And not only do they have different tools, they have different goals. I mean, how
Exactly.
many retail investors, especially younger generations, who have thought about this differently? It wasn't 100% about making money on their trade. They were expressing an opinion, certainly the meme stocks.
And that's one place where I think retail investors are going to be directly impacted by the SEC's rules. The short sale disclosure, I think, is a key component of responding to that group of investors' mistrust in the market. They thought the system was rigged against them. They were reacting to that. And that's a place where I think disclosure could really help. I don't know if the rules and that are coming and FINRA's changes are going to address that, but that's one place we have, kind of high hopes. T+1 clearing, I think, is an important advance forward. I think the market is going to be better off holistically, and that's an indirect benefit to retail investors.
Both of those coming out of the investigation into meme stock trading and what was happening.
And predictive analytics as well came out of that.
But those made sense, right? The rest of it, we're looking at the GameStop, MemeStop report that came out, and there was no smoking gun when there was nothing fundamentally broken in our equity markets.
Well, I think what was fundamentally broken was trust, and that concept of people feeling like the markets aren't designed for them. We have to, as an industry, solve those problems and talk about how it actually works so that you can rebuild that trust. It brings me to another area where you see a market reaction to a lack of trust is shifting from TradFi to crypto or DeFi, or we use the word crypto to describe so many different elements of digital assets. But you're seeing that again as people saying, hey, the markets weren't designed for us. Let's find a new way of doing it by removing intermediaries. During last year's session on this panel, we talked a lot about digital assets and crypto, and the landscape has changed so much over the past year. Some of the firms that were major players at that time are either no longer in existence or a shadow of themselves. We've seen progress on a Bitcoin ETF, not necessarily live yet, obviously, but mostly through the judicial system. We've seen the courts saying, hey, we shouldn't let regulation get in the way of innovation. But it is harder to regulate, especially DeFi. So, Professor Angel, I'm going to start with you. Have investors been protected to date when we look at digital assets, and where are we heading from here?
Well, the easy answer to that is no, for a number of reasons. But a lot of people, I think, really misunderstand digital assets. It's not really a new asset class. It's really a new settlement rail. What we've done is we have recreated bearer assets in digital form. And they have some tremendous uses. You can trade them around the clock, around the world, with hopefully or theoretically low transaction costs. That's very useful. And they're programmable in that the traditional stocks and bonds we trade are really dumb contracts. But the fact is, we have programmable assets that can do things like execute themselves. Whether it is something like an option that can execute itself, or the tranche of an asset-backed security. We can do so many different things with this technology that is really exciting. And that's why people go, wow! But it's fascinating to watch this complete rethinking of what we do from the ground up. But what we've also seen is people reinventing many of the traditional intermediaries that we depend upon. And we've seen people demonstrate the fact that we need to have appropriate regulation in our financial markets. And unfortunately, our regulatory system has been so slow, and we have so many gaps in our regulatory edifice that people have not been well served. So definitely, I think we can do a much better job in providing appropriate rules for so-called digital assets.
We haven't seen really anything change on that front since we were here a year ago, despite the fact that there's been a lot of, there continues to be investor interest, both at the retail level and increasingly at the institutional level as well. So hopefully we do have some clarity, because I do think the protections are so critical. And decentralized exchanges are completely different from the centralized exchanges that we often talk about. I think people don't understand that component as well.
Although I think people also misunderstand the DEXs, or the decentralized exchanges, in that they think, oh, there's nothing there that can be regulated. When you examine these closely, there's always some degree of centralization. There's a group of core developers, there are a group of people who have governance tokens, there's somebody who's got the administrative keys who can change the protocol. So there are things you can regulate there. But we are seeing some movement in Congress with various stablecoin bills, and it's a classic example of how not to regulate things. So instead of coming up with a sensible regulatory scheme, Congress is basically saying you can choose from 55 different regulators, I'm serious about this, for, if you want to issue a stablecoin in the US, you can do any of the multiple banking regulators, securities regulators, commodity regulators, or state regulators. So we're going to create this, I was about to say unlevel playing field, not a field, it's going to be rolling hills of possibilities for regulatory arbitrage and a race to the bottom.
I think there is some hope for retail investors around a Bitcoin ETF, right? I mean, with the reversal of the grayscale decision, and there's an action point at the SEC in probably mid-January. There are 8 or 10 Bitcoin ETFs lined up. I think there's high hopes that there'll be approval. That will give retail investors a well-regulated institution to deal with, a way to be protected when they invest in Bitcoin. It'll shift them from dealing directly with the Bitcoin exchanges, which are more or less regulated or more or less unregulated, to dealing with recognized institutions that make the disclosures, do the registrations, and are held accountable for the protections. So we think that's a positive step.
Progress.
Okay. Long overdue. Progress.
Yes. Another area where the SEC has focused is in environmental, social, and governance issues, and using the legislation, a regulatory environment, to encourage certain behavior, whether on public or private companies at this point. What role should the exchanges play in that? Certainly your listed companies are facing everything that's coming out of the SEC on that front. How do you think about what's been proposed, and what can you do? And Hope, I'll start with you.
Sure. Well, I think it goes back to what you said a moment ago, Stacey, that investors are expressing themselves by investment in different ways today, not necessarily looking for a financial return, but looking to advance some of their own goals, and whether that's an environmental goal, a social goal, to some degree governance. So on the investor side, there continues to be investment driven in that way. Mm-hmm. For the issuers, shareholder engagement is at an all-time high. They're trying to manage engaging with their shareholders, being responsive to their needs, at the same time reacting to what has really developed into a kind of a cottage industry of issuers being rated by unregulated entities, issuers getting surveyed for how they're approaching ESG issues. So I think the tension there is that issuers are trying to do the right thing by their shareholders, by their long investors. Mm-hmm. Sometimes they don't even know who holds them because short disclosure is not required. So issuers are in a really tough spot in the normal course, and then layer on the many disclosure requirements, which have some derived from Dodd-Frank, others are coming out along the way. So I think it's a tough landscape for issuers today that they're contending with. For the exchanges, from the exchange side, I mean, our principle is really founded in providing our issuers with tools to comply with all of these tensions. And of course, part of our listing standards are grounded in compliance with the federal securities laws. So we think our role is much more one of providing tools for them to comply, providing convening power so that they can understand what their peers are doing, which is critical when you're in disparate geographies, different industries, but all at the end of the day subject to the same regulatory requirements, both onshore and offshore. A lot of this is coming from Europe. A lot of global reporting companies are contending with European regulations, and so some of the stuff at the SEC isn't quite so controversial. That's different. So different issuers have different reactions to all of this, and we try and spend our time convening them, helping them understand how to tackle these problems and concerns that they're hearing from their investors.
I think in some ways, though, NASDAQ and NYC have taken a different stance on some issues, maybe not necessarily all of them, but certainly diversity. And I've seen NASDAQ adopt a rule around board diversity and other components. So how do you think about it, Jeff?
I don't think it's that different, frankly. I think we, like Hope was saying, we listen to what our issuers are telling us and focus on the governance aspects of our role as a listing market, and creating a market-driven approach to allow issuers to express themselves in the way that they want to. And so that's, with the diversity rule, that was entirely around disclosure and allowing them to respond to the market forces they were feeling. This comply or explain gives every issuer on our market the opportunity to express themselves in the way that they think their stakeholders are expecting, as opposed to a quota or something more prescriptive. And I think that's been our approach to ESG as well, giving the issuers the tools, compliance tools, to express their view of sustainability or whatever it may be in the way that their stakeholders expect.
So go ahead, Professor Angel.
Oh, I just want to throw in from a public policy perspective, there's a strong argument for why polluters should be required to disclose. But why are we limiting this to public companies? The EPA already requires quite extensive disclosure of pollution in a number of different areas. So why are we allowing some private companies to do dirty deeds in the dark and putting all of the cost on the public companies? So I think from a public policy perspective, we need to rethink, is the Securities and Exchange Commission really the right place to be doing this? Yeah, there are good reasons to have disclosure, but why only public companies?
The state of California agrees with you. Right? Their recent legislation, just signed by the governor, applies to both public and private companies.
Well, sometimes they get it right.
Well, so there are a lot of, we talked about a lot of U.S. regulations. When we think about how going offshore a little bit and spreading out the scope, there are there's a lot of legislation around Chinese companies listed here in the U.S. And I think it's interesting when you think about global dynamics. So I'll start with the exchanges and then hear from Sepp and anyone else on this. But what do you think about the U.S. position on companies listing here from China?
Well, I would say, I have a formidable competitor sitting next to me, but our biggest competitor are the private markets and other jurisdictions. We're in a different spot than we were a couple of years ago with the Holding Foreign Companies Accountable Act specific to China. There has been some progress made. There's a lot more, I think, that needs to be made. So when companies have a choice of coming to the U.S. markets or remaining offshore with a different regulatory regime, there are choices to be made. China in particular, a lot of pressure being brought to bear by Congress, by investors, by indices who are looking at companies and different regulatory regimes and making choices. So more to come, I think, but certainly there's been some downward pressure on Chinese issuers in the past 2 years.
I think the only thing I would add is when these edicts come out, they have to consider the interests of individual investors. They have to give investors the opportunity to get out of these securities. They have to, do a cost-benefit analysis. There are tremendous opportunities. There's capital to be deployed. There are investment rewards to be gained. I think they have to, hear from issuers, and they have to hear more broadly at the government level from those who are interested, and make sure that when they take action, which of course, we're obligated to enforce the securities laws, national securities interests, no question about that. But they need to hear from issuers and they need to hear from market participants how to balance the costs and benefits.
From my perspective, it's just impact to the customer base, right? As you guys both put it, some of this is out of our hands, right? The exchanges have to react accordingly. But I think whenever we see, whether it's a Chinese listing or an ADR or GDR that's halted on NASDAQ or the New York Stock Exchange, I'm scrambling because my traders and sales traders are getting calls from their customers saying, we just saw this halt. What does it mean? How long is it going to be in place? What does pending news mean? Or we're collecting more information. And it's really difficult because we have to reach out to the exchanges and there's very little they can tell us. But the customers are impacted, the investors are impacted because they're holding on to positions that they can't trade out of at that point. So there is real impact to investors as a result.
There was a legitimate gap, right? There wasn't enough audit oversight for Chinese listed companies. And we've talked a lot about trust in the markets, and the reasons why the US markets are so strong is because of our regulatory environment. So that gap did need to be closed. And so I am encouraged, as Hope mentioned, that there has been some oversight. But shutting the doors on the US to outside companies coming, we shouldn't take our position for granted as the markets of the world. And so if we start to see a lot moving internationally, we could cede that seat that we have. So I'm glad to see that problem solving has found its way into this debate over the past year.
The protection of investors issue was present in the halting of the Russian securities as well, right? I mean, just again, responding to geopolitical events. The information flowing from the government in that case was very iterative and non-transparent. And so I think that really was a challenge for us. I'm sure it was a challenge for you and your customers to follow. Everybody wants to follow the edicts, but learning what those are, how they're implemented, how to protect investors when they come is really, really challenging.
Thank you. So I want to leave some time for Q&A, but I have one more question that I'm definitely going to get in before we do that. Because when you hear about all the conversations and topics that we talk about, market structure proposals, you might think the markets are broken and that we have so much to fix. And I certainly would argue it's the opposite. Our markets are so incredibly strong, but we don't do a great job about telling our own story and telling about not only the strength of our markets, but why finance in general is so important for this country and our nation. And so I want to end on the positive and have the sense of trying to correct that wrong. Like, let's tell our story. So I'm going to have each of you answer this one. And I want to know, one, either, what are you most proud of in your current organization or what your organization is doing that's good for society? And what are you most proud of that we've accomplished either as an industry or that organization? Or what good are you performing at your organizations, and what are you most proud of? Or either or. Jeff, go ahead.
So NASDAQ is a very purpose-driven organization. We have a goal and a mission, twofold, to become part of the trusted fabric of the financial services industry and to promote inclusive capitalism. So I'm really proud of our entrepreneurial center out in San Francisco, where we bring together entrepreneurs, mostly in the private market space, to try to create opportunities for underrepresented minorities and people who have not had the opportunity to grow a business, incubate a business. I'm really proud of the way that we're bringing our purpose and our tools together to help promote inclusive capitalism.
Hope?
Yeah, I would say I'm proud of our promotion of capitalism in an environment where sometimes people are questioning the value of capitalism. I think the New York Stock Exchange is an iconic institution, and we represent capitalism. We represent providing ordinary people with access to the markets, and so the convening power that we have from people from all walks of life, of all levels of society, I think is my most proud element.
I echo a lot of the sentiments. Look, I said this kind of early on. If I were given a blank slate, I wouldn't necessarily create the U.S. equity markets the way that we have them. We're a global firm. We have experiences trading in a lot of different markets. When you tell somebody that there are 60 plus places you can trade an equity stock in the U.S., I think it just boggles people's minds. I'm sure the current SEC administration, after the GameStop and meme stock events, when they heard that, they probably had the same reaction with the new chair coming in, formerly CFTC, where there's one market pretty much where you trade. But What I'm proud of is, despite the market structure that we had, we've optimized it over the years. And the biggest test to the efficiency of our US equity markets was the early on of the pandemic. And it's not like we did Reg NMS and we didn't touch it. We had the financial crisis and we learned that short sell bans really don't work really well in the US. We had flash crash and we put in place single stock circuit breakers. We optimized market-wide circuit breakers that triggered for the first time during the pandemic and worked efficiently. We had Hurricane Sandy, where we learned that the New York Stock Exchange floor could be flooded and they needed to have an automated way of opening and closing stocks. All the infrastructure that we put in place from the lessons that we've learned allowed retail and institutional investors to continue trading.
Yes.
And that, I'd say that's what I'm really proud of,
Yeah.
is what we have isn't broken. It can continue to be optimized, but we should be really careful about breaking something, making too many changes that actually works for investors.
I would second that. When you look back to spring of 2020, every single tool that has been designed over the years was used. Circuit breakers, remote BCP plans for people to go home and run the markets from their living rooms, and it all worked flawlessly. So the industry really does deserve a shout out for that one. Go ahead.
What I'm proud of is the fact that our financial markets help people live better lives. Almost everything we do is improved by our financial markets. If you think about it, our financial markets provide not just a payment system to move money around, but also we allow people to save and invest for retirement. We provide a time machine. We can take earning power that we create today and transport it to the future. Or if we want to buy a house or a car, we can take that future earning power and move it up to the present. We provide a mechanism to bring together the enormous resources needed to fund modern technology, whether it is life-saving vaccines or treatments or new airplanes or new artificial intelligence or new chips. Those all require massive quantities of capital far beyond what individuals can provide. And yet our financial markets provide means of doing this. We also provide risk management tools, ranging from insurance to options and futures, to allow us to manage the risk as well, something not well understood or appreciated. So I'm really glad that you brought this up, because we really don't do a good job in this industry of letting people know how we let people live better lives with the tools we provide.
Totally agree with that as well. And we saw the markets provide a lot of debt through debt and equity offerings in spring of 2020 so that companies could raise money to go do the things they needed to do to battle the pandemic. And I'm grateful for all the work that all of those companies do while they're creating jobs and growing. So financial markets, good. Now, I have a couple minutes for questions, so we'll start right here.
Hi, my name is Vic, and I'm a freshman here in the college. My question is regarding excessive fragmentation. The U.S. has 16 equities exchanges, 7 of which transacted less than 1% of the overall volume on Friday, November 10th. Meanwhile, FINRA TRF reported 43% of the equities volume traded off exchange. For listed options, we now have 17 options exchanges. My question is, are U.S. markets getting too fragmented? Also, if there was no regulatory requirement to route to every exchange, would the 7 equities exchanges that trade less than 1% even exist?
All right, so who wants to take that one?
I have opinions on everything.
Yes.
Do we have too many supermarkets? Do we have too many gas stations? Do we have too many clothing stores? I'm a fan of letting the competition sort things out. Now, I'll agree that we should probably rethink Reg NMS in a number of ways, but it's sort of like, one could say that I have too many children, but which ones do I want to get rid of? None of them.
It's a fair question, right? And I think we share the concern. And frankly, I think I'm on the same trajectory as Sapna. I came to NASDAQ in 2000 when liquidity was really, really concentrated. The SEC had adopted Reg ATS, let 1,000 flowers bloom. And we are really at the other end of the spectrum now. Order flow is really fragmented. There are incentives to spread it out further and further and further. I think the commission has done a really nice job orchestrating the structures of the market. I do think it is time for them to really focus on fragmentation so that we don't lose the central pool of liquidity that helps form the MBBO and really protects investors.
Fragmentation definitely leads to volatility. Yeah. All right, next question.
My name is Monty Singer, and I'm a sophomore in the business school. I had a question. So I am a meme stock retail investor, and I was curious to learn your opinions on AI and whether that's going to lead to more kind of opacity in these large kind of wealth, market makers, or whether it's going to lead to more democratization for these retail investors, and where the opportunity for regulation is in that.
Maybe I'll start. I think, again, the commission has tools to fight fraud and tools to require disclosure. To me, it's not as big a revolution as people have been portraying it. Algorithms run the market. There is not a lot of transparency around algorithms. We measure outcomes, we measure impacts, we set up guardrails. The difference between an algorithm-driven order type or an algorithm-driven routing strategy and an AI one is really, really small. And so I think there's a lot that we can import from current market into AI to help provide the guardrails and protect investors.
Yeah, I agree. It's almost as if the AI outside of the markets is what would be more concerning, and with misinformation and
Right.
people not having clear visibility.
Right.
But focused on it. Last question.
Kelvin to Data Boiler. Well, first of all, I'm glad the U.S. didn't go into the extreme like Europe, banning payment for order flow completely by 2026. But like the SS fee cap, well, I'm glad that it doesn't cut entirely the rebate, right? But like all of a sudden, all this coming along, wouldn't that drain liquidity out of the market significantly? Because like without incentive to go around the ecosystem, right, there could be a liquidity concern if the rules are being adopted, like the SS fee caps, recalibrations, and all this. And then I'm just looking into, like, for example, Phil McIntosh as NASDAQ just come out with like an article talking about price discovery and all this contribution and the SIP rebate and all this type of things. Well, shouldn't we look into the music industry, the copyright licensing mechanism, as a way to kind of regain trust about all this rebate or SEC concern about conflict of interest, so that it will grow the overall pie as well as regain the interest, like in the markets, and regain the confidence, like in our public markets. So thoughts?
Using licensing to provide more transparency?
Well, a systematic way, like the royalty payments in the music industry, to consider how rebates and all this should be aligned with rights and obligations, so that it could potentially improve the overall system to regain confidence about, hey, there wouldn't be conflict because we have a certain standard or disclosure how rebates are being given out and all this. So rather than government come in to regulate ourselves, right, or the pricing control by the government, well, it would be a market-driven type of approach. And music industry has some success story, like to proven that work.
Hope, I'm going to let you take that in the rapid-fire answer because we're over time.
I mean, I would say exchange rebates are incredibly transparent. Anytime we change our prices, we have to file it with the SEC. The same is not true of payment for order flow arrangements, which are bespoke between two market participants. So I think there is, just like when you're looking at on and off exchange transparency, there is a very big difference in those two pricing mechanisms and how they're disclosed to the public. So I think.
Excellent. Thank you. And thank all of you for joining me up here today. And enjoy the rest of the day.
We're going to take a short break and come back in about 10, 15 minutes. Thank you.
who knew that I was interested in financial policy and that sphere of government regulation. And so he forwarded me the invitation, but it was really lucky because it was the last day of applications for the fin policy track. And I was really glad to be able to get mine in. I think a real highlight of the trip was our journey to the SEC. I had done an internship with them, but the sort of opportunities and people that David was able to connect us with was on a whole different level. We actually got to meet with Commissioner Crenshaw, which was incredible because I had been working on supporting her efforts throughout the entire duration of my internship, and I had never met her. So to actually be able to have a conversation with her and just express my thoughts about public service and have a conversation on those subjects was really cool. The other experience I thought was really edifying was our trip to Morgan Stanley. We got to speak with a few alums in their equity research team. And I was really impressed, first by how open and willing they were to speak to us, but also how erudite they were about a lot of those macroeconomic subjects that can be a little more esoteric and wouldn't have expected people outside of the Fed to be that intimate with. So that was a really cool experience, and it sort of showed me that there's plenty of expertise on the private sector in these sort of macroeconomic forecasting events, just like there are at the Fed. The fin policy trek was really edifying, and it helped show me aspect of finance that I wasn't really familiar with, Wall Street, and also a lot of the asset managers like Neuberger Bowman. And well, we've had a lot of dinners with people at institutions like BlackRock recently. I think that the financial policy trek was really helpful and provided some really clarifying context for what kind of work I'd like to pursue after college. I knew that I wanted to stay in macroeconomics, but I was pretty uncertain to what private sector opportunities there might be. And the trip and all of the activities hosted by the Psaros Center since then have taught me a lot. I've stayed very much in contact with the Psaros Center. They host a lot of events and they're really cool. They're some of the best programming I've seen at Georgetown. We've had guests like Joe Barada and Mike Psaros come and speak to us. And also bi-weekly lunches, dinners with important guests who are experts on the fin policy track members' respective fields of interest. So I definitely keep very much in close contact with the Psaros Center, and it's one of the best opportunities I think I've had at Georgetown to meet alums from the university who've gone into industries tangential to my interests.
My first engagement with the Psaros Center for Financial Markets and Policy was the undergraduate stock pitch competition. I was really excited about this opportunity to learn more about financial investing and the opportunity to have that experience presenting a stock pitch to a panel of experts. After participating in that competition, I then learned about the opportunity that the Psaros Center was hosting with the Fin Policy Trek, and being interested in finance as well as its connection to the government, to regulation, and to policy making. I thought that that was a very fascinating opportunity, something very unique to Georgetown. I was really excited to hear that there would be an opportunity to really maximize Georgetown resources as well as the Psaros Center for Financial Markets and Policy. So upon hearing about the Fin Policy Trek while at the stock pitch competition, it was something I definitely wanted to keep on my radar since I found it so interesting. And then when the time came to apply, I made sure that I had my name in the running, and I was so grateful to have had the opportunity to go on that trip. And I really found it as such an incredible and meaningful learning experience. Going to New York was also a fantastic experience, getting to learn from market participants in a wide variety of areas within finance. I really enjoyed that well-rounded perspective on the financial services industry. Some experiences from the Fin Policy Trek that were particularly meaningful for me. One of them I found was our dinner conversation with a representative from Churchill Asset Management, and we got to learn about the private credit space, which is something that was very new to me. So being able to learn about this industry that is becoming so much more prevalent given the financial tailwinds that we're looking towards. I really found that conversation to be super fascinating. I also just appreciate the career advice that we were able to receive, and just insights on being a leader in the financial industry is something that I found super valuable. Some other experiences from the Fin Policy Trek that I found as particularly meaningful was our time in the CFTC. The CFTC was something that I had relatively little exposure to. I was really appreciative of that learning opportunity to learn about an organization that oversees such an important area of our country's and the world's financial markets. And I'm so glad that I got that exposure to, once again, an industry that I may not have had as much exposure to otherwise. It was also so wonderful to meet such kind and caring leaders who care deeply about us, and were just excited to really pour their all into their conversations with us and teach us about ways to approach our professional lives. Working with the Psaros Center for Financial Markets and Policy has impacted my career aspirations and my endeavors within the business school. I would say that in one respect, it has certainly opened my perspective. There are so many lanes and areas to explore. And so I definitely look forward to, as I go throughout my career, being able to gain expertise in a variety of subjects relating to the financial markets. I believe that my work with the Psaros Center has furthered my interest in ensuring that my work in the financial services industry someday remains closely connected to the government and policy side of the equation. And it's clear, especially in the work that I've done with the Psaros Center, that the two industries are very much closely connected. I'm just so grateful for what the Psaros Center has provided me as far as educational opportunities, as both a student and a professional.
My name is Nadia Nassim. I am a senior in the School of Foreign Service studying global business, and I'm very interested in financial policy, risk management, figuring out what are the vulnerabilities in financial markets and how do we minimize those vulnerabilities as well. How I learned about the financial policy track is I actually saw a flyer at the Levy Center that had the description of the financial policy track and all the amazing places that they were going to. And initially I had thought this was an annual program that had been going on for a while that I didn't know about, as it is housed in the MSB. So I decided to apply because I had been doing an internship at the FSOC at the US Department of Treasury, and that is a lot of financial policy, a lot of coordinating, interagency, regulation among all the financial policy agencies in America. So I decided to apply for it because I had done this internship and I was really interested in learning more about it, and I was really happy that Georgetown was also pushing this forward as well. I think because I have a little bit of background in the financial policy sector in DC, going to Wall Street was really cool for me. Being able to sit in the morning markets meeting at JP Morgan was really cool. Just being able to see the conversations that they were having about their clients and things that were important. A lot of the things that were happening at the time were about debt ceiling issues, so how that would be affecting investment firms. Another one of the experiences that I really enjoyed was visiting the Neuberger Berman office, asking questions about things that I had learned about in class, what their perspectives was on, especially concerning ESG investment. That was really amazing. Everyone we talked to was super open to questions and super friendly, so really grateful for that. I think I definitely got opened up to what it would be like to work in the private sector facing the government. I didn't know that that was an option coming into the financial policy track. It's something that I learned about during the track, but thinking about what it would be like to be on the side of the bank or investment firm, asset management firm, whatever it is, and learn about what's going on in the government, what the Fed is thinking about, what the Treasury is thinking about, and reporting back and figuring out what the best action is to take for those firms are. I think that is really interesting. So I'm interested in both sides, but that's something that's definitely been opened up for me as well. The continued engagement has been very helpful for me to stay connected with the Psaros Center. I have been able to attend a lot of the events, the webinars that have been happening throughout the semester. The group that we went with was really great, so I've stayed connected with all the members of the financial policy track. We met up a couple of times individually and on a group basis. Everyone's been really great in connecting each other to resources and things that are happening at the Psaros Center. We're always making sure that we're always trying to go to the same events so we can see each other. It's been a really great community that I've been able to build with the Psaros Center. So really happy about that.
Hello, my name's Maxwell Basson. I'm a junior studying business and global affairs, which is a dual degree between the business school and SFS. And I completed the Fin Policy track last semester. I got involved with the Fin Policy track because I think I ended up just getting an email from the MSB. It was an email talking about the Fin Policy track, what the visits are, and it kind of proposed it as basically you get to go to New York with a bunch of other Georgetown students and visit a bunch of other cool places. So I was instantly attracted to it, and I did some more research, and then I ended up submitting the application. And I think the main reason that I decided to apply was because I wanted to kind of learn about finance and see if it was for me without maybe, taking semester-long classes in finance or doing a finance internship. So I thought this was a good way to get exposed to finance in kind of a 1-week way, almost like a crash course in finance, and get to talk to some of the top executives to see if it's something for me and something that's appealing. I think my most memorable moment was our visit to the CFTC, or the Commodities and Futures Trading Commission. And I think that was most memorable for me was because it wasn't really a visit that I had thought about that much beforehand, or even I didn't really know that much about the CFTC. It was really cool we got there because almost everything we was learning about was kind of a surprise for me. It was new. So that was really cool. And I think also the visit itself was just incredible. We got to talk to some high-up commissioners from the CFTC. They shared not only their experience at the CFTC, but also some life advice that they had that you could really take whichever field you want to go into. I think that was pretty cool, and it was kind of a topic that I never learned about before, and how they regulate crypto markets, futures, and all those things. So that was really cool. So I think it definitely has influenced my career track. It was interesting because for the first half of the week, we did most of the policy side. So we were visiting places in DC. And then the second half of the week, we got the finance side. So it was almost like a comparison between the public sector and the private sector. And I think I realized by
If you can settle down, please, we will get started. Okay. We'll get started with our next panel here on digital assets. And Victoria, I'm going to hand it over to you.
Thanks so much. My name is Victoria Guida. I'm an economics reporter at Politico. I'm very happy to be with you all here today to talk about digital assets, and we have an A-list panel here to talk about that. To my left is David Laval, who is Senior Managing Director and Global Head of ETFs at Grayscale Investments. We have Jason Monk, who is Director of Capital Markets and Digital Assets Product Strategy at Invesco. And last but not least, Daniel Gorfine, who is founder and CEO of Gattaca Horizons LLC and an adjunct professor at Georgetown Law. So, since we have 45 minutes, I figure I'll just jump right in. Daniel, I'll pick on you first. I'm wondering if you could just start us off and set the stage for the policy landscape. We've seen a lot of changes in digital assets over the last couple of years. We had the crypto winter. And so, how are policymakers thinking about crypto and digital assets now? And how has that sort of shifted over the last few years?
So I think actually crypto winter and kind of the fall of FTX is a good starting point when we think about kind of before that and after that. I think before the fall of FTX, there was growing consensus in Washington that we needed some type of comprehensive federal legislation that would oversee the spot markets for cryptocurrencies. And The reason for that is that crypto is largely regulated today at the state level when it comes to spot or cash cryptocurrency markets and exchanges, and they're subject to state money transmission frameworks. So there was kind of this growing agreement that what we're seeing with crypto exchanges looks more like traditional market activity, so we should have some type of federal market oversight. I think there was also consensus that we needed more clarity, or growing consensus, that we needed more clarity on definitions. When is an asset a security, and when is it not a security? Then you had the fall of SBF and the FTX debacle, and it did change things in Washington, and I think for a few different reasons. One, I do think many policymakers in town wanted to be as far away from the space as possible for fear that they would kind of be tainted or viewed as being too close to the industry. And I also think that it empowered those who are arguing that any type of legislation would just provide legitimacy to the industry and that would help it go mainstream. So according to that view, better to stick with kind of a caveat emptor, a little bit of a buyer beware environment, and kind of encourage regulators to use their maximum enforcement capabilities to go after the space. I think we've been seeing in the last number of months the limitations of a regulation by enforcement approach. So the SEC has had some losses in the courts. You had the Ripple case. We'll talk more about ETFs. So I think the pendulum will start to come back. I tend to be an optimist that eventually folks will realize that this has gone mainstream. There are enough individuals in this country who hold crypto that if you care about investor protection, if you care about consumer protection, we do need some type of comprehensive federal legislation that provides clarity around definitions and provides proper market oversight.
Yeah, we'll definitely dig into that as well. David, I did want to turn to you. You've seen the regulatory approach up close and personal. How have you seen it shift over the last couple of years?
Well, I mean, obviously it's hard to come on stage and not talk about the court case that we had. We believed that our product was in a perfect position to be converted into an ETF and uplisted in the New York Stock Exchange. Unfortunately, the SEC thought that it was not the time for a spot Bitcoin ETF to be brought to market. I think 5 or 6 years ago, I was on this panel with Reggie Brown, and we debated for a little bit whether there was ever going to be a Bitcoin ETF, a spot Bitcoin ETF, and I said it's just a matter of when, not a matter of if. And now we're really on the precipice of that, having challenged the SEC's decision to deny our product, winning in the DC circuit, and now materially moving much closer to having the opportunity to bring a spot Bitcoin product to market. I think the reality is that this was not about thumbs up or thumbs down to Bitcoin as an asset class or as an investment tool. It was really about the administrative procedure and the ability to take advantage of common rules, regulations, and process in our regulatory environment. So I think we're on the precipice of something that's going to be really favorable to investors and something that has been in demand for a while.
And that's sort of brought on by the courts rather than any sort of attitude change by the regulators.
Look, the SEC has a difficult job. It's investor protection is a very broad mandate, and we respect that. And there has been quite a bit of consistency in the messaging from the commission, but their behavior, didn't necessarily match, what they were saying. And so the need for assurances that there is appropriate surveillance and that the markets are or are not susceptible to fraud and manipulation are really credible things to show concern for. And by the way, normally regulators and industry participants are somewhat competing. Usually industry wants less regulation. We're raising our hand and saying we want more regulation. We're coming in. We want to register our product. We want to have it as an ETF. We want to have it on one of the most regulated markets in the world, the New York Stock Exchange. And so we're asking for more regulation. And the reality was that once they approved a Bitcoin futures product, they essentially said that there was enough surveillance in that product. And so if you're good with a future, you should be good with a spot. They're inextricably tied. That was the real underpinning of our court case. And if you want to read the transcripts, you would see that the courts really agreed with us unanimously.
Jason, how do you think that the policymakers should be thinking about the infrastructure around digital assets at this time?
Well, I think that's a very interesting question. I think that, as David pointed out, the policymakers are faced with a very difficult decision as to how do you regulate entities that handle digital assets. I think that the other aspect of it, and I think Daniel touched on this, is that you have to think about the underlying assets themselves. Because right now we're in an environment where we deal with stocks and bonds and other types of assets. Those things essentially live on paper, right? So you get a paper document that represents your ownership in a company, and that imbues you with certain rights. But when you get into digital assets, the digital asset is essentially computer code. It can interact, it can become essentially a living thing. And I think that that's the challenge for regulators, is to think, not only do entities need to be responsible for KYC AML, but how does that KYC AML manifest itself in the token itself, right? And you're starting to see more and more technologies that allow you to write smart contracts that are thoughtful and being forward about how do you do KYC AML and make sure that the only people that hold that token are the right people who should hold that token.
Can I pipe in there? It's a great point. I think oftentimes we see that there isn't really a gradient between this kind of binary. You either have a tokenized asset that's totally on the blockchain, or you have, a stock or a bond, which is something that we're all familiar with. The whole point, and this isn't to speak my own book, but the whole point is that there are really effective rails that are really effective in kind of offering opportunities to investors of all shapes and sizes. And so the idea of, yes, maybe in 30 years, we're going to have tokenized assets of everything that we have in our portfolios. But between now and 30 years, there's probably an opportunity to leverage the rails that we have that are currently working quite well, but that we can kind of merge into traffic, so to speak, and offer the opportunity to have exposures for digital assets, taking advantage of some of the things that are working really well in our markets.
Yeah, also jumping off something that you said, Acting Comptroller Michael Hsu recently sort of made this distinction between tokenization of assets and crypto, and he was basically saying that interest in crypto is waning, but this idea of tokenizing really anything is really getting more attention. Do you think that's the right way to think about it? Is there a increasing divide there?
Well, I think that there is an increasing divide, and I think a lot of it just comes down to what Daniel mentioned earlier, is that the perception that crypto has gotten over the past few years has trended very negative. Whereas if you just look at it from an asset manager's perspective, you can use blockchain technology, as we were just speaking about, to bring life to assets that were traditionally static. But I think where you're going with your question is that you can also bring access to things that traditionally didn't have a clear liquidity mechanism. So where it makes sense, tokenizing private market assets is very interesting. We just need to find effective ways to do that that don't negatively impact the underlying strategy. So for example, I know that there are private equity people in the room. You don't necessarily want your company to be trading 24/7 when you bought that company, because you recognize that there's going to be a period of time where I need to fix this company, I need to improve the value of it, then I can make it available for a liquidity event. So I think what we need to do is just think about how can we use tokenization and apply it to the right strategy, and to apply it to those right strategies at the right time.
Yeah, so jumping in on that as well, I think the answer to that question is it's yes and no. Tokenization is a piece of the technological innovation that's taking place. What tokenization does is it effectively creates digital bearer instruments, things that you can actually exchange from one to another, and the holder of that instrument is the owner of that instrument. So you can tokenize almost any asset or ownership right or title and interest. But that's part of it, and I agree with the acting comptroller that there could be some real advantages within the banking system, for example, if you tokenize deposits, and it assists clearing and settlement, decreases counterparty risks, speeds transactions. But there's more, and I would be wary of dismissing all the rest. To me, the blockchain conversation is about new rails. Those are the transaction rails. So you've got the tokenized asset, and then the question is, what rails does it move upon? It can move on traditional rails, traditional infrastructure, or you can think about blockchains, distributed ledgers, where it's moving on these interoperable and potentially open public systems. I wouldn't discount or dismiss how important that could be as well. That can be thornier, and we've seen that with cryptocurrencies, because the nature of open and public is, but you can see the positives in terms of access, and you can see it for efficiency perspectives, being able to communicate across different entities without being in a siloed environment. But there are going to be risks associated with it as well, because by the very nature of it being so open, right? No one controls it per se. So personally, I think all of these innovations are really important, and I think we're going to see them kind of move gradually and change how we transact most types of financial assets and instruments.
I think what Daniel brings up is a really important point. I hope that the audience understands, is that right now digital assets, excuse me, are operating on one rail, and then fiat or cash is operating on a completely separate rail. And that created different use cases, or in some cases, people would view it as different problems. So for example, stablecoins. Stablecoins address one of those key problems, which is that Bitcoin, instantaneous settlement, cross-border transactions, et cetera. But if I have US dollar cash, it's really hard for me to move my US dollar cash from my entity or my bank to another bank. Cash doesn't settle instantaneously. It takes time. So stablecoins fill in that gap. And because they're filling in that gap, there are specific trade-offs that you need to make with a stablecoin. So people who issue these stablecoins have to be thoughtful about, hey, I can't make this a security, so I can't promise a yield. And now we're in an environment where cash is actually worth something, right? So people are thinking about what is the trade-off between having a stable coin that can transact instantaneously versus tokenization of something else that can transact instantaneously and be on the same rail, as Daniel pointed out, as the underlying crypto or digital asset you want to transact in.
Yeah, well, that's a perfect transition to talk about federal legislation. There's been a lot of activity around stablecoins. The Fed and Treasury, it seems like they really want to have issuers of stablecoins have bank-like regulation. I mean, is that the type of thing that makes the on and off ramp more difficult? Is that like a good way to think about it?
So that's a very thoughtful question as well. I think that as we think about on and off ramps, we certainly want all of those on and off ramps to be regulated to a certain degree, because you're essentially transmitting cash. And transmitting cash comes with a lot of regulatory scrutiny, but doing so in a way that gives people transparency into what's happening. So if you think about transacting in a stable coin without that regulatory framework being very clear, people are taking a risk, right? And we saw that in some of the tokens or stable coins that broke the buck earlier this year and last year. And I think that was a part of what precipitated the fall of FTX, right? So it broke the buck, and then people started to apply pressure to that. So I think regulators need to think, what problem are we trying to solve? Right? So the problem that we're really trying to solve, as Daniel pointed out, is we need cash or the transfer mechanism to be on the same rail as a digital asset, whether that's a cryptocurrency or some other asset that people want to transact in. And it's really important to make sure that that on and off ramp is regulated and stays regulated. So we saw SVB go down, and we saw other banks go down, and we saw that these ramps started to deteriorate, and that put more additional pressure on stable coins and their ability to hold fast.
Yeah, I think things can get very complex. You raised some great points. It can get very complex very quickly, and if we kind of lean on the last panel and talk about some of the things that we've discussed, it's about investor protection, transparency, disclosure. And you make a comment about like stable coins just generally, or ETFs generally. There are many different examples of those products within that kind of overall umbrella or wrapper. And so it's about the opportunity for investors to understand what they're kind of owning. It's about understanding access. How do you get access to that? What level of transparency and disclosure is there for that particular investment opportunity? And making sure that it's put in front of the investor either on the platform that they already have access to, or in a manner that they're kind of used to experiencing their investment opportunities. And nobody wants to see someone's investment, be vaporized because they didn't know what or didn't understand what they owned. And so it's another reason why we're quite, strong advocates of finding traditional rails to kind of, merge these new types of opportunities and put them in front of investors in a way that they can absorb them, understand them, research them, digest them, and then making an informed investment decision.
I can't help myself. I'll get myself into a little trouble here and say that just like with crypto market regulation, I do think that stablecoin regulation is also, it shouldn't be that hard. When we talk about what we need, it's fairly straightforward. You need regulatory oversight that can actually audit and confirm reserves that are being placed with the issuer. We can model a lot of this off of what we do in the dual banking system, that you can have well-regulated state-chartered banks, you can have nationally chartered banks. So I fear that we've made this even more complicated than it should be. I mean, in many respects, stablecoin as a business model is fairly straightforward. Many of them are pretty plain vanilla. It's taking cash in, it's tokenizing and issuing a token in a dollarized form, or a dollar in a tokenized form. This is an area where we should be able to figure out how to just make sure that you have a regulator that oversees the operations of the entity. I think we've made that a little bit more complicated than it needs to be.
I agree and disagree. I mean, we were stuck in a position where we wanted to kind of advance the ball of GBTC many years ago, and we raised our hand and voluntarily registered the product as an SEC reporting company. So on a quarterly basis, we're filing Qs and filing Ks and we're filing 8Ks. And so how do you take advantage of the current regulatory framework instead of throwing your hands up and saying, man, there's no regulatory framework? What we've continued to do, and we think the industry should do, is to continue to leverage what we have and push it forward. Obviously, there's a need for massive overhaul, in terms of how to build a regulatory framework that's more encompassing. But we're really advocates of pushing the envelope and making sure we can use the rails that are currently in place. Obviously, we're pushing forward with an ETF, but there's other opportunities to do that as well.
Well, and on that point, I mean, how important is federal legislation, just sort of on the crypto framework generally, figuring out what's in the SEC's purview, what's in the CFTC's purview, what's maybe in the Fed's purview? How important is that to your business?
I mean, it's very complicated when you think of it holistically. For our business, it's pretty simple. We're facing off with the SEC. We want to have registered products that are clearly under the purview of the SEC. We've been engaging with them both on our own and in concert with the NYSE, who is the stated listing venue to uplist our product. So it's pretty straightforward for us. But we welcome that and we like that, and we think that the ETF wrapper holistically offers a very battle-tested wrapper that has become a really ubiquitous tool to have building blocks for clients' portfolios. And we soon forget that in 1993 SPY came to market, and everyone thinks it's S&P 500, market cap weighted, index-based exposure. It's plain vanilla. In 1993, that was a pretty exotic kind of institutional class of investment, and it took the 1987 crash and a bunch of work by the entirety of the market community, that is, lawyers and regulators and exchanges and market practitioners and indexers and quants, to come together with this idea of we need something that institutions can utilize to help balance out the market. Now, it turned out to be this wonderful investment tool for retail investors, but it took nearly a decade to get that product launched. And so ETFs have continued to evolve and offer access to investment exposures that had not yet before been accessed by retail investors. And this is another example of utilizing that wrapper, utilizing that innovation. And it's really kind of the two of the greatest financial innovations in at least my lifetime coming together, and that's why we get pretty excited about it.
I do want to come back to the Bitcoin ETFs, but just to close the book on this legislation conversation, Daniel, how optimistic are you that there actually will be legislation that makes it through?
Oh, goodness. I mean, I'm not incredibly optimistic just based on reading the town, but not in the near term. I do think it will eventually happen. As I said, on crypto market structure, the existing gap in terms of lacking federal market oversight, regulation and supervision of what's clearly trading activity, I find it hard to believe eventually we don't get there. And I think definitional clarity on assets, there I'm a little less optimistic because I think it's difficult for lawmakers to articulate what the tests should be. So probably the courts end up deciding a lot of this, and it'll be case law. And those of you who are lawyers know that you can have periods of ambiguity and eventually new tests emerge. So that's probably what happens there. With stablecoin, again, to be clear, I think there already are ways to issue, and you can do it through state-based frameworks. My point is you'd provide a lot more overall clarity and certainty and consumer protection if you just clearly articulated what the standards of regulation need to be, whether it's state or federal based. These are basic kind of bank oversight type functions. This is not, it's not that complicated in terms of how do you safeguard deposits? Is there transparency around what happens with reserves? I mean, a lot of the things that we've seen over the last couple of years could be solved with just common sense kind of regulation there. What will make it happen? I mean, again, maybe you see it after an election cycle that some reasonable minds come together on it. My longer term view is that there'll be a forcing function. It's going to be either, we haven't talked about CBDCs yet, but whether it's public sector CBDCs or private sector stablecoins that really start gaining scale. Unfortunately, this town tends to only act when it's really being pushed or there's a crisis or something happens that triggers activity. So it's probably going to take some type of a trigger. It could be, seeing a central bank digital currency elsewhere, seeing a major private stablecoin project. That's enough to motivate to say, hey, we should probably just provide the right degrees of clarity and oversight here, as I think we can do.
So I'm going to do your job for 1 second. I'm sorry. I have a follow-up question. We have never seen more bicameral and bipartisan support, which is a result of every constituent base in every state either having been hurt by things that have happened in the past or having demand for more clarity on that. So I'm curious your opinion on that.
Yeah, no, I think that's right. We all, and that was my, when I stated this, but the kind of pre-FTX, I think that consensus was really coming together, and I could see a path. I think that got muddled as a result of the fall of FTX, and again, we kind of talked about the dynamics that drove that. I think we can get back there. But there are some lurking issues, and some of the lurking issues are, we talked about banking, like how much do new oversight frameworks, licenses and charters, will they start to look bank-like? Will the banks not like the fact that there are new entrants? There's the state-federal issue. Those are pretty big issues in Washington that can delay things and kind of grind things for a while. So while the ultimate outcome to me seems pretty obvious, and I think to many seems obvious, it's how you get there that's the challenge. So I am net optimistic we can get that consensus, but it'll take some time, I think, to work through the process here.
Got it. Well, back to the Bitcoin ETF.
Sure.
Which I won't ask you to speculate on when it's going to be approved.
You can ask. I don't know. There we go. We did it. No.
But let's assume it does get approved.
That's a good assumption.
What does that actually mean? And there's been some talk about whether the effect of that is maybe a little bit overhyped. What are your thoughts on that?
So it's about access, right? And back to the example of kind of new ETFs or new exposures coming to market in the form of an ETF. This is really about the opportunity for Bitcoin exposure to be brought into, as I'll broadly categorize, the advised market. Unlike most ETFs that would come to market, it's kind of like an institutional class of exposure that's then kind of afforded to the retail investor. This is really a case where there's kind of a barbell approach where the most sophisticated institutional investors have done their homework and figured out how to gain access to the asset class or to Bitcoin. And then there's kind of the retail enthusiast who has also figured it out. That advised market in the middle, registered investment advisors, independent wealth managers, broker-dealer wirehouse, large global banks with their wealth management platforms. And what we hear from advisors are two questions and two frustrations. One is, since Bitcoin or digital assets are not available to their clients on their wealth management platform, it doesn't mean that their clients are not investing. They're just pulling money off the platform, and then they're going and investing in other areas. That causes two problems. Number one, it has a revenue impact to that institution because now their asset base is lower, and so they're not able to charge the fees on that. And the second problem is, which is to the kind of frustration of the financial advisor, they don't have a holistic picture on their client's portfolio. So they may have taken 5% of their money and bought Bitcoin. Well, now it's maybe 30% of their money. And that could be a problem for the advisor's ability to actually kind of manage the portfolio for the benefit of the client's kind of needs. And so this is about offering kind of access in the rails that individual investors are used to. So we think it's really favorable.
Jason, I also wanted to ask you, I mean, how would an investment manager actually think about a Bitcoin ETF? How would you go about storing and purchasing and insuring Bitcoin?
Well, I think what we have to do as asset managers is think about the trade-offs. So David touched on some of those trade-offs, and those are the things that we have to think through. Is if you make a product available to retail investors, you need to think about the regulatory impact of that. And you also need to think about how do you apply the tried and true frameworks that you're used to and the vendor partnership that you have. and frame those in a way that allows you to create something that works efficiently for retail investors, but in a new asset class. So for us, it's just about weighing those pros and cons of each decision that we make.
In 2013, we envisioned this product to be exactly the way GLD, the largest kind of physical gold ETF that was brought to market in 2004. And many of the same complexities about having a physical gold investment apply to a physical Bitcoin investment in the form of an ETF. It's not difficult to invest in gold. Institutions do it. Individuals do it. People could buy jewelry, or institutions can buy gold bars. But the complexities associated with custody, the complexities associated with the liquidity of those markets, and quite frankly, the transparency into those markets and how efficiently they work, certainly for a retail investor, is pretty difficult if you've ever been to 47th Street in Manhattan. It's a pretty vibrant market, but it's not necessarily transparent, right? The process of utilizing this investment wrapper offers pretty tried and true price discovery mechanism, and the opportunity to have quite a liquid investment inside a wrapper that has been battle tested in up markets, down markets, sideway markets, and the infrastructure around it with high quality market makers, liquidity providers, global banks, authorized participants are all the same. So the investor's experience is that I'm going to buy this ETF, I'm going to trust the marketplace, I'm going to trust the regulatory framework, I'm going to trust the New York Stock Exchange, I'm going to trust the SEC's oversight of it, and that's something that we think the battle-tested nature of the ETF is going to allow investors to invest in Bitcoin with a high degree of confidence.
Jason, I also wanted to ask you, there's obviously a lot of different rules about digital assets around the world. How do you all navigate sort of the different regulatory landscape in all the different countries and trying to figure out?
So that's a good question. When you think about the different countries, the one thing that we've learned and we've tried to apply in every decision going forward is that just because you tokenize something or try to put a digital wrapper around something, you still have the underlying regulation. And I think this is something that Daniel touched on. So if we want to tokenize something in Luxembourg, we still have Lux-CCAV regulations to contend with. If we want to tokenize something here in the States, we still have that same framework. So what we look at is how do we make sure that we're fulfilling all of the local requirements, because every local requirement is going to be different, of course, but then also investor expectations around disclosure and how they should view those assets is going to be different in each locality, and that's how we think about it.
Yeah. And then, I did want to make sure you mentioned CBDC. I did want to make sure we touched on that before the conversation's over. How do you see CBDC fitting into this conversation? There's a whole debate about, whether a CBDC would supplant stablecoins. How do you think about?
Yeah, it's a good question. So I don't view CBDC conversation and stablecoin as being mutually exclusive. And I also would even step back further and say, but for Bitcoin, we wouldn't be talking about any of these things. And it goes back to that kind of overarching infrastructure conversation about rails, about tokenization, and just the general realization that we can send, information about value halfway around the world to somebody with relatively few intermediaries at low cost with near instant settlement with these bearer instruments. Like, that's a really powerful thing, and it's going to impact all assets, all instruments, including money. So, I tend to view private sector stablecoins are really interesting developments, and I think they can help future-proof the role of the dollar. I mean, the dollar can be used in that tokenized format. That said, I think central bank digital currencies are the most risk-free forms of money. And I think that where a lot of the debate comes in around this is really a design question, and that's where people get very uneasy, and rightfully so. Because it's difficult to think about how you want to design the future US dollar. But things like privacy matter a lot. You worry about surveillance, you worry about these types of issues, but I think that these are the right debates that we should be having right now around how we want to design money and how we want transactions to kind of flow going forward. But to answer your question, the US definitely is a slower mover overall in the CBDC conversation. I think that being said, back to the point I made before about global developments will kind of shift things. Whether we like it or not, whether the US issues a CBDC or not, jurisdictions already are, and I think more will. And I think we're going to continue to see private stablecoins continue to grow in adoption. So we have to be mindful that from a US perspective, we're going to operate in a world where there are different types and forms of money. And so, from a US perspective, I'm a co-founder of the Digital Dollar Project, which is a nonprofit focused on CBDC exploration. The view we have is that it's critical that the US has a lead seat at the table in terms of designing the standards that will govern the future of money, whether it's CBDC, whether it's a stable coin. Those questions around privacy and surveillance, we can't just ignore it and assume that if we don't go forward with a digital dollar, it means that the issue goes away. It won't go away. And we have to figure out what's the role of the dollar in that future system. Is it interoperable? What if other jurisdictions move to these new digital rails? How do we effectuate things like sanctions regimes? Countries are moving to develop new infrastructure to kind of avoid Western-controlled payments infrastructure. So I view this as all intertwined, and I know it's a lot that I threw at you with a simple question about CBDC, but I view CBDC as a forcing function to make us think about these things, because otherwise, my biggest concern would be 5 or 10 years from now, if the country's not kind of playing a leadership role, we may wake up one day and say, well, wait a minute, gosh, there are all these new rails out there that people are transacting upon, and maybe it's anchored to either other foreign currencies, or we haven't really thought about how do we design these to embed privacy norms and expectations. Those types of things need to be done now.
Yeah, well, and I think there's also a debate about retail CBDC versus wholesale CBDC. Do you see any kind of limitations from if we did have a central bank digital currency, if it's only between banks as opposed to having regular people have access to it?
So I tend to be kind of net. I'm generally pro any of these innovations because I think that they drive down costs. I think they increase efficiencies over time. There's certainly risks, but overall, if we talk about wholesale CBDC, yeah, I think it can create a more efficient banking system. I think when you're talking about other issues like retail CBDC, and you're thinking about inclusion and access and interoperable money and automated money or programmable money, then retail CBDC does become important. So I personally am still very interested in the concept, but design matters an incredible amount. So my hope would be we would hold the analogy as much as possible between a potential retail CBDC and physical cash. So if it's not insured, if it's non-interest bearing, I don't expect that Americans are going to want to hold huge balances in digital dollars the same way you probably don't hold more than $50 in your wallet. But it does create a way for retail individuals to hold public money. And I would actually take a contrarian view that it wouldn't destabilize the commercial banking sector. I think that public money, the idea that we can go to an ATM and get cash out of the machine, supports commercial bank deposits. You're confident in your commercial bank deposits because you know it's redeemable into this form of money that's backed by the full faith and credit of the US government. So I think we should have a digital type analog of that. But I don't see it as something that means that we're going to completely transform banking. And in fact, we shouldn't do that. I think it should be distributed through the two-tiered banking system, like the same way you go to an ATM and you get physical cash from your bank. So design matters a lot when you get into the retail conversation, and that's why it becomes so thorny and controversial.
So I do want to turn to the audience, but do either of you have thoughts that you want to add on central bank digital currencies?
I think it's a lot easier to start with a Bitcoin ETF. That's what I would say.
On message.
That's what was resonating.
So the one point I will add to what he said, is, which is really important, is that design matters. But I also think we have to look at how banking has evolved, right? So I think what Daniel was touching on is that our banking system in this country has evolved to a point to where you're starting to limit what would be the potential use cases for CBDC for a retail investor or a retail holder. So for example, we have FedNow, right? So FedNow is out there, and now you have instantaneous money transfers between banks. So in theory, the bank is now instantaneous, but it's between essentially commercial bank and some community bank. So as that evolves, more instantaneous transfers will happen between banks on behalf of clients or customers. Now, if you look at what the retail case would be, we have to all go back to COVID, unfortunately. We used to pay for cash. We used to pay for things with cash. Now you go into venues and people are mad because they can't use cash, right? So now you go from, now it's not cash, but now it is a digital currency of some sort that has functionality that people may not understand or be aware of. And I think that that's where the design does matter. So how do you maintain my privacy? How do you make sure that I'm not being surveilled in a way that impacts my civil rights? And it's really hard to get people to do that or to understand that, especially when the countries that are leading this CBDC development have a certain history, right? So do we want to follow in that same history, knowing that people have privacy concerns and are concerned about being surveilled?
Yeah. Well, let me know if you figured that out. So I do want to turn to the audience now, and I think we want to give priority to any students in the audience. So if anybody has questions, please feel free to stand up. Over there.
Hey, my name is Jabari Aiken, second-year Master of Finance student here. Thank you guys so much for being here. My question is pertaining, and I guess it's for the retail and the institutional side, but for the retail investor that's not necessarily a Bitcoin or crypto or digital asset enthusiast, how do you guys suggest that they or we think about value and valuation and then just general investment in the space? And then I guess also the same question from the asset management side.
Who wants to take that?
You want to start and I'll finish?
Okay. So I think the question about value, and I think the question, it really boils down to that's what makes markets, right? So people have a different view on value of Bitcoin, regardless of what's happening in the market. You believe it goes up or down, right? So Bitcoin is a bit of a different beast in that you can't necessarily model cash flows, you can't necessarily model these things, but it does have a place, and people will have a contrarian view or a protagonist view on where it should go. When you look at digital assets, I think it goes back to what we were saying earlier. You're still going to be looking at the underlying asset itself. Even though we put a digital wrapper around it, you're still going to want to understand what are the cash flows of the underlying company or real estate holding, et cetera. And that's what you're going to use to base the value of that specific digital asset on. I think we just can't allow ourselves to get abstracted away from the fact that we're still trying to make an investment and still use some of those same principles.
So I would say if you don't understand something, don't invest in it. But I would counter that by saying there's a tremendous amount of information out there. Not every product is created equally. You know, it could be called the financials ETF, and it could have 20 constituents or it could have 200 constituents. And so understanding what you own, making sure you understand the product, and leaning on the institutions that are bringing those products to market is the absolute best way to get confidence in the investment. You're either going to go to that website or talk to a human that works there, and you're going to feel confident and more educated about it, or you're not going to feel confident or educated about it. But there's a tremendous amount of resource out there, and there's a tremendous amount of disclosure. I'm not suggesting you read the disclosure documents, but I'm suggesting that you reach out to the individuals and the entities that are bringing products to market and educating yourself on it to see if that fits your investment profile, that fits your risk tolerance, and that fits what your investment needs are.
I mean, just quickly, when it comes to kind of the broad universe of cryptocurrencies, I think you should approach it with a lot of caution and a lot of skepticism. I personally do not believe we're going to end up in a future state where there are hundreds, if not thousands, of different tokens that exist. I think that they have to have a real-world application or use case or reason to exist. With things like Bitcoin, whether it's a good hedge or not is an open question for the market. Is it digital gold? Is it digital bronze? Does it have some anti-inflationary characteristics? Maybe. What's it worth? That I think markets seek to discern, but I do think you should come at it with a lot of healthy skepticism. Outside of assets that do that, there has to be kind of a purpose for the token, right?
Great. Do we have another question? Right here.
Hey, thank you for this really, really exciting and insightful conversation. I think I might be the only person representing the McCourt School of Public Policy, but I'm very interested from a more policy-oriented perspective and a former staffer of potentially one of the most pro-crypto legislators in the country right now, Richie Torres in New York. But I saw through the work we did on the Financial Services Committee that there were two conflicting narratives around digital assets. One was one of low transparency, but really tight security and privacy safeguards, one that could potentially be used for illicit purposes, but another conflicting narrative around traceability and the use case of being able to pinpoint really specific transactions, which may help with law enforcement. So I would love to know your thoughts on what lawmakers and policymakers are too often getting wrong around the use cases with digital assets and crypto, and perhaps where the conversation can be going beyond just the retail investors that would be using it for personal gain.
Oh, that's yeah, everyone looking at me. I mean, I think that both views are somewhat right, but I would actually step back and say that, the initial starting point should be that this stuff exists in the world, whether we like it or not. And I'm very wary of any approach that just kind of further pushes it away from US regulatory oversight, because all you're doing then is having these rails and networks develop outside of our jurisdiction and purview. So I don't like that approach. I think that you have to realize that this cat's out of the bag. So the best thing to do then is really understand it. Learn how to use the technologies. There are blockchain analytics and surveillance firms that can help you kind of trace and monitor. You can work closely with industry in order to solve for some of this. And then I also think on the leadership stage, there's international organizations like FATF that put out standards that global regulators should be adopting to make sure that proper anti-money laundering requirements are in place. Most jurisdictions around the world are not adopting the full set of FATF standards, and that's a problem. We need to be pushing that. You have kind of a recent conversation around terrorist financing with crypto, and yeah, I mean, if you have exchanges that operate in unregulated jurisdictions or where that oversight doesn't exist, we shouldn't be surprised that there's going to be a problem there. So U.S. leadership needs to kind of push standards through international entities like FATF to make sure that as many jurisdictions as possible are putting the right safeguards in place. But I don't think we can kind of reverse the clock. I mean, this stuff's out there. So if we choose to kind of push it and cut off, you're just moving it further away from our potential to have influence, quite frankly.
So
We're out of time.
Yeah, I think that's the perfect place to end it. I think this was a great conversation. Thank you all for being here, and look forward to the rest of the program.
Thank you to the center as well. Thank you.
set. Okay. Can I have your attention, please? Hello, my name is Rohan Williamson. I'm a professor of finance here at Georgetown. And I would like to welcome again this year Robert Cook, CEO and president of FINRA. And we'll spend the next 30 minutes or so going back and forth. And then at the end, we'll open it up for questions from the audience. Well, Robert, welcome. Welcome back to Georgetown. Happy to have you as usual.
Thank you. It's great to be back.
Absolutely. So let's just.
And I understand you've come back from a sabbatical to be here, so I'm honored that you're once again my inquisitor.
Absolutely. Just the opportunity to be your inquisitor is enough to come back from no matter where I was, and you can go to Hawaii anytime.
Yeah.
So let's get at it. The consolidated audit trail continues to be a topic of keen interest to the industry, particularly in terms of sensitivity of customer information, as well as funding for CAT. So can you update us on sort of where we stand on these issues?
Sure. Nothing like jumping right into a fun topic.
Absolutely. This is
Yeah. So first, let me preface this by saying I'm really only speaking for FINRA and not all the other parties who are engaged in working on the consolidated audit trail. It really is a large group of regulators who are actively involved in it. But I guess I'd say two things about CAT. The first is that there's a transaction database of CAT which is up and running and is doing everything that was, we wanted to get out of it. It is a single source of data on all equity and options, orders, and transactions. It provides the type of insight into what's happening in the markets that I think our investors expect regulators to be able to have. Remember, this was sort of born out of the flash crash when it was very difficult to piece together these various data sets. They were incomplete, and it took a lot of time. The transaction database really provides a single source of data for oversight. So we use it for surveillance. We use it for market reconstruction when something's happened that we need to take another look at. And we use it to help inform policy. It's still relatively new, so we're still beginning to learn what more we can do with that. But I think that's a big success, and I think that gets forgotten sometimes in the conversation. The second part of CAT, I'd say, is relates to the question you raised about sensitivity around personal information. There's a second database under the CAT regime that has information on individual and institutional participants in the markets. And it's a way of allowing regulators to be able to see, well, who's behind all those orders that are in the transaction database. And a lot of questions have been raised about whether we really need all the information that's collected in there. I mean, do you have a securities account somewhere? I guess you do. Yeah. But your name's in there, and your address, and your date of birth. Do we really need that? It's a different kind of system than we typically have, where normally for oversight we'd find there's a problem and then we'd go find out who's behind it by going to, after we realize there is a problem. Here, all that has been collected up front so that it's available for regulators to look at without having to go to the broker to find out who's there. And I think a lot of people feel that's maybe doesn't strike the right balance in terms of privacy, security concerns. So look, if you ask a regulator, is more information better would it make your job easier? Of course it'll make their job easier, but that's not really that can't be where the inquiry ends. Right. Like, you have to balance that against security and privacy and other types of concerns. So I think that from my perspective, we haven't landed in a resting place there, in the sense that there are a number of alternatives that have been presented over time that the SROs have worked on, the industry have worked on, to reduce the amount of information that's there and still provide important regulatory benefits. We could just go with large traders, like just the biggest people who are in the market. I'm guessing you're not manipulating the market, right? No, I don't know. I don't mean to presume, but
I'm on sabbatical. I don't have time for that now.
But I mean, anyone's in there, and maybe we say, let's just get the really big traders in there, or we say, let's get more limited information that we could then use to follow up if we need to. So I think there's a lot of detail to get in here, but my point is that I think that we probably should take another look at whether we've got the right balance there between achieving the regulatory objective and recognizing the important privacy and security concerns.
Great, great. So let's think about the regulation landscape and the volume of regulations at the state and federal level. So how does FINRA think about how to proceed on its own agenda and priorities given this this landscape on the federal and state level?
Well, let me answer that by maybe amplifying on the problem I think or the issue I think you're identifying. There's a lot of change going on right now. A lot of new rules that have either been proposed or are in the implementation phase. And so what can we do in that environment? I think we try to be very, very sensitive to the amount and pace of change. I do think that there is such a thing as going too far too fast when you're talking about very complex systems, a lot of back office operations and technology that can be impacted. Things can go wrong if you try to force too much at once. And so one thing we can do is be aware of that and then frankly throttle some of the rulemakings we have in mind. And I think you see that, a number of the in a number of respects, we're really trying to focus now on what do we really need to get done. There are things that we think would be good to do, but we're probably going to pace ourselves to make sure we're not throwing too much at the industry at the same time, all at one time. And there's also an opportunity for us as an SRO to work with other SROs to try to help the industry make those transitions, help provide guidance, help provide best practices or effective practices where we can to recognize there's a lot going on. Just to give you an example, right? T+1 settlement. The industry is working really hard on that. It's complicated. It's a big lift. There's a lot of technology, operations, processes that need to change between now and May. And in any ordinary environment, that would be the big thing we were talking about. Hey, how are we doing on T+1? And I'm worried we're not talking enough about it. I want to, are we really on track? People are working really hard. People are really dedicated. I think, I'm not saying there's going to be a problem. I'm just saying that's a big thing by itself. And we have to make sure we don't lose track of all the things that are happening all at once. And we're going to try to help you support the conversation in that regard.
Okay. Let's go a little bit to sort of the working environment. We know over the past several years, this idea of remote work and hybrid work has become important. And so FINRA has a proposal to the SEC and how they look at remote work. Why is that important to you, and how do you think that's going to go?
So, COVID hit. Everyone had to work from home. We had a lot of rules that created a problem in that context because a lot of our rules are written around the brick and mortar concept of an office or a place of work, right? So we gave a lot of relief from a number of our rules, but we also recognized, we're going to have to go back and circle around and figure out what should our rule set look like going forward? How does it need to be updated? And we picked to start with a couple of items we thought were relatively low-hanging fruit. I think they're the ones you're referring to. One is to allow firms to, firms have to have branches and they have to go out and inspect their branches, and traditionally that has to be occurred in person or the branches in other locations. And in a work from home environment, it's are you really going to go to someone's home? People do that sometimes, but some firms say if I have to do that, I'm just not going to let people work from home. Some people just won't work from home if that's the way it's going to work. So how do we create a regulatory system for supervision that really protects investors but recognizes that people have shifted their expectations around where they do work? And so that's what this proposal, we have a pilot it's a proposed pilot to allow firms to do oversight of branches on a remote basis, subject to a lot of conditions. And there's another one to allow certain supervisory activities to happen from home without becoming a branch office. There's a lot more to do, but we really wanted to get these ones done first because we heard from the industry these are the ones that mattered the most in the near term. So we filed them back in July of 2022, and it's been a long process with a lot of comments, and it's been helpful to kind of refine those proposals. The period for the SEC to act is this by the end of the year on both of them. It's a little different timing, but for both of them, they have to be done by the end of the year. So if you're from a firm, what I'd say is you've probably been thinking about these things and listening to them and not sure, like, when should I really engage? Who knows if it's going to happen? Nothing's done till it's done. They haven't been approved by the SEC, but I would encourage you to start looking at these rules and think about or budget time to look at them, because they're not self-executing. There's a lot of conditions, requirements, procedures you'd have to put in place. It's going to take some effort by firms to get on top of those things. And I would say, it's probably worth beginning that process now. So we're optimistic they'll get approved, but the conversation needs to continue about how do we strike the right balance between appropriate oversight and creating appropriate flexibility for firms and their workforce to adapt to the new normal post-COVID.
Okay, and thinking about the evolution of work here. So the SEC recently released a proposal for public comment on the use of predictive data analytics, which would regulate some digital interactions that firms have with customers. From your perspective, what do you see as any potential issues in regulation to address this issue?
Well, it's a big topic. I guess I'd start by saying that, look, technology has been amazing in enabling greater access by investors. We see that when we look at our research from our Investor Education Foundation. There's so many more new investors coming into the markets. Many of them really they haven't had exposure to investments before. They're more diverse in their makeup. This is a good thing, right? To have and to leverage technology to expand participation in our capital markets. But we also know that we need appropriate regulation. And a lot of existing rules apply to digital interactions that investors have with firms. And I want to just underscore that those rules matter and they're important, and firms need to make sure their communications are accurate and that they're fulsome and the disclosures are effective and everything else. And we need to make sure those rules evolve as the technology evolves. It's really important to make sure the rules evolve appropriately as well. So which brings me back to this proposal. I think it is important that the regulators look at how technologies are changing and then how can the rule set evolve to make sure investors are protected. On this specific proposal, I think we're still kind of sorting through in our minds how it actually works, because what it says is you take there are very broad definitions in it, so it covers a lot. There's a broad definition of investor interaction. It's basically any interaction you have with investors. There's a broad definition of the technology that's covered, which is basically any technology you use to interact with investors. And then there's a broad definition of conflict of interest. You look at all the technology that enables your interaction with investors, and you ask, does that technology take into account any interest of the firm? And most interactions will, I think, conceivably take into account some interest of a firm. And so then once you've got that covered technology broad, investor interaction broad, and conflict of interest potentially there broad, then you got to do a whole analysis of whether the technology results in putting the firm's interest ahead of the investor. And that's I think a very important and useful principle and goal. But I think when you think about the implementation of it, it's very challenging to know, what do you have to do and how far do you have to go? And I think I'm worried a little bit about potential, do we really understand all of the unintended consequences that could flow from having to do this cataloging of everything you do, look for all the conflicts, and then when you have that type of conflict, you have to either eliminate it or neutralize it. And so what does it take to eliminate? What does it take to neutralize? And oh, by the way, there's Reg BI, right, which is out there, and that also applies when there's a recommendation. And so this uses a slightly different definition of conflict of interest than. So my overall answer is, we have to keep up with the technology, and the rules need to evolve with the technology. I think we're just trying to make sure we understand, because we're going to be in a position of having to oversee this or to supervise or examine for this when it comes to broker-dealers. What exactly does it require, and how, what steps are firms really going to need to take, and what are the unintended consequences? So we're very much kind of I think a lot of folks kind of absorbing the the proposal and trying to understand what it would mean for our supervision and what it would mean for the ability of firms and investors to continue to leverage the great benefits that can come from technology.
Good. So let's kind of shift directions a little bit. And so this month, FINRA filed with the SEC a proposal to disseminate information on individual transactions and Treasury securities. This latest development is a series of changes over the past few years to increase transparency and transactions in Treasuries. So what's FINRA's role in sharing this information about Treasury securities, and why is FINRA proposing disseminating information on individual transactions now?
Sure. So this is part of our overall TRACE system, which is the reporting system for trades and fixed income securities, which has been evolving for decades, and most recently has started to include reporting in of Treasury transactions, which did not happen 10 years ago. And so our approach to the rollout of sort of the expansion of TRACE has been, first, let's collect things for regulatory purposes so we understand the data and we can make sure it's got integrity. Then look at dissemination of data transactions on an aggregate basis. Then look at dissemination of individual trades on a delayed basis, and then finally to look at dissemination of individual trades on a more of a real-time basis. So a lot of TRACE is at the end is in that last category. It's the trades are being reported more or less as they happen. What this proposal does is, for the first time, it would have the dissemination of individual trades in Treasury securities. Not all, just a selected group of on-the-run securities. The dissemination would happen at end of day, and there'd be caps. So we operate the system, and the reporting comes in accordance with our rules. So that's our role. But we work really closely with the Treasury and the SEC to make sure that everyone's on board with the nature of the scope and when the timing, when the data is released and what's included in it. So we're by no means sort of off on our own on this thing. But I think it's exciting because this is the first time there'll be dissemination of trades on individual Treasury securities. And why is that important? It's like the rest of TRACE. We believe that the transparency this brings to the market actually improves the experience for investors. It reduces spreads over time. I think there's a lot of academic literature that supports that. And so this is sort of the next step in that evolution. Again, it's kind of like in the third of the four categories I think I mentioned. It's dissemination of individual trades on a delayed basis. And perhaps the next step beyond that at some point in the future might be dissemination of individual trades for Treasuries on a more immediate basis, like for other fixed income securities. We're not there now, who knows, but we like to take this step by step and to see what the impact on the market is before we move further.
Good. You're up for a few questions?
Sure.
From the audience?
Yeah.
So there are mics set up on both sides, and we'll open it up for audience questions. Go ahead.
Mr. Cook, thank you for being here today. I am a sophomore here at the business school, and my question is, with the rise of digital assets and decentralized finance, what steps is FINRA taking to adapt its regulatory framework to ensure investor protection and market integrity in these emerging sectors of the financial industry?
Well, thanks for that question. And we do spend a lot of time thinking about the growth of the digital asset markets, and the nature of our regulatory authority is that we really only have authority over our members. And most trading in crypto assets does not happen in a FINRA member. It happens in people who aren't regulated. But we do have a group of firms who have applied for and received membership to trade in crypto assets. It's usually very limited private placement type of activities, but these are folks who are saying, okay, these assets are securities. I want to be a broker-dealer. I want to comply with the broker-dealer rules. We've got about 26 firms who've come in in that way. And we're learning by working with them, how do the rules work? Are there areas where the rules need to be adjusted? Similarly, we're also looking at any situations where the rest of our members are involved in marketing or advertising crypto activities and making sure they understand that our rules apply to those when it comes to false advertising or the integrity of the disclosures being made. So, but we're sort of in the mode of where a lot of this is happening outside of the FINRA firms, and so we're trying to think about how do we best support the investor protection within the scope of our jurisdiction. Thank you.
Okay. Over here.
Hey there, Mr. Cook. Thank you for coming today. My name is Holden. I'm a senior in the business school here. Earlier today, we heard from the market structure panel about GameStop and the rise of retail investing, trading over the past couple years. From your perspective, what has kind of caused this rise or this trend? Do you think it's attributable to perhaps the gamification of investing and trading through apps like Robinhood? And then as a follow-up, I was wondering if you could speak to kind of the GameStop situation and how FINRA acts to kind of balance the risks posed to retail traders and institutional traders.
Thanks, Holden. A great question. I'm looking at someone who's spent a lot of time studying this. I think there's a lot of things that's driving increased retail participation, and no doubt a big piece of it is the technology we're just talking about has enabled it, made it so easy. I don't have my phone on me, but I'd hold it up otherwise, right? And you can do so much with your phone, and it's very engaging, and so that's probably a very important factor. But I think there are other factors as well, including things like perhaps COVID, people being at home, having time. There's a whole range of things I think might be driving it, but I think it's going to surge here and there. I think it's here to stay, though. We're seeing a lot more retail, self-directed trading in the markets, and again, this is a good thing, right? I mean, it's great that investors are focused on the opportunity to build and grow their wealth and to plan for the future. I think the thing that we want to make sure we're focused on is, are they getting the right information at the right time? And that's not always an easy thing, because what we're seeing through our research is that a lot of investors are getting their information from areas that we don't control. Traditionally, we regulate the broker-dealers, and people would have a relationship with the broker-dealer, and that's where they'd get their information about where to trade. Now there's a lot of information. People go to social media. They go to family and friends. They go to various sources to get their information that may or may not be regulated, and may or not be conflicted, and may or may not be accurate. And so I think there's a real role for investor education here, and so both looking at what's happening at that point of interaction on the digital platform, and we were talking a little about that a little bit earlier, and the need to make sure we're preserving investor protections there. But then what's happening away, and how do we make sure that investors know where to get reliable, trusted information, or at least understand the risks of relying on the first thing they might read in social media. I think those are the challenges that all of the regulatory community needs to continue to wrestle with.
Thank you. Okay. And then if I could just follow up on the GameStop situation specifically, regarding the high volume of short selling from institutional investors, and I guess the retail position was long. I think a recent movie came out, Dumb Money, kind of showed the Hollywood take on the situation, but what's your inside take on the situation?
Well, I think the meme stock phenomenon is one where thinking about how we're getting thoughtful, reliable information to investors is important, to understand that where they're getting their information, and to see if we can more proactively engage with investors to provide information in a way that or education and background in a way that they're going to be able to absorb. I think in that situation also we've seen some ways in which we could enhance disclosures, for example, around short sales. And the SEC has taken a number of steps recently to help provide more transparency around short sales. FINRA's got some things in the works to provide more transparency around short interest positions. There's a lot of interest in short selling. And one of the things we can do is help people understand, like, better, in more real time, what is the nature of the short interest in a particular stock, and also what is it? How does short selling work? And in that regard, the SEC's recent rule requiring disclosure around securities lending transactions, I think, is going to be very, very helpful in helping us all understand, including regulators, but also the markets, like where is their short interest developing, and where are, what's going on in that really important market, the securities lending market, which supports short selling. But we really don't have any integrated collective insight into what's happening in that market today. The SEC just adopted a rule and it requires FINRA to kind of collect this information. We're working hard to get that up and running, but I think that'll be very helpful for investors as well.
Thank you. I appreciate it.
Thank you.
Okay. This will be the last question over here.
How you doing, Mr. Cook? Thank you. I quickly wanted to touch on CAT again. It's great, but it's costly. I want to talk about the funding model. 1/3 buy executing side, 1/3 sell executing, and then the exchange. Can you just talk about some of the challenges that this funding model has caused?
Talk about something, make it where you can succeed in making nobody happy. CAT's going to cost money, right? And there were projections for what it would cost, and it's costing more. And why is that happening first? The volumes are so much bigger than the projections were based on. The projections were assuming 50 billion events a day. We're talking about 600 billion events a day. So it's gone up 12 times, but costs haven't gone up 12 times. But they have gone up higher than what was originally anticipated, number one. And the SROs are working really hard to manage the costs and to make sure that things are being done as efficiently as possible. But it is a big system that's going to cost money. Then who pays for it? There is an allocation regime that was approved by the SEC, and FINRA dissented from that and commented negatively on it twice. So we were disappointed that it was approved, in part because it allocates a very high percentage to FINRA, and FINRA just passes on. It's going to have to pass on all of our costs to our members because we're a non-for-profit organization. So I think some of the members have made the argument that there's 1/3 to the buyer, 1/3 to the seller, 1/3 to the SROs, but everything that goes to FINRA, which is the biggest share of the SRO, is just going to go back to the industry anyway, and that ought to be counted. But I think the SEC made their decision, and we're engaged with the other SROs to implement that. The model's been challenged in court. I don't know what's going to happen. But I would say to people in the industry that the model that was created, there's no perfect model. There's no way you're going to be able to make everyone happy again. But one of the things that was taken into account with this model was, is there a way to structure the fee to the industry that allows it to be passed on to investors? And we all knew investors are ultimately going to pay for this, right? And so the model does contemplate that if a firm gets an invoice, which they will start getting invoices, they'll be able to, if they handle it right, they could pass it along. If you're one of those firms, you should make sure you're on top of that, because it's not as easy as flipping a light switch and passing it on. You got to do disclosures, you got to do all kinds of stuff. But not unlike the Section 31 fee, which helps support the SEC's budget, that's passed on to investors, right? This is just another element of market infrastructure. So I'd say firms ought to be focused on that, and then FINRA is going to separately pass on its share to its members, which will be a smaller piece, but they're going to be getting two bills, one for the CAT LLC share and one for the FINRA share, and I don't know what the other SROs are going to do, but it's one of these things where you heard me say at the beginning, this is an incredibly important system, and we do need to manage the costs, but it needs to be paid for, and we always knew this time was coming. I just think, I want firms to recognize that time is now and be ready for it. Thank you.
Well, Robert, we're out of time, and it's as usual great to sit and have the conversation.
Yeah, thank you.
And I'm hoping you'll be back again. But on behalf of the Psaros Center in Georgetown, thank you so much for stopping by, and this is very informative. And hope to see you again soon.
Thank you.
All right.
Thank you, everybody. Appreciate it.
Thanks a lot.
We have lunch next, and lunch is on the 4th floor in something called the Fisher area. So we're going to go out on the 2nd floor and just walk up to the 4th floor. We'll be back at 1 o'clock. Thank you.
Agrawal came to me in the aftermath of the great financial crisis and explained that there was an enormous amount of proposed legislation that would have had enormous impact, not just on business finance, but rather on society.
I said Georgetown needs to step up to fill this leadership void, and Mike completely agreed, and he immediately provided seed capital to form the center.
I made the first $500,000 contribution to put the center in business, and I am in awe of the center's accomplishments over its first decade. 10 years ago was step one. This is now a major step two. My family's making this $11 million transformational gift to see the Psaros Center for Financial Markets and Policy manifest itself and reach its true potential. And hopefully I will spend the next decades working with Dr. Agrawal and the professional staff that we're going to hire here at the center, speaking the truth and speaking objectively about financial markets and policy.
And now, with this new gift from the Psaros family, we are prepared to realize the full impact of the Psaros Center as the preeminent center on markets and policies through expanded opportunities for research and scholarship, in global convenings and lectures that take advantage of our location here in Washington and the many strengths of our university.
The wonder of the Psaros Center for Financial Markets and Policy is that we can actually embrace a very complex future in finance. We're going to be able to share our understanding with business and politicians and policymakers, and we're going to be able to make a big difference to ourselves and to the world.
At Georgetown, we can do deep research. We have extraordinary faculty that we pull in from all parts of Georgetown who provide thought leadership. We are brokers between policymakers and practitioners, and our recommendations are driven by research. That is the role that the center plays. Students play a huge part at the center in terms of doing research, addressing the biggest issues, and so students have a great opportunity. What the Psaros family is providing us now, it really is going to help transform what we are doing at the center, but more broadly, Georgetown's reputation, McDonough's reputation, and the impact that we can have.
This is a perpetual endowment. This center will be here when we are not here anymore.
Mike brings so much passion and energy to this endeavor, and I can't wait to see what we can do together.
We are going to be the convener to make this country better and to make the world better. That's why the Psaros Center matters. The first time I understood the vision for the Psaros Center for Financial Markets and Policy was when my mentor, Dr. Reena Agrawal, came to me in the aftermath of the great financial crisis and explained that there was an enormous amount of proposed legislation that would have had enormous impact, not just on business finance, but rather on society.
I said Georgetown needs to step up to fill this leadership void, and Mike completely agreed, and he immediately provided seed capital to form the center.
I made the first $500,000 contribution to put the center in business, and I am in awe of the center's accomplishments over its first decade. 10 years ago was step one. This is now a major step two. My family's making this $11 million transformational gift to see the Psaros Center for Financial Markets and Policy manifest itself and reach its true potential. And hopefully I will spend the next decades working with Dr. Agrawal and the professional staff that we're going to hire here at the center, speaking the truth and speaking objectively about financial markets and policy.
And now, with this new gift from the Psaros family, we are prepared to realize the full impact of the Psaros Center as the preeminent center on markets and policies through expanded opportunities for research and scholarship, in global convenings and lectures that take advantage of our location here in Washington and the many strengths of our university.
The wonder of the Psaros Center for Financial Markets and Policy is that we can actually embrace a very complex future in finance. We're going to be able to share our understanding with business and politicians and policymakers, and we're going to be able to make a big difference to ourselves and to the world.
At Georgetown, we can do deep research. We have extraordinary faculty that we pull in from all parts of Georgetown who provide thought leadership. We are brokers between policymakers and practitioners, and our recommendations are driven by research. That is the role that the center plays. Students play a huge part at the center in terms of doing research, addressing the biggest issues, and so students have a great opportunity. What the Psaros family is providing us now, it really is going to help transform what we are doing at the center, but more broadly, Georgetown's reputation, McDonough's reputation, and the impact that we can have.
This is a perpetual endowment. This center will be here when we are not here anymore.
Mike brings so much passion and energy to this endeavor, and I can't wait to see what we can do together.
We are going to be the convener to make this country better and to make the world better. That's why the Psaros Center matters.
My name is Nadia Nassim. I am a senior in the School of Foreign Service studying global business, and I'm very interested in financial policy, risk management, figuring out what are the vulnerabilities in financial markets and how do we minimize those vulnerabilities as well. How I learned about the financial policy track is I actually saw a flyer at the Levy Center that had the description of the financial policy track and all the amazing places that they were going to. And initially, I had thought this was an annual program that had been going on for a while that I didn't know about, as it is housed in the MSB. So I decided to apply because I had been doing an internship at the FSOC at the U.S. Department of Treasury, and that is a lot of financial policy, a lot of coordinating, interagency, regulation among all the financial policy agencies in America. So I decided to apply for it because I had done this internship and I was really interested in learning more about it. And I was really happy that Georgetown was also pushing this forward as well. I think because I have a little bit of background in the financial policy sector in DC, going to Wall Street was really cool for me. Being able to sit in the morning markets meeting at JP Morgan was really cool. Just being able to see the conversations that they were having about their clients and things that were important. A lot of the things that were happening at the time were about debt ceiling issues, so how that would be affecting investment firms. Another one of the experiences that I really enjoyed was visiting the Neuberger Berman office, asking questions about things that I had learned about in class, what their perspectives was on, especially concerning ESG investment. That was really amazing. Everyone we talked to was super open to questions and super friendly, so really grateful for that. I think I definitely got opened up to what it would be like to work in the private sector facing the government. I didn't know that that was an option coming into the financial policy track. It's something that I learned about during the track, but thinking about what it would be like to be on the side of the bank or investment firm, asset management firm, whatever it is, and learn about what's going on in the government, what the Fed is thinking about, what the Treasury is thinking about, and reporting back and figuring out what the best action is to take for those firms are. I think that is really interesting. So I'm interested in both sides, but that's something that's definitely been opened up for me as well. The continued engagement has been very helpful for me to stay connected with the Psaros Center. I have been able to attend a lot of the events, the webinars that have been happening throughout the semester. The group that we went with was really great, so I've stayed connected with all the members of the financial policy track. We met up a couple of times individually and on a group basis. Everyone's been really great in connecting each other to resources and things that are happening at the Psaros Center. We're always making sure that we're always trying to go to the same events so we can see each other. It's been a really great community that I've been able to build with the Psaros Center. So really happy about that.
Hi, I'm Will Burke, and I'm majoring in finance and international business. I first learned about the financial policy track when seeing a flyer around campus, and it clearly stuck out to me that this was kind of a unique experience that I couldn't get anywhere else on campus in terms of the ability to meet both people from the government side in DC and then the private sector of New York. So combining those two interests for me were truly unique. I personally was looking for an experience to kind of gauge my two interests in both the international sector of public policy and international business, and combining that with finance in the private sector to kind of figure out what roles there are at an intermediary level where you can combine these two interests to get both that international knowledge and combining that interest with the finance side of things. So I think this experience truly kind of opened up new experiences for me in terms of roles that people have been very successful in both DC and New York, to be able to combine those two interests of the international markets and the U.S. markets. One experience that really stuck out to me from the financial policy track was the dinner that we had with multiple officials in the government offices of key financial services firms such as Morgan Stanley and JP Morgan. And I was given the unique experience to be at a table with a Morgan Stanley official in their government relations office, where she mentioned that her interest in both financial policy and the international world combined through this role that she now serves in the private side, but working in a government role. So she's able to combine those two interests. And I was really able to relate to that experience from her coming out of university. For her, she'd always been very interested in all things happening in the world, but also wanted to use her strengths in numbers and finance to find a role that kind of meets those two. So for me, this kind of opened my eyes to a new role that I hadn't so much thought about as to the government side of these private firms. So I was really able to look into this more and continue my conversations with her privately through email. And she's really been a helpful resource in terms of expanding my eyes into this new opportunity. I think for me, I had a unique experience where I was very early in my career aspirations in terms of trying to figure everything out in just the end of freshman year. So now being a sophomore, I think I was really influenced by the fin policy track to use more of that policy side. And I was able to see roles where I can really incorporate that policy side into a financial interest, which I wasn't as knowledgeable about. I thought that you kind of had to pick one side of the thing, whether it be serving on the Hill in DC or just going to the financial side of New York. And I think this financial policy track really found that middle ground that I was looking for. So I'll be forever grateful for that. I've been able to stay in touch with a lot of members of the financial policy track and the officers in the Psaros Center to continue this interest that I have. And because I have so many years left at Georgetown, I have a lot of ability to continue that interest in this unique new part of the business school where we have this combination between public policy and finance. And I think that is a relationship that I definitely want to continue and is going to be really helpful in terms of my career aspirations. So this new Psaros Center has really been able to open my eyes to the opportunities that Georgetown students have here on campus and with the resources that we have off campus in terms of connecting them with alumni and other people that have similar career goals.
Hi, I'm Kelly Grace. I'm a junior in the MSB, double majoring in finance and management. I also have a minor in government, and I'm really interested in the intersection of government and finance, specifically as it relates to fintech, blockchain, cybersecurity. I attended the Psaros Center's first event in January 2023. From there, I got on the mailing list, and they sent several emails in March and April about the fin policy track, and I got really excited, so I applied through the newsletter. I think one of my favorite memories from the fin policy track was when we were at the morning meeting for JP Morgan. We got to sit in, see the behind the scenes morning meeting that was streamed to every single office of JPM. And then we got a chance to ask some questions about the presentation and how it related to the current events that were happening in the market. So it was really cool to see how they interrelated the private and public sectors within the morning meeting every single day. The trip and engaging with the Psaros Center has really inspired me to continue interacting with the key stakeholders from both the public and the private sectors throughout my post-grad career. So I'm starting in investment banking, and I'm really hoping to interact with government officials in terms of trying to see the new policies that may affect investment decisions. And the Psaros Center also has inspired me to go after an MBA and a master's in public policy at the same time in my future career line. I'm really excited about that. So I'm staying engaged by doing the bi-weekly lunches that the Psaros Center is hosting for a lot of business students here at Georgetown. And that's been great just to give back and talk about my experience with the fin policy track and talk with a lot of like-minded students. I'm also helping with the FMQ that's being hosted in November and helping with the speakers and lists and ushering. Excited for the conference.
My first engagement with the Psaros Center for Financial Markets and Policy was the undergraduate stock pitch competition. I was really excited about this opportunity to learn more about financial investing and the opportunity to have that experience presenting a stock pitch to a panel of experts. After participating in that competition, I then learned about the opportunity that the Psaros Center was hosting with the fin policy trek, and being interested in finance as well as its connection to the government, to regulation, and to policy making. I thought that that was a very fascinating opportunity, something very unique to Georgetown. I was really excited to hear that there would be an opportunity to really maximize Georgetown resources as well as the Psaros Center for Financial Markets and Policy. So upon hearing about the fin policy trek while at the stock pitch competition, it was something I definitely wanted to keep on my radar since I found it so interesting. And then when the time came to apply, I made sure that I had my name in the running, and I was so grateful to have had the opportunity to go on that trip. And I really found it as such an incredible and meaningful learning experience. Going to New York was also a fantastic experience, getting to learn from market participants in a wide variety of areas within finance. I really enjoyed that well-rounded perspective on the financial services industry. Some experiences from the Fin Policy Trek that were particularly meaningful for me. One of them I found was our dinner conversation with a representative from Churchill Asset Management, and we got to learn about the private credit space, which is something that was very new to me. So being able to learn about this industry that is becoming so much more prevalent given the financial tailwinds that we're looking towards, I really found that conversation to be super fascinating. I also just appreciate the career advice that we were able to receive, and just insights on being a leader in the financial industry is something that I found super valuable. Some other experiences from the Fin Policy Trek that I found as particularly meaningful was our time in the CFTC. The CFTC was something that I had relatively little exposure to. I was really appreciative of that learning opportunity to learn about an organization that oversees such an important area of our country's and the world's financial markets. And I'm so glad that I got that exposure to, once again, an industry that I may not have had as much exposure to otherwise. It was also so wonderful to meet such kind and caring leaders who care deeply about us, and were just excited to really pour their all into their conversations with us and teach us about ways to approach our professional lives. Working with the Psaros Center for Financial Markets and Policy has impacted my career aspirations and my endeavors within the business school. I would say that in one respect, it has certainly opened my perspective. There are so many lanes and areas to explore. And so I definitely look forward to, as I go throughout my career, being able to gain expertise in a variety of subjects relating to the financial markets. I believe that my work with the Psaros Center has furthered my interest in ensuring that my work in the financial services industry someday remains closely connected to the government and policy side of the equation. And it's clear, especially in the work that I've done with the Psaros Center, that the two industries are very much closely connected. I'm just so grateful for what the Psaros Center has provided me as far as educational opportunities as both a student and a professional.
My name's Siona. I'm a sophomore in the college studying political economy with a minor in statistics. And I first got interested through financial policy from the policy aspect as a political economy major. But after Fin Policy Trek and interacting with the Psaros Center, I've learned a lot more about the finance side of things. I first got involved with the financial policy trek through a poster in the ICC. I decided to apply on the whim because I was interested in policy and econ, and it was probably one of the best decisions I've made since coming to Georgetown. The opportunities we had was visiting the CFTC, and we got to hear from Chair Behnam, who's a Hoya. That experience was so invaluable, and it was something I would have never been able to do without the Fin Policy Trek. I always knew I was interested in policy, but after going on the Fin Policy Trek, I've really narrowed that interest into financial policy and economics. After hearing from people at the Department of Treasury, CFTC, SEC, I've realized those parts of governments are the ones I want to pursue. I've continued to be involved. There are bi-weekly dinners with the Psaros Center that we attend. This week, we spoke with Ernie Tedishi, who is the chief economist at the Council of Economic Advisors for the White House. It was an amazing opportunity, and I learned so much, and I gained a lot out of those dinners.
My name is Pavlos Tintomas. I was born in Montreal, Canada, and I'm a sophomore at the McDonough School of Business, majoring in finance. I'm very passionate about finance, especially, increasing financial literacy. The first time I really heard of the Psaros Center was during last year's FMQ. I attended with my dad, actually. He came in because he thought it would be a really interesting event as well. And that's actually where I met Dr. Agarwal for the first time, and Mike Psaros as well. They were just so friendly, and they were really excited just to have us there. That personal aspect really stood out. And then just the quality of the speakers and the quality of the event was just exceptional. From that moment, I knew that the Psaros Center was truly something special, and that it was something I wanted to learn more about and potentially get involved with. That really escalated when the FinPolicy Trek was announced. And from there, I was fortunate enough to be accepted, and it was truly an exceptional experience. The FinPolicy Trek was truly packed with many incredible meetings and experiences. And I have to say that I did not think that I'd be able to experience so many different things in such an early point in my undergraduate career. Being able to walk into the Capitol, sit in the meeting rooms, going to visit Neuberger Berman or Morgan Stanley and sit in their incredible conference rooms and listen to some really incredibly successful people. I just didn't think I'd be able to experience that so early on. The whole trip was truly just one bucket list item ticked off after another. It was really incredible. My favorite memory personally was our meeting with Neuberger Berman. Just the way they welcomed us in with these packets, outlining the current state of the markets on their conference table, and offering us snacks and everything. It was just so professional, and we felt truly welcomed. For me, that was, such a testament to the Georgetown Alumni Network. The fact that these people were truly excited to have us there. I was definitely excited to find any way to stay involved with the Psaros Center following the event. I was actually fortunate enough to be granted a position as a student assistant with the center. So I've been helping out with researching for our upcoming webinars, finding potential speakers that might want to join us as well. And that's been a very informative experience. And I'm hoping that it will continue to develop potentially into some form of formal research paper with faculty here at Georgetown. I would not have experienced had it not been for my continued involvement with the Psaros Center and all of the incredible resources that they have for students, clearly of all ages. I'm working with another student who was on the trek with us as well. Not only from an experiential standpoint has this been incredible, but I still get to keep in touch with all the great people that I met along the way. I'm really happy to stay involved with the center. In terms of how the FinPolicy Trek has changed or shaped my outlook on what I potentially want to do post-college, I have to say that it has definitely shed light on the corporate culture of different firms that we visited. And I've definitely gained a better idea of what kind of experience I want in finance, especially with the firms that are out there. Above that, I have to say, I think everyone at this point is just talking about either consulting or investment banking. But one thing in particular that I've always been really curious about has been private equity. And although this isn't specifically with the FinPolicy Trek, but it was a leading point to this. My current involvement with the Psaros Center has me researching private equity regulation. So although the FinPolicy Trek was an indirect cause of me being able to explore this and, potentially seeing a future in private equity, I've been able to hone into the things that I'm really passionate about. I think that just the involvement with the Psaros Center has definitely overall helped guide me into the right direction.
I'm Alexander Yu. I'm a senior at Georgetown University in the business school, majoring in finance and international business. And in terms of how I got involved in the financial policy trek, I sort of found an email in my inbox about the program and I just decided to apply to it. And it was overall a really good experience. For reference, I'm interested in the private sector, having this exposure, this opportunity to explore these opportunities within the public sector right here in DC was just an amazing opportunity. The most significant highlight of this trip for me was the fact that we were able to explore so many different places during the 3 or 4 day trip that we had. It was really interesting to go from DC to New York and explore and meet with all these people across not only the leading firms within the private sector, but also prominent policymakers within DC. It was really great to see the two sides of the same coin. as it relates to financial markets and the overall economy. After graduation, I have plans to go into investment banking in New York, but the Fin policy track really allowed me to see what's on the other side of the table in the public sector, which I normally would not have the opportunity to see. And I guess I'm really appreciative of that unique opportunity that the Psaros Center offered during this trip. So after the Fin policy track, I found myself attending more of the Psaros Center events, whether it be the Friday lunch and learns or the Thursday dinners that the center hosts, where we meet with experts across the industry and within in the public sector. These really good opportunities keep engaged and in touch with everyone that I met during the program. Everyone was amazing, and it was just a great opportunity to sort of explore different parts of financial markets that I otherwise would not have the opportunity to.
Hello, my name's Maxwell Basson. I'm a junior studying business and global affairs, which is a dual degree between the business school and SFS. And I completed the Fin policy track last semester. I got involved with the Fin policy track because I think I ended up just getting an email from the MSB. It was an email talking about the Fin policy track, what the visits are, and it kind of proposed it as basically you get to go to New York with a bunch of other Georgetown students and visit a bunch of other cool places. So I was instantly attracted to it, and I did some more research, and then I ended up submitting the application. And I think the main reason that I decided to apply was because I wanted to kind of learn about finance and see if it was for me without maybe, taking semester-long classes in finance or doing a finance internship. So I thought this was a good way to get exposed to finance in kind of a 1-week way, almost like a crash course in finance, and get to talk to some of the top executives to see if it's something for me and something that's appealing. I think my most memorable moment was our visit to the CFTC, or the Commodities and Futures Trading Commission. And I think that was most memorable for me was because it wasn't really a visit that I had thought about that much beforehand, or even I didn't really know that much about the CFTC. It was really cool we got there because almost everything we was learning about was kind of a surprise for me. It was new information. And it's one of those organizations that I don't think I would have known a lot about without this visit or even just deciding to do this trip. So that was really cool. And I think also the visit itself was just incredible. We got to talk to some high-up commissioners from the CFTC. They shared not only their experience at the CFTC, but also some life advice that they had that you could really take whichever field you want to go into. I think that was pretty cool. And it was kind of a topic that I never learned about before, and how they regulate crypto markets, futures, and all those things. So that was really cool. So I think it definitely has influenced my career track. It was interesting because for the first half of the week, we did most of the policy side. So we were visiting places in DC. And then the second half of the week, we got the finance side. So it was almost like a comparison between the public sector and the private sector. And I think I realized by the end of the week that, at least out of college, I want to work in the private sector just because it moves a lot faster. And I think there's more innovation in places where I can find myself making important decisions in the private sector. So that was kind of a big realization for me when I think about my career trajectory, at least in the short run. I think I realized I don't want to go directly into finance or investment banking right out of college. And that's something maybe I want to pick up later. One thing that I realized throughout the trip was that finance is very numbers heavy, and I kind of wanted to do something that I could work with tangibly and maybe more social science related. But that was a really important realization for me. And I think without this trip, that's something that I wouldn't have realized. And then also maybe in the future doing something finance adjacent, because it really does impact everything. So I've definitely tried my best to stay involved with the Psaros Center because it really is such a great resource. It's been a little bit difficult because I haven't been able to attend the events in person as I've been on study abroad, but I've kept in close contact. Really, this trip also helped me get a lot closer with some of the professors in the MSB who helped organize the trip and who I gave feedback to about the trip. So that was one big way that I've been staying engaged, is keep talking to the professors who are involved. And definitely in the spring, when I'm back on campus, I'm looking forward to attending a lot of the in-person events that the Psaros Centers has.
The first time I understood the vision for the Psaros Center for Financial Markets and Policy was when my mentor, Dr. Reena Agrawal, came to me in the aftermath of the great financial crisis and explained that there was an enormous amount of proposed legislation.
My name is Holden Zarega. I'm a finance and international business regional studies major in the business school. I'm from Norwalk, Connecticut, and I was drawn to this program because of my interests in financial markets, specifically investing. First heard about the financial markets and policy trek was through LinkedIn, and I was really impressed by the itinerary. I saw that it was a week long, which was quite extensive, and I was not aware at the time of any other program that was similar in the extent of the in-depth, in-person experiences that it offered. I was drawn to the opportunity to travel to these profound locations and talk to really smart, motivated people on subjects that were near and dear to their hearts. The program was split half between policy here in DC and the private sector in New York City, and I really liked the duality of the trip in that sense. As someone who is more knowledgeable about private markets, I thought it would be a tremendous opportunity to learn more about the public sector. There were many moments that left a lasting impression. If I were to speak to a couple, I would say the opportunity to speak with senior members of Neuberger Berman in their corporate office was super impactful in that I gained a perspective on how institutional money managers and capital allocators thought about the various economic, political things occurring every day. I thought that opportunity was super cool and extremely informative. Another one I'll speak to is we had a chat with a senior member of Churchill Asset Management. He's actually a former Hoya, and he spoke about how he leveraged his unique educational insights from Georgetown to kind of branch out into a new market that was severely underserved, which was private credit. I thought this experience was unique in that as a Hoya, he shared many personal experiences that us as Hoyas could relate to and find encouragement from. I think my participation in the FinTrek trip was extremely helpful in allowing me to better evaluate the professional opportunities. I can better estimate which career paths and specific positions are best aligned with my strong suits, my interests. I think one of the things that this trip enabled students to obtain was diverse exposure to a range of different career paths. Additionally, of course, the trip helped me to learn new things. I mean, these students that accompanied me on the trip asked a range of really smart, probing questions. So I was constantly learning on the trip, and having completed it, I can say that I walked away a smarter, more knowledgeable person. The Psaros Center has done an excellent job of maintaining opportunities for the trip's participants to stay engaged and continue learning about the intersection of financial markets and policy. I've been lucky enough to attend several additional dinners. The Psaros Center actually hosts biweekly luncheons, which are another great opportunity to connect with the trip's alumnus and remain engaged. They've hosted luncheons with people in policy and in the private sector, enabling us as students to maintain an understanding of what's going on right now. What are the things that these economists, these capital allocators, these regulators are thinking about as they occur? Actually, just last night, I was at a dinner with Ernie Tedeschi, the chief economist at the Council for Economic Advisors. Having the opportunity to listen to Ernie speak about how he approached the economy was extremely enlightening. Having the opportunity to maintain access to these really smart, really motivated individuals who are leaders in their careers is not to be taken for granted.
My name's Siona. I'm a sophomore in the college studying political economy with a minor in statistics. And I first got interested through financial policy from the policy aspect as a political economy major. But after Fin Policy Trek and interacting with the Psaros, I learned a lot more about the finance side of things. I first got involved with the financial policy trek through a poster in the ICC. I decided to apply on the whim because I was interested in policy and econ, and it was probably one of the best decisions I've made since coming to Georgetown. The opportunities we had was visiting the CFTC, and we got to hear from Chair Behnam, who's a Hoya. That experience was so invaluable, and it was something I would have never been able to do without the Fin Policy Trek. I always knew I was interested in policy, but after going on the Fin Policy Trek, I've really narrowed that interest into financial policy and economics. After hearing from people at the Department of Treasury, CFTC, SEC, I've realized those parts of governments are the ones I want to pursue. I've continued to be involved. There are bi-weekly dinners with the Psaros Center that we attend. This week, we spoke with Ernie Tedishi, who is the chief economist at the Council of Economic Advisors for the White House. It was an amazing opportunity, and I learned so much, and I gained a lot out of those dinners.
Hello, my name's Maxwell Bassin. I'm a junior studying business and global affairs, which is a dual degree between the business school and SFS. And I completed the Fin Policy Trek last semester. I got involved with the Fin Policy Trek because I think I ended up just getting an email from the MSB. It was an email talking about the Fin Policy Trek, what the visits are, and it kind of proposed it as basically you get to go to New York with a bunch of other Georgetown students and visit a bunch of other cool places. So I was instantly attracted to it, and I did some more research, and then I ended up submitting the application. And I think the main reason that I decided to apply was because I wanted to kind of learn about finance and see if it was for me without maybe, taking semester-long classes in finance or doing a finance internship. So I thought this was a good way to get exposed to finance in kind of a 1-week way, almost like a crash course in finance, and get to talk to some of the top executives to see if it's something for me and something that's appealing. I think my most memorable moment was our visit to the CFTC, or the Commodities and Futures Trading Commission. And I think that was most memorable for me was because it wasn't really a visit that I had thought about that much beforehand, or even I didn't really know that much about the CFTC. It was really cool we got there because almost everything we was learning about was kind of a surprise for me. It was new information. And it's one of those organizations that I don't think I would have known a lot about without this visit or even just deciding to do this trip. So that was really cool. And I think also the visit itself was just incredible. We got to talk to some high-up commissioners from the CFTC. They shared not only their experience at the CFTC, but also some life advice that they had that you could really take whichever field you want to go into. I think that was pretty cool. And it was kind of a topic that I never learned about before, and how they regulate crypto markets, futures, and all those things. So that was really cool. So I think it definitely has influenced my career track. It was interesting because for the first half of the week, we did most of the policy side. So we were visiting places in DC. And then the second half of the week, we got the finance side. So it was almost like a comparison between the public sector and the private sector. And I think I realized by the end of the week that, at least out of college, I want to work in the private sector just because it moves a lot faster. And I think there's more innovation in places where I can find myself making important decisions in the private sector. So that was kind of a big realization for me when I think about my career trajectory, at least in the short run. I think I realized I don't want to go directly into finance or investment banking right out of college. And that's something maybe I want to pick up later. One thing that I realized throughout the trip was that finance is very numbers heavy, and I kind of wanted to do something that I could work with tangibly and maybe more social science related. But that was a really important realization for me. And I think without this trip, that's something that I wouldn't have realized. And then also maybe in the future doing something finance adjacent, because it really does impact everything. So I've definitely tried my best to stay involved with the Psaros Center because it really is such a great resource. It's been a little bit difficult because I haven't been able to attend the events in person as I've been on study abroad, but I've kept in close contact. Really, this trip also helped me get a lot closer with some of the professors in the MSB who helped organize the trip and who I gave feedback to about the trip. So that was one big way that I've been staying engaged, is keep talking to the professors who are involved. And definitely in the spring, when I'm back on campus, I'm looking forward to attending a lot of the in-person events that the Psaros Center has.
Hi, I'm Kelly Grace. I'm a junior in the MSB, double majoring in finance and management. I also have a minor in government, and I'm really interested in the intersection of government and finance, specifically as it relates to fintech, blockchain, cybersecurity. I attended the Psaros Center's first event in January 2023. From there, I got on the mailing list, and they sent several emails in March and April about the Fin Policy Track, and I got really excited, so I applied through the newsletter. I think one of my favorite memories from the Fin Policy Track was when we were at the morning meeting for JP Morgan. We got to sit in, see the behind-the-scenes morning meeting that was streamed to every single office of JPM, and then we got a chance to ask some questions about the presentation and how it related to the current events that were happening in the market. So it was really cool to see how they interrelated the private and public sectors within the morning meeting every single day. The trip and engaging with the Psaros Center has really inspired me to continue interacting with the key stakeholders from both the public and the private sectors throughout my post-grad career. So I'm starting in investment banking, and I'm really hoping to interact with government officials in terms of trying to see the new policies that may affect investment decisions. And the Psaros Center also has inspired me to go after an MBA and a master's in public policy at the same time in my future career line. I'm really excited about that. So I'm staying engaged by doing the bi-weekly lunches that the Psaros Center is hosting for a lot of business students here at Georgetown. And that's been great just to give back and talk about my experience with the Fin Policy Track and talk with a lot of like-minded students. I'm also helping with the FMQ that's being hosted in November and helping with the speakers and lists and ushering. Excited for the conference.
My first engagement with the Psaros Center for Financial Markets and Policy was the undergraduate stock pitch competition. I was really excited about this opportunity to learn more about financial investing and the opportunity to have that experience presenting a stock pitch to a panel of experts. After participating in that competition, I then learned about the opportunity that the Psaros Center was hosting with the Fin Policy Trek, and being interested in finance as well as its connection to the government, to regulation, and to policy making. I thought that that was a very fascinating opportunity, something very unique to Georgetown. I was really excited to hear that there would be an opportunity to really maximize Georgetown the Psaros Center for Financial Markets and Policy. So upon hearing about the Fin Policy Track while at the stock pitch competition, it was something I definitely wanted to keep on my radar since I found it so interesting. And then when the time came to apply, I made sure that I had my name in the running, and I was so grateful to have had the opportunity to go on that trip. And I really found it as such an incredible and meaningful learning experience. Going to New York was also a fantastic experience, getting to learn from market participants in a wide variety of areas within finance. I really enjoyed that well-rounded perspective on the financial services industry. Some experiences from the Fin Policy Trek that were particularly meaningful for me. One of them I found was our dinner conversation with a representative from Churchill asset management, and we got to learn about the private credit space, which is something that was very new to me. So being able to learn about this industry that is becoming so much more prevalent given the financial tailwinds that we're looking towards, I really found that conversation to be super fascinating. I also just appreciate the career advice that we were able to receive, and just insights on being a leader in the financial industry is something that I found super valuable. Some other experiences from the Fin Policy Trek that I found as particularly meaningful was our time in the CFTC. The CFTC was something that I had relatively little exposure to. I was really appreciative of that learning opportunity to learn about an organization that oversees such an important area of our country's and the world's financial markets. And I'm so glad that I got that exposure to, once again, an industry that I may not have had as much exposure to otherwise. It was also so wonderful to meet such kind and caring leaders who care deeply about us and were just excited to really pour their all into their conversations with us and teach us about ways to approach our professional lives. Working with the Psaros Center for Financial Markets and Policy has impacted my career aspirations and my endeavors within the business school. I would say that in one respect, it has certainly opened my perspective. There are so many lanes and areas to explore. And so I definitely look forward to, as I go throughout my career, being able to gain expertise in a variety of subjects relating to the financial markets. I believe that my work with the Psaros Center has furthered my interest in ensuring that my work in the financial services industry someday remains closely connected to the government and policy side of the equation. And it's clear, especially in the work that I've done with the Psaros Center, that the two industries are very much closely connected. I'm just so grateful for what the Psaros Center has provided me as far as educational opportunities, as both a student and a professional.
Please come on in and settle down, and we'll get started. So it's a real pleasure to introduce David Schwimmer, CEO of the London Stock Exchange Group and a member of the board of the group. David joined the London Stock Exchange Group in 2018 after having spent 20 years at Goldman Sachs in a number of different senior roles, most recently as Global Head of Market Structure and Global Head of Metals and Mining. David also served as Chief of Staff to Lloyd Blankfein, then President and CEO of Goldman. And he spent 3 years in Russia as co-head of Russia's CIS. Before that, David practiced law at Davis Polk and Wardwell. He holds a BA from Yale University and postgraduate degrees in law and international affairs from Harvard University and the Fletcher School of Law. David, we are absolutely delighted to welcome you back to the Financial Markets Quality Conference at the Georgetown Psaros Center for Financial Markets and Policy. We're going to start with some remarks by David, and then we'll do a little Q&A, and then we'll open it up to questions. David.
Rena, thank you very much for the introduction. Thank you for having me. And it is great to be back at the Psaros Center, and it's great to see Mike here in the audience. Thank you for making today's event possible. As I look back on the last few years, it's clear that it has been a challenging time for financial markets and the world. The pandemic, war in the Middle East, war in Europe, concerns about inflation and the cost of living, threats to democracy. But it's in these moments of uncertainty that the work of great institutions like the Psaros Center proves invaluable. Bringing together market participants and policymakers, bridging the gap between practice and policy, engaging with, informing, and learning from the next generation. These are all vital endeavors that help to safeguard the health of our financial markets, especially in today's environment. We're experiencing a number of paradigm shifts in very short order. Some of these are genuinely new for the world, like dealing with dramatic technological advancements and addressing the challenge of climate change. Other shifts, like the changes in monetary policy and geopolitics, while very challenging, are in many ways a return to normal. To be clear, normal doesn't mean the past 20 years. The extraordinary support from central banks over the last 15 to 20 years has not been normal. The negative interest rates we've seen in many markets have not been normal. But if you look back to the 1990s and before, the interest rates we're seeing today are not unusual. A mortgage rate of 5 or 7% was not cause for shock and alarm. In terms of the geopolitical landscape, for the last 20 years, we have benefited from a historically unusual alignment in favor of globalization and economic cooperation among countries that were historically rivals or even enemies. Today, we're seeing a breakdown in that alignment, geopolitical fragmentation, and a return to what I suggest are more historically normal tensions. And at the same time, we're seeing shifting paradigms in technology. AI is transforming the world that we live in. In this environment, at LSEG, we don't try to predict the future, but we do a lot of scenario planning, and we try to prepare for whatever may come. This has been a necessity. LSEG today is much more than our stock exchange in London. We are a leading global provider of financial markets infrastructure, data, and analytics. We're the world's #1 real-time data business, the leading global provider of Know Your Customer and anti-money laundering background check information, a leading index provider, and our clearinghouse is super systemic, helping banks and their clients all over the world hedging their risk. And while we are headquartered in London, we operate in every major financial center with 23,000 people serving 45,000 customers in 190 markets. So we're very focused on enhancing the efficiency and resilience of the world's financial markets. And there are a few key trends that we have been looking at very closely. The rise of AI, the fragmentation of the digital economy, and the growth of private markets. Each poses potential risks, but if we approach each of these issues the right way, we can address challenges, seize opportunities, and strengthen global markets. So let's start with the topic that is getting an enormous amount of attention these days, AI. We've seen fast-moving advances in this space over the last year, especially with regard to generative AI. And while we have been using AI and machine learning in our business for a while, generative AI is leading to a step change in the financial world. We're building AI functionality into our platforms and workflow to enhance customer productivity, creating more valuable insights through proprietary analytics. And we can use the vast amount of data that we ingest and manage to inform and prompt or train large language models for targeted use cases in our sector. It's great to see the progress being made with this technology, but as we are building AI-powered solutions, we're also thinking about the risks that AI poses in our industry. AI hallucination, or the idea that AI may perceive non-existent patterns and produce inaccurate outputs, raises very serious questions for financial services. AI can enable you to make the same mistakes you would have made before, but with even greater confidence. LLMs built on questionable or inaccurate data sourced from the internet are not good enough. Our industry relies on pinpoint accuracy. If I were to tell our customers that our data and analytics were 95% accurate, that's simply not good enough. So we're very focused on using AI responsibly. Specifically, we're focused on meeting two key conditions in the use of AI. One, we are ensuring the quality of our data, cleaning and codifying it to be accurate and reliable, and drawing on our decades of experience in data management to ensure that it is internally consistent. Two, we're ensuring the integrity and lineage of our model inputs. We're building auditability into our AI-enabled products so that our customers can easily verify the source of information. Meeting these conditions is critical for the responsible use of AI and will be central to our approach as we leverage the depth and breadth of our data to meet our customers' needs. The second trend that we've been watching carefully, and frankly with concern, is the increasing focus on data sovereignty and the challenges to free flows of data across borders. Many of you are familiar with how the current geopolitical climate has put the open global economy at risk. But this is especially true when it comes to the digital economy. Governments around the world are asserting greater data sovereignty through laws and regulations that are threatening to fragment the world's open data ecosystem. And this could have a very negative effect. The digital economy drives innovation, empowering businesses and communities to create solutions for society's greatest challenges. Cross-border data flows already underpin how we all live and work, from booking hotel rooms and flights to tackling cyber and financial crime. And they facilitate the orderly and efficient operation of financial markets, including our global trading platforms. So the fragmentation that we are seeing is no small threat. Data localization, which requires the storage and processing of data inside the country of collection, is already undermining efforts to enhance international data flows. And estimates show such data flow restrictions could lower the GDP of some countries by 0.5% up to 2%. It doesn't have to be this way. Governments can and must come together to advance international cooperation and trust on digital governance issues. We should have a coordinated global effort to ensure that cross-border data flows can be used safely to drive innovation and growth. Some countries are leading the way on this with bilateral agreements, such as the US-UK Data Bridge. But we need multilateral versions of these, perhaps starting among relatively like-minded groups like the G7. The third major trend that we've been looking at has been the growth of private markets that was brought about by 2 decades of abnormally low interest rates. Cheap capital has pushed the total AUM of private markets to a gargantuan $11 trillion. And as the interest rate cycle shifts and capital becomes more expensive, there is change coming to this opaque, illiquid, and occasionally highly leveraged part of the markets. At LSEG, we've been looking at a few options to bring more transparency and liquidity to this space. And we're now creating the world's first regulated crossover market. Our intermittent trading venue will allow private companies to periodically provide new and existing shareholders with the opportunity to transact through the controlled and efficient mechanism of a stock exchange auction and public trading functionality. So under this construct, a private company can notify the market on what date it will be available for public trading. It will put out a disclosure document in advance of that date. For the designated window, it will be effectively traded using public market infrastructure. And then it will go back to being a private company. It can choose to return to this mechanism periodically after that. This will create more of a continuum between private and public companies. It will help early-stage investors recycle their capital. Employees realize the value of their shares, and companies reduce the costs of providing shareholders with liquidity. And it will give investors access to a broader universe of companies. So, responsible use of AI in financial markets, free flow of data across borders, and facilitating liquidity in the private markets. These are 3 areas where LSEG is driving change in the markets. The world is in a difficult period economically and geopolitically. As stakeholders in the world's financial markets, we must work together to overcome potential challenges and continue to innovate and improve, making markets better, more flexible, and more resilient so that they can succeed in their critical role as efficient allocators of capital. By adopting a global mindset and relying on transparency and trust, we at LSEG are doing what we can to ensure that our financial system is robust, secure, and competitive, and ready to take on whatever tomorrow brings. Thank you.
Okay. Thank you, David, for those remarks. So just sort of following up on some of the things you talked about, I've been involved with FTSE Russell for a long time now, having served on your academic advisory committee. And it's fascinating to see how LSEG has transformed under your leadership in the last 5 years, right? You were about 5,000 employees at that time. Now you have 20,000 employees. And so let me start by asking, and you, as you said, you have 45,000 clients, if I got that right, and around 190 countries. So in this world with all the geopolitics and uncertainty, how are you managing? Where are your people? How are you managing that?
So, again, thank you, Rina, for having me here. It's great to be here. We are all over the world. We are a global business, and that's part of our value proposition to our customers. But it is also part of the risk that we manage as a company. Over half of our people are in Asia, actually. And we do feel all of the geopolitical events that are happening. So we have about 1,500 people in Sri Lanka. Sri Lanka has had a tough stretch over the last couple of years with economic crisis. We have people in Ukraine. We still have people in Ukraine today who continue to work and are doing a terrific job for us. We have about 100 people in Israel. We have people all around the region in Jordan and Egypt and Lebanon. So it's important to us to be global. It's important to our customers that we're global. But it is also something that we manage as a company. In other words, we have to think about and be focused on operational resilience in everything that we do because we are systemic market infrastructure and our customers rely on us to conduct their daily business. So we do a lot of scenario planning. We have a lot of backup plans. We have a lot of redundancy built into our systems. And it works. It's not always easy, but it's built into our DNA in terms of how we try to operate.
So what exactly does LSEG do? It's fascinating to watch how exchanges around the world, including ICE and New York and NASDAQ, and you have transformed. So what are your major lines of business now?
So it is always surprising for people when I tell them. We're known, of course, for being the London Stock Exchange, and it's a great part of the business. It's a great part of our heritage. It's been around for 300 years as a driver of innovation for those 300 years, and it continues to be. It's also a great business. It's 3% of our revenues. So what do? We have data and analytics as the biggest part of our business. And all in our different data businesses and analytics businesses, including the FTSE Russell Index business, including our what we call risk intelligence. So we're the provider of probably the leading content set for background checks and anti-money laundering checks called World Check. Put all those together, that's about 70% of our revenue. And then we have, in addition to equity trading on the stock exchange, we have the leading execution venues for foreign exchange trading. And we also are the controlling shareholder. We have majority stake in a business called Tradeweb, which is probably the leading fixed income electronic execution venue based in New York. It's a public company in its own right. And then, so our data and analytics, our capital markets execution venues. Then we have a post-trade business, post-trade division, which is mostly London Clearinghouse, LCH, which is one of the world's most systemic institutions, where we provide clearing in a number of different asset classes, but most prominently interest rate swaps, which are the largest traded derivative asset class. And that we're regulated in 21 jurisdictions, serving banks all over the world. We're the largest counterparty for most banks because of the clearinghouse. So those are the big legs of the stool, if I can describe it that way.
So just picking up, you're operating in so many countries. Here we are, the Georgetown Psaros Center for Financial Markets and Policy. How do you manage around all these regulations around the world? Every country seems to have different rules and regulations. How does your organization manage that?
So it's really interesting. From our perspective, we view being regulated and dealing with regulators as a core competency. And it's really important to us, and it's something that I would almost describe as a secret weapon, because we work closely with regulators. We take great pride in having good relationships with regulators. I know there are lots of industries or institutions that are either wary of regulation or actually hostile to regulation. That's not our approach. And we work closely with regulators and really try to be helpful and try to contribute and try to help shape the dialogue where appropriate, provide data, information where appropriate. And I think it's an important part of our value proposition to our customers in that a lot of the content that we bring, a lot of the subject matter expertise that we have, and a lot of the products that we create and offer help them deal with the regulatory environment. So just to give one example, Fundamental Review of the Trading Book, FRTB, viewed as a fairly onerous regulatory requirement for basically, for those of you not familiar with it, it basically means that the more opaque the positions you have on your bank balance sheet, the more capital you have to hold against those positions. And what we have done is pulled together data from different parts of our business, including Tradeweb, including YieldBook, our fixed income analytics, and including LCH, where we have curve data on a lot of very opaque over-the-counter derivatives, to provide a very high quality, unusual product that allows banks to get much greater information and transparency about how to price certain parts of their balance sheet, and therefore hold less capital against those positions and be much more efficient.
Wow.
So that's just an example.
That's fascinating. So you're monetizing data in very unique, value-added ways, right?
In a way that that helps our customers deal with regulation
Right.
in a constructive way.
Right. Yeah. Yeah. I was fascinated listening to you about the private markets and what you're doing there. That's so novel and unique. Are there any regulatory issues there?
Yes.
Tons of them, right?
Yes,
Yeah.
absolutely. So we're ready to go. We're ready to launch that, and we are. I say this politely. We are waiting for regulatory approval from the FCA, and they're working diligently to get that for us. So once we have that regulatory approval, we will launch that capability. So the use of the public market trading infrastructure is something that we have to obviously be very, very careful about and be thoughtful about who gets access to that. So do we make it open to all of the markets? Do we make it open to what here are referred to as accredited investors? So we're just working through that from a regulatory
And initially, this is going to be just for private companies in your part of the world, or is this going to be global? Or
Well, the aspiration is to make it accessible to private companies all over the world. We may have an initial stage where there has to be some nexus with the UK, but we'll see how that plays out from a regulatory perspective.
Okay, fantastic. You've done a number of acquisitions in the last few years. You've come up with partnerships. I'm curious to hear a little bit about the Microsoft partnership.
So we announced in December of last year that a long-term strategic partnership with Microsoft. And as part of that, Microsoft took a 4% stake in LSEG, which is something I don't think they've ever done that before. And Scott Guthrie, who's Microsoft's head of cloud and AI, has joined our board. So it's a really interesting partnership in terms of the products that we're building together, but also has these structural elements in terms of the board membership and the ownership stake. What are we doing from a product perspective? There are a few different areas where we're building product together. One is that we are embedding our data and analytics and desktop platform into Microsoft 365. So if you think about a typical financial sector desktop terminal, and you think about PowerPoint and Excel and Teams, merge those and think about having the interoperable functionality of all of our data and analytics in the really, frankly, easy customer user interface of a Teams environment, and single sign-on, and instead of copying and pasting from over here into your Excel model, you can pull it right in. And PowerPoint presentations that update automatically with our data. And so that's one part. And that's the part that's gotten the most focus because it's so tangible. But there are other things that we're building as well. We're moving we have vast amount of data across what has historically been built up as 48, or depending on how you count, more data sets, databases. And we're moving that into an integrated architecture within the cloud environment of Microsoft, which will make it much easier for our customers to access the data, manipulate the data, commingle their data with our data. And then we're also building a modeling infrastructure. It's effectively an app store for analytics or models, where with the combination of our data and our models and the Microsoft cloud environment, we will make our models available for anyone who wants to use them, effectively rent our models. But more interesting than that is that others can use our infrastructure to put their models into this infrastructure or access other models for the infrastructure. So that's what I mean by it's effectively an app store for models.
You know, this is going to be fascinating to see whether other technology companies start taking equity stakes in other exchanges or financial firms. To some extent, I guess it's already happening where exchanges, the so-called exchanges, are acquiring technology companies.
There's an important convergence going on here. I think the big tech companies, the cloud companies, are unlikely to want to move into areas where they will be regulated from a financial sector perspective. But if you think about that as sort of a bright line, beyond that, I think you're seeing a massive convergence of our business is basically market infrastructure, so the plumbing that makes the markets work, information services, and technology integrating. And that's the direction of travel for our customers. And so in order for us to be helpful for them and frankly helpful in driving the change in the industry, that kind of integration is what we're doing.
Fantastic. I look forward to seeing what happens over the years, but there's a real transformation going on here. I have tons of questions to ask you, but I know we have questions from the audience, so we have time for 1 or 2 questions here, and I'm going to ask our students to come up first and ask questions, please. So can we have the students line up first, and then happy to open it up to others. We only have time for like 1 or 2 questions.
Hi, David. Thank you so much for your time today. My name is Lauren. I'm a master's student here at MSV. I heard you say recently in a CNBC interview that you believe that London will remain the main exchange in the European financial markets. After Brexit, there was a lot of talk that Paris or Frankfurt will become the next center. So I wonder if you could expand a little on that and share your thoughts with us. Thank you.
Sure. This is a topic that's gotten a lot of focus, and there's been a lot of interest in and sort of curiosity about London after Brexit. Fact of the matter is that London continues to remain by far the leading financial center in Europe and one of the world's leading financial centers. And I say this, I'm a New Yorker. Our business, as we were talking about, is global, and we operate in every major financial center. So on one hand, it's a little bit funny that I find myself in this position of talking about London as a leading international financial center, but it is. I think the kind of communication about other cities, in many ways, it's healthy if there's a diversification of capital markets activity across geographies. In the US, you have New York and you have Chicago. And the New York Stock Exchange is owned by a company based in Atlanta. So I think Europe was unusually concentrated in terms of capital markets activity in London. Having said that, London continues to, the stock exchange is by far the most international capital destination in Europe. And in terms of listings or capital raised, we're, again, by far ahead of the other European exchanges. The IPO market goes up and down. IPO window opens and closes, and that always gets a lot of attention from the media. But when you sort of strip all of that away, London continues to be Europe's leading financial center. So, but there will continue to be focus on it and questions about it because people like to focus on, what's the impact of Brexit.
Sure. A last question from Pavlos.
Yes, hi. I'm Pavlos. I'm a sophomore at the business school. Thank you so much for coming. You mentioned that the financial industry overall and the financial markets are changing drastically and very quickly. I was hoping you could talk more about, what skills or different coursework potentially that students like me can take in order to progress in this new context. Thank you.
So, probably the first thing to remember in the context of a question like that is the breadth of the financial sector. There's so many different skills that are necessary in this sector. And so the most important thing is to find what you are passionate about and what you're really excited about. Because if you're spending time in an area you're not that excited about, that'll just be painful as opposed to exciting. And this is a great sector if you're excited about it and passionate about what you're doing. I would say we see a lot of focus these days on data science, computer science broadly, coding. We're in an environment now where many traders know how to code. And that's really different from the world I grew up in. So that just gives you a sort of a sample or a taste, but there's a huge range of capabilities and skills that are necessary in this industry. So find what you're really passionate about.
David, we are so appreciative. You flew in last night to be here with us today, and you're flying back tonight. Thank you so much. We really appreciate it. Please join me in thanking David Schwimmer.
Thank you.
Fantastic. Thank you.
All right, so I'm Jill Hidary. I will be the moderator for the next session. We have today 4 fantastic panelists. I will let them introduce themselves, but very happy to have everyone here today. The session will be about ESG disclosure and particularly climate disclosure. So we're going to see what's happening in this area at the moment. Martha Carter, do you want to start? Maybe introduce yourself briefly,
Sure.
and then also define ESG for us, right? Because different people have different definitions for this concept, right?
Okay, very good. So we're starting off with intros. Hi, everyone. Nice to meet you and nice to be here today. My name is Martha Carter, and I'm the head of governance at global CEO consultancy Teneo, based out of New York, although I am actually based out of this area. And Teneo does work for CEOs and by extension management teams and their boards. And we work with a lot of very large public multinational firms, some of which will be reflected in my remarks today. I've been with Teneo for 8 years, and before that I was with proxy advisor ISS. where I led global research there and also chaired their policy board. And I was with ISS for 13 years, and before that, I was with NASDAQ stock market, and before that, I was working on my PhD, and Regan Agarwal was on my dissertation committee. So I've her to thank for the fact that I was able to actually finish my PhD.
Congratulations. Sam, you want to introduce yourself?
Sure. Hi, everyone. Thanks for joining us here today. I'm Sam Hodis. I'm head of enterprise ESG strategy at Nuveen, which is the asset management arm of TIAA, the retirement provider. I'm responsible for all of our governance and strategy covering our corporate ESG issues as well as our client strategy as it relates to our ESG products and solutions.
Christina White.
Sure. Thank you for having me. My name is Christina Wyatt. I'm Deputy General Counsel and Chief Sustainability Officer at Persephone. Persephone is a software company that helps other companies to measure and manage their greenhouse gas emissions. Before coming to Persephone, I was on a one-year assignment at the Securities and Exchange Commission working on the climate proposal that's currently pending, that we're all waiting with bated breath to see what comes out in the coming months. And then before that, I spent over a decade at the law firm of Latham & Watkins.
Anant?
Thank you. Good afternoon, everyone. Really happy to be here. Anant Madhavan from BlackRock. I'm a managing director there. I've been at BlackRock for 20 years. Actually started at BlackRock's, in our San Francisco office with BGI. Before that, I was at Investment Technology Group, and before that, I was actually an academic, and I'm probably one of the few people here who did not have Rena as his dissertation chairperson. So there we go.
Fantastic. All right, so like I was saying before, we're going to be talking about ESG. Maybe a good starting point is, what does that mean? Because again, it means different things for different people. Sam, do you want to?
Yeah, obviously, what it means to different people is very contingent on what their goals are when they look at different investment solutions and what their overall investment thesis is. For us at Nuveen, we focus on thinking about ESG as a noun. Right? Those are the environmental, social, and governance factors. They just exist. There's nothing about them that is, should be uniquely magical or controversial. And then responsible investing is where the value is, where we look at those ESG factors and we consider them in our investment analysis, portfolio construction, and ongoing monitoring to deliver, hopefully superior investment products and returns to our clients.
Martha?
Sure. So ESG, everybody knows what the letters stand for, but there, as Sam said, there's a lot of different definitions and it means a lot of things to a lot of people. If I could just do a quick history lesson, the genesis of ESG really comes from about 2 decades ago with UNPRI and the principles of responsible investing. And out of that, and we've got a couple of investors sitting here today, and they can Sam alluded to it and they can talk to it, but out of that came, what are the impacts, what are the risks, what is material, and all of this discussion is really grounded in a concept of materiality. And it's, people like to conflate value and values with an S, and it's really grounded in materiality. What is material for a company? And back then, there wasn't a lot of this stuff out there. They're really, from an investor perspective, the only tools they had were practically screening, and by screening is negative screening out. And you mentioned you were with BGI a long time ago. You probably remember this, which is just you're screening out tobacco stocks, or you're screening out sin stocks, or whatever. And from an investor view, it shrinks your portfolio and gives you fewer options, not more options. And so the idea behind the principles of responsible investing and ESG is that you can have positive screening where you can increase your investable pool by looking at those that have really investment solutions that are good for long-term sustainable impacts. Because at the end of the day, all these asset managers have underlying them asset owners, and those asset owners are pensioners and foundations and sovereign wealth funds, and whose horizon is longer term than a future pensioner. And so all of ESG, which is, and I know we're going to talk about the backlash, it's been conflated with woke capitalism and it's been demonized and politicized. But its heart really is at this concept of materiality.
I don't see you're shaking your head here.
Yeah, no, I'm in violent agreement with Martha. I think the first point she made about this is not something that's suddenly very new is a really excellent one. So she mentioned the United Nations. I would say that, under different monikers, this has gone back to the divestment movement from South Africa. So it's gone back even further, under the name of socially responsible investing and so on. So this is nothing new. And just to echo Martha's points, I mean, to me, yeah, we have three very different groupings of things that are called data. This is essentially data. And I'll also rephrase kind of your question a little bit, Gil, which is, it's not how I think about ESG, it's how do our clients think about ESG, right? So Martha made the point, Sam and I are asset managers who are managing the assets of the ultimate asset owners, pensions, foundations, endowments, individual retail investors through separately managed accounts with direct investing, say. All of those people have views about how their portfolios should look. So some of our investors are faith-based, and they want their portfolios to reflect their values with the values, and it's our job to execute our fiduciary duty to give them the best possible portfolio that's consistent with their belief systems. I think where it gets challenging is that we need a lot of data to do this, and again, to Martha's point, this is all about metrics, so that we can deliver a better solution in terms of the ultimate risk and reward of the portfolio.
Christina, data?
Yeah, I mean, to me, it really goes to companies looking over a longer term horizon and thinking about, as Martha was talking about, the issues that are material to the company. It's expanding the company's view from what's in front of them quarter to quarter to what are those externalities that the company may have in the way that it does business, whether it relates to pollution or climate change or supply chain human rights or human capital management, all of these things that may have an impact on the world that ultimately will have a financial impact on the company that a well-governed, well-run company ought to be thinking about for the benefit of long-term investors. So thinking about those things that aren't just in front of the company today, but also those things that will be really important, financially material, over the long term.
Sounds like a plan. So Sam, it's a very quiet area. Nothing is happening in ESG at the moment.
No, it's been boring for all of us.
For all of you.
We spend our time going from conference to conference because there's nothing else happening in the ESG space, which has been nice. It's been very nice for us.
But if you had to say something about what's going on, what would you say would be the major themes at the moment?
Obviously, the marketplace continues to grow, and especially when we look at client demands and global asset owners. This is becoming foundational to what their expectations are when you're bringing them different strategies and solutions to meet their long-term investment goals. This is being paired over the last couple of years with a much more polarized view, obviously here in the United States. And I think that has really helped focus, honestly, more attention within our industry on exactly how we're trying to communicate the value and the history of ESG to clients, both domestically and at a global scale, because again, we are here providing strategies and solutions that meet a variety of different client aims. We, at least at Nuveen, are always taking the lens of putting investment first and providing the end client with choices and options. And I think that as we see global asset owners and the global regulatory system, which I know that we're going to get into in more depth, continue to evolve and provide more precision and guidance around what is expected at an asset manager, fund, and corporate level from an ESG perspective. It's going to allow for continued refinement and more bespoke and specific strategies that will meet the ESG aims and needs and regulatory demands of a global marketplace.
So you're nodding.
Yeah.
Do you agree those are the main themes, or are there other
so Sam
themes?
mentioned sort of the pushback or the anti-ESG backlash. In our line of work, we work with a lot of CEOs. They have top of mind really.
May I just maybe postpone this for a second on the backlash?
Oh, you want to push it to the next?
The next, yeah.
Yeah. So that would be, I know we're going to drill down in that. So that would be topic one. Geopolitical risk is huge. And in fact, arguably that's topic one because, as Sam said, the anti-ESG backlash is a very U.S. component to it. So the geopolitical risk, if you just look at where we are here in Washington this week, yesterday there was a huge pro-Israel rally. Today, in San Francisco, Biden and Xi are meeting. Friday, Congress is scrambling to avoid a shutdown. Boom, all in 1 week. I mean, it's just incredible amount of geopolitical risk and tensions that have to go into the calculation of how you run your business, and there's sanctions in Russia and what's going on in Taiwan, and how do you navigate through this world of social media is another one that's fast-paced and can have huge reputational damage in a heartbeat. And that's also top of mind for CEOs. And I could probably go on. I'd probably come up with 5 or 6 more. But I will let you jump in.
I'll be happy to take that one. So I'm almost scared to nod now because Gilles is going to pick on me. But
that's my bouncer look.
That's your. But to us, I think the main thing is, can we learn about the client's desires or wishes from the data that's given? So let me give you an example. So consider like 2 different clients who both say sustainable investing is very important for them and their portfolios. But the first client may want to direct, to Martha's initial opening remarks, they might want to direct their investments away from certain industries, even give us tickers saying we don't want to be in these tickers. The second client may take a more quant approach. They may say, I want to emphasize renewables, I want to emphasize sustainable agriculture, so to Marta's point, actually expand the remit beyond the traditional index. They may want to also have a goal of reducing their carbon footprint relative to a popular index benchmark. All of this we can do if we have enough data. So the job is to gather meaningful data that is informative. And when we talk specifically about climate change, I mean, climate change is a global issue. So there is a need for global standards that are consistent across domiciles, across regions. And that's kind of the challenge that we're facing right now as asset managers.
Right. Christina, you want to elaborate on what you think are the main issues at the moment?
I mean, I think we'll probably get into the data issue, but I couldn't agree more that we really need to see harmonization of standards so that we're all trying to measure the same things in the same way. We'll have some differences in different jurisdictions around who's subject to what laws, and there's single materiality in this country and double materiality in Europe. There are those differences, but getting to a point where we're measuring at least the same things with the same measuring stick is critically important, and we're well on our way. We're making a lot of progress in that regard, so I'm actually quite optimistic about the direction of travel.
So better definition of the concepts and then better measurement so that we can implement solution.
Yes.
Yeah. I can hear the passion for the backlash. I can hear my panelists want to talk about this. So Sam, given what we read in the newspapers, you see companies, domestic companies having to deal with this, but also foreign companies moving to the US and dealing with a political or cultural environment they're not really familiar with. What are your thoughts on that?
I think that, this is, when you look at the number of ESG designated or sustainable products, the AUM flows into those products over the last 5 and 10 years, and the real ramp up, it was inevitable that folks were going to take a hard look and say, all right, well, what's really going on under the hood in these funds? And some of that has come from, I would say more of the political left from a greenwashing perspective, but some of it's come from the political right, saying what's really the value here, and are you really trying to satiate client demand, or are you advancing an agenda of your own? So it's put the onus on us as an industry to be much more clear in our communication about, again, we provide solutions to investors, And also, as we get more data and these global regulatory regimes start to come online and we get more consistent and high quality data, it becomes easier to demonstrate, maybe not direct attribution analysis to any one ESG factor, but sort of the overall value set that responsible investing has. At the same time, I think it's important, if I were a company coming from overseas to start to do business in the United States and looking at what's happening in the political environment, that while we've got states that have made decisions through statute and regulation in their individual jurisdictions to limit the ability of their state DB plan assets to invest in ESG strategies, almost every state in the United States at the same time is advancing state-level policies that incentivize energy efficiency, renewable energy, and a lot of other initiatives that sort of undergird the direction of travel that makes looking at ESG factors valuable from an investment analysis perspective. So I think that while you need to be mindful about how you communicate to a broad and diverse client set and a broad and diverse stakeholder set, at the same time, we're investing for the future. We're investing on behalf of long-term asset owners who have that lens. And when you look at what's happening under the hood, it clears out some of the noise, and you can see more broadly why it becomes valuable to have a clear view and clear principles around ESG factors.
Right. Given this complexity, I know some folks have told me that they try to have two messages depending on which states they're talking to. Views on that?
I think that's a recipe to. We were in Washington D.C. What's like the if you're in the middle of the road, it means you're roadkill. I think that having or wherever I can't remember the exact political analogy. When you're communicating about anything that your company is doing, whether it's related to your ESG products or responsible investing, whether it's related to your corporate sustainability initiatives, or your just overall product set, you need to be clear and direct about what your values are, what your principles are, and why what you do and the initiatives you've undertaken ultimately have value to your clients and the broader set of stakeholders who have an interest in the success of your company. And that means that if somebody is skeptical of responsible investing, you say the same thing to them that you would say to someone who believes that our companies aren't doing enough to actually take a political stance in response to many of the issues that are percolating in the world today. Instead, what you tell both sets of critics is, this is what we do, this is the principles and the value that underlies it, and this is why we believe it's the right thing for our clients. And having one clear and consistent message, I think, is critical to navigating the current political environment.
That's how I talk to my wife. That's my story, and I'm sticking to it. So, sorry, I cut you off before when you were about to.
We could spend a whole panel just on the anti-ESG backlash, right? So from our perspective, and again, we consult with CEOs and managements and boards, companies are really looking to sort of navigate this rocky road through a lot of the political backlash. But it's very localized. So we work with a lot of large multinationals. They don't see it in Europe, quite to the contrary. I think you mentioned that Europe is moving along with CSRD and everything. So quite to the contrary, in Europe, there are more directives out there, not fewer directives. And so it's very much a US phenomenon, which will probably continue right up through election next year. But the toothpaste is out of the tube. Investors aren't backing off. You can hear what Sam's talking about. We don't see evidence that investors are backing away from really making sure that environmental and social issues that do have impacts and that are meaningful to company and our material really get assessed. And the regulators, particularly overseas, aren't backing off. And the companies know that, and they're not backing off. Teneo just recently did a study. It's on our website if you're interested at teneo.com. It's called the DNA of sustainability reports in the US, and we looked at half of the S&P 500, combed through 250 ESG reports, no small task. But what we found is that 95% of those reports are signed or co-signed by the CEO. The CEOs are not backing off. 80% of those reports are saying that a lot of their goals are on track. The vast majority of companies are not shying away from the messaging. They're either, when they're putting out their ESG reports, which they almost all do, they're putting out press releases with it, or they're setting up microsites so that investors and other stakeholders can go right to the company and go see what their ESG report is and what their ESG platform is. And they're doing external assurances. To the comments about data, I second that and third that, because we can't do anything without good quality data, and we don't have that yet. But they're really seen as these, the CSRD in the EU is being phased in, California is being phased in, you gotta have data. And so they're gathering data, and they're also looking at internal and external assurances, including third-party independent assurances, not just with the big accounting firms, but also the boutique firms, to really make sure that the data is of high quality as well.
So I know this is moving to a data-driven discussion, a way to mitigate this backlash, or at least to have a more peaceful discussion?
Yeah, well, I think the asset management side of things, Sam articulated very well. That's I think how the industry is proceeding. And when we talk about this, we try to explain again, reinforce basics. We are asset managers. We're not the asset owners. We have a fiduciary duty. I can't emphasize that enough. Fiduciary duty to the clients who've entrusted their money with us to manage, or for whom we are making decisions. And that fiduciary duty is very, very clear, which is we have to give the clients the best possible portfolio given the data that they give us. So in my earlier example about somebody who wants to reduce the carbon footprint of their portfolio relative to, say, a popular index, well, that comes with a tracking error. So our job is to explain to the client using a risk model, using an optimization framework typically, what that tracking error might be for different levels of lower carbon relative to the index portfolio. But then the client makes the choice. It's not our decision, and that's something that we stress a lot in our conversations of, it's not about our values or so on. It's especially clear with faith-based investing where the manager may have a different faith. The client says, I want to exclude certain tickers, certain industries. Fine, we will do that. And we will just explain to them what the resulting tracking error might be. So it is about not only the data, but also explaining how the data is used and presenting the client with a range of possible outcomes in terms of risk and return. So all of these climate change issues have risks, which we've talked about, but they also have potential opportunities. So there's new technologies being developed. Clients are very interested in these things. So we want to explain what these things are and let the client decide, because that is really how we satisfy our fiduciary duty.
Christina?
I couldn't agree more, really. I would just put a fine point on or emphasize the importance of the quality of the data and the role of assurance, because it is the way that we can combat greenwashing. And greenwashing is really the enemy of confidence in the markets and in sustainable investing. And once we have requirements to disclose information in a consistent, comparable way, subject to assurance, and we have methods to track the data so that they're really, truly transparent, then investors can have confidence that the risks and opportunities that the companies are talking about in their reporting are actually measurable, and that where companies say that they're making progress toward, for example, decarbonization goals, that's actually measurable, it's provable, it's assurable, and so investors can know that the money, the capital that they're allocating to those companies is being allocated wisely, and it's not just just words on a piece of paper.
Right. So to go from the mission to the implementation, right? I was reading an article in a newspaper a few days ago, and I came up with a new word that I've never seen: green hushing. So apparently, what this thing is it used to be the case that people didn't do good things, but were bragging about doing them. There's apparently a trend, according to that article, that people do good things but won't be quiet because they're afraid of the backlash. Is that just a catchy title, or is there something to it? And I guess that's a free-for-all.
I think so, but...
Sorry, Martha, you go. Well, I would say, I've seen that phrase pop up in the last few months in different articles, and we certainly all passed it around, inside the companies, like, have you guys seen this phrase before? What does this phrase mean? But to Martha's point, the trend from a point of market expectations from a corporate disclosure perspective is towards greater disclosure that's aligned to specific either market frameworks, GRI, SASB, or to increasingly regulatory frameworks with CSRD, UK, Hong Kong, Singapore, other global jurisdictions coming out with their own climate and ESG reporting frameworks. So I think that green hushing, it may have referenced a brief and fleeting moment as folks took a step back and said, how are we really approaching this and what are our principles? But over the medium and long term, I don't think I don't think it will reflect a permanent shift in the approach that both corporate issuers and the investment community is taking to this.
Is this a consensus on this?
Yeah, no, I think I'm aligned with Sam's view on this, exactly.
Yeah, I think it's, on the one hand, nobody wants to be the next Disney Florida or the next Bud Light. On the other hand, very few companies have the kind of marquee name where they're going to be called on the carpet. And so what we're seeing in particular in non-household name companies, like say more the mid-caps, or even in private equity and in pre-IPO where they can run under the radar, they are all in on ESG because they know that, like especially for a private equity company that has a portfolio companies, they know that when they get to an exit strategy, they want a clean exit strategy, and that includes governance and all governance, ESG. And so they don't have to back off because when Congress declared July ESG month and started calling people in for hearings, their portfolio companies and the PEs aren't going to be top of list. So they can really run with this. So there's a huge swath of companies that really are relatively ambivalent to the political backlash because they're not Disney.
All right, so we probably want to save some time for the Q&A, so maybe in 30 seconds or less, like your last words for today's discussion. Extra credit if you mention regulation in those 30 seconds.
Yeah, so, I'm enormously optimistic about the direction of travel for the harmonization of reporting standards around the world. We went from what was really an alphabet soup of different reporting voluntary standards to something that is much more harmonized around the International Sustainability Standards Board, which was designed by the IFRS Foundation to try to create a common baseline for sustainability reporting. Its standards on climate, which are the first standards that it's come out with, the only ones so far, a general standard and a climate standard, align quite closely with the SEC and California, and even with Europe, even though Europe is a little bit different because it has a double materiality lens. But all of this is to the good because it means that companies can have greater assurance that as they work to gather the data that they need and build their reporting, that there won't be wasted effort. The work that they're doing will serve them in all of these different regulatory frameworks, even where there are some differences around the edges. The common baseline is there and well-defined.
Sam, 30 seconds or less.
Yep, I'd say ultimately the proliferation of global regulations should help bring clarity on both a product labeling and a disclosure perspective. It's critical that there's the appropriate sequencing of regulation with corporate issuers who provide the data that we utilize in our decision making, doing the disclosure, and then it's also critical that on all these regimes we have equivalence and interoperability so we don't bifurcate the market and create barriers to entry in certain jurisdictions. And then lastly, I would say we've talked a lot about ESG disclosures from an operating company perspective, but I think we're also going to see moving forward from an asset manager perspective much more client demand and a race to onboard data and technology to respond to asset owner demands for ESG characteristics and reports coming out of the funds and strategies that they're invested in.
Great. Martha, 30 seconds or less.
Yeah, I would say between now and next year's U.S. presidential election, fasten your seatbelts, it's going to be a bumpy ride. Beyond that, I agree with my panelists. We're going to see better data, better disclosures. The U.S. will hopefully fall in line and not be the laggard that they currently are. And the whole investment of ESG and companies focused on materiality and impact is not going away. It's only going to gain traction.
Yeah, so just really quickly, I mean, I think my fellow panelists made all the points for me. I think we're moving in the right direction. The data is getting harder and it is getting more standardized. As I said, global warming or global climate change is a global problem, and so we need to know, we need to have consistent standards across regimes, across regions. I think we're moving in that direction. I think that's the general sentiment from the panel. More data is good because it helps us tailor those client outcomes that are so important. It's a form of having, it's almost like a language. You can imagine that when we created these words, we can have a better, more in-depth discussion with the clients about what they really want. And somebody who's interested in sustainable investing may want renewables, they may want to lower their carbon footprint in their portfolio. They may want very different things, but we have the data, then we have the discussion with them.
All right, sounds like a plan. So I guess at this point we're going to move to the audience and take questions. I don't really see because I've got the lights in my face, but if someone wants to ask a question, please go ahead.
Sure, thank you. First of all, thank you all for coming. I appreciate it. My question is, when you think about kind of businesses allocating resources, capital, labor to ESG, can you provide some color on kind of the weighting? Like, is it 60% sustainability, 20% S&G? And on the client side, when they're investing in a business, is it, again, kind of what's the weighting? Is it similar to how companies approach ESG? Some more color on that would be awesome. Thank you.
It's very, what's one of the things about ESG factors is they're very company specific. So if you're a technology company, there might be a much greater focus on your human capital management practices, your overall governance practices, whereas if you're in an extractive industry or a utility, there would be a much heavier weight on climate risk, natural resources, biodiversity risks, and the E. So when we look at ESG factors, it's not necessarily a fixed weight where you're looking at a risk score or ESG score for an issuer. You're going to look at what matters both and from an absolute basis, but then also a relative basis within their industry.
Yeah, and I'll just add, I totally agree with what Sam said. Companies are more and more looking at it as part and parcel of their business strategy. So not as ESG that sits off here, and we have a DEI group that focuses on diversity, and we have a climate group that focuses on that, but what comes under the umbrella of a business strategy, and thereby being able to determine what is material and impactful to that business. And there are ESG is a huge, massive umbrella of topics, and thereby being able to say what comports with our business strategy, and then we can say what's material to us and what do we need to really focus on.
I would just chime in. I totally agree with both of you, and I might just also point you to the SASB standards, the Sustainability Accounting Standards Board, which is now a part of the ISSB, which I mentioned, the International Sustainability Standards Board, has come up with proposed standards and topics by industry, and it's done this for 77 different industries. So it can really help you to identify the issues that are material for companies in a particular industry. It's a great place to start, and you'll see that there is significant diversity of topics. As Sam was saying, a technology company will be quite different than a company in the extractive industries, and that's quite useful because you want companies to be focused on the issues that are material to them and not just paint the world broadly with one ESG brush.
Just summarize my last MBA accounting class on ESG disclosure. So, Anand?
Well, I mean, I think it's a great question. I actually want to answer sort of the part two of the question, which is how do investors think about the companies they're investing? And I think one of the questions that always comes up is there a relation between E, S, and G and returns of the company, right? And that's a topic that's very difficult to answer. I can't go into it in 30 seconds, but I will point you towards a very interesting meta study from NYU Stern School by Emmanuel Axt, and he looked at over 1,000 academic articles. So to Martha's point that ESG has been around for a long time, I was actually amazed to read that there were 1,000 academic studies on this subject. And it's a great meta study where he goes through and summarizes all of this information. So that's the other side of the coin in terms of thinking about this and how investors think about positioning E, S, and G in their portfolios.
I think we have time for one more question.
Thank you guys so much for being here. My name is Jabari. I just had a question, especially as somebody who's interested in the sustainable investing space. How do you guys think about the benefits of engagement, especially from what you guys were speaking of the somewhat exclusionary investing that can sometimes happen where you just exclude a company that doesn't meet your standards? How do you think about the benefits of engagement to potentially get a company that may not meet those standards today to get there over time?
Right.
Yeah, I mean, we have a very active stewardship team at Nuveen, and we take a lot of pride. We put out an annual stewardship report that I encourage you to take a look at, where we get into the value that we see in direct engagement, the strategies that we put in place, the issues that we focus on, where we think they're material. We think that there's a lot that can be done from us identifying what we see to be a material ESG risk with an investee company, engaging directly with management, to try to get first more transparency. Can they get us data in a more consistent way that's up to industry standards? Can they put out a clear strategy through their ongoing corporate strategy and operations for how they're going to address that? And then ultimately, we want to see what are the tangible outcomes. But we think that there's a lot of value in getting people to create longer term value for us as an investor by sort of following that path towards, through engagement, towards greater aptitude in addressing ESG risks.
So before I ask you, make the remarks within 30 seconds, I'm going to say 20 seconds.
I'll just comment again from the asset management perspective. I mean, we have a large stewardship team. They're very transparent. We publish a lot about how we make decisions. We engage, and it's all very public.
Okay.
I'll just make a tangential, though quite related comment, which is the whole shareholder proposal process is the U.S.'s form of engagement in a way that it doesn't exist in a lot of other countries. And the whole 14A process has been maligned to some extent. But when advocates file shareholder proposals on environmental and social topics, that's a form of engagement. And a lot of times companies will engage both with their institutional investors as well as these proponents to understand what the environmental or social issue is, and they may make changes because of that.
Christina, 20 seconds or less.
I think engagement is enormously important and would just point to the fact that even if Nuveen and BlackRock have exclusionary funds, they also are, in many of their investments, exposed to the market. And so if we can address the risks, the systemic risks that the market faces through engagement, then we're going to improve performance and risk-adjusted returns broadly for all of those investments that are across the market.
All right. Well, at the beginning, I promised a fantastic set of panelists, and I delivered. So thank you very much for your time, for your insights. We appreciate that you came here today, and I'm sure the audience also appreciate it.
My name is Pavlos Thomas. I was born in Montreal, Canada, and I'm a sophomore at the McDonough School of Business, majoring in finance. I'm very passionate about finance, especially, increasing financial literacy. The first time I really heard of the Psaros Center was during last year's FMQ. I attended with my dad, actually. He came in because he thought it would be a really interesting event as well. And that's actually where I met Dr. Agarwal for the first time, and Mike Psaros as well. They were just so friendly, and they were really excited just to have us there. That personal aspect really stood out. And then just the quality of the speakers and the quality of the event was just exceptional. From that moment, I knew that the Psaros Center was truly something special, and that it was something I wanted to learn more about and potentially get involved with. That really escalated when the Fin Policy Trek was announced. And from there, I was fortunate enough to be accepted, and it was truly an exceptional experience. The Fin Policy Trek was truly packed with many incredible meetings and experiences. And I have to say that I did not think that I'd be able to experience so many different things in such an early point in my undergraduate career. Being able to walk into the Capitol, sit in the meeting rooms, going to visit Neuberger Berman or Morgan Stanley and sit in their incredible conference rooms and listen to some really incredibly successful people. I just didn't think I'd be able to experience that so early on. The whole trip was truly just one bucket list item ticked off after another. It was really incredible. My favorite memory personally was our meeting with Neuberger Berman. Just the way they welcomed us in with these packets, outlining the current state of the markets on their conference table, and offering us snacks and everything. It was just so professional, and we felt truly welcomed. For me, that was, such a testament to the Georgetown Alumni Network, the fact that these people were truly excited to have us there. I was definitely excited to find any way to stay involved with the Psaros Center following the event. I was actually fortunate enough to be granted a position as a student assistant with the center. So I've been helping out with researching for our upcoming webinars, finding potential speakers that might want to join us as well. And that's been a very informative experience. And I'm hoping that it will continue to develop potentially into some form of formal research paper with faculty here at Georgetown. I would not have experienced had it not been for my continued involvement with the Psaros Center and all the incredible resources that they have for students, clearly of all ages. I'm working with another student who was on the trek with us as well. Not only from an experiential standpoint has this been incredible, but I still get to keep in touch with all the great people that I met along the way. I'm really happy to stay involved with the center. In terms of how the Fin Policy Trek has changed or shaped my outlook on what I potentially want to do post-college, I have to say that it has definitely shed light on the corporate culture of different firms that we visited. And I've definitely gained a better idea of what kind of experience I want in finance, especially with the firms that are out there. Above that, I have to say, I think everyone at this point is just talking about either consulting or investment banking. But one thing in particular that I've always been really curious about has been private equity. And although this isn't specifically with the Fin Policy Trek, but it was a leading point to this. My current involvement with the Psaros Center has me researching private equity regulation. So although the Fin Policy Trek was an indirect cause of me being able to explore this and, potentially seeing a future in private equity, I've been able to hone into the things that I'm really passionate about. I think that just the involvement with the Psaros Center has definitely overall helped guide me into the right direction.
Hi, I'm Kelly Grace. I'm a junior in the MSB, double majoring in finance and management. I also have a minor in government. And I'm really interested in the intersection of government and finance, specifically as it relates to fintech, blockchain, cybersecurity. I attended the Psaros Center's first event in January 2023. From there, I got on the mailing list, and they sent several emails in March and April about the Fin Policy Trek, and I got really excited, so I applied through the newsletter. I think one of my favorite memories from the Fin Policy Trek was when we were at the morning meeting for JP Morgan. We got to sit in, see the behind-the-scenes morning meeting that was streamed to every single office of JPM, and then we got a chance to ask some questions about the presentation and how it related to the current events that were happening in the market. So it was really cool to see how they interrelated the private and public sectors within the morning meeting every single day. The trip and engaging with the Psaros Center has really inspired me to continue interacting with the key stakeholders from both the public and the private sectors throughout my post-grad career. So I'm starting in investment banking, and I'm really hoping to interact with government officials in terms of trying to see the new policies that may affect investment decisions. And the Psaros Center also has inspired me to go after an MBA and a master's in public policy at the same time in my future career line. I'm really excited about that. So I'm staying engaged by doing the bi-weekly lunches that the Psaros Center is hosting for a lot of the business students here at Georgetown. And that's been great just to give back and talk about my experience with the Fin Policy Track and talk with a lot of like-minded students. I'm also helping with the FMQ that's being hosted in November and helping with the speakers and lists and ushering. Excited for the conference.
Hi, I'm Will Burke, and I'm majoring in finance and international business. I first learned about the financial policy track when seeing a flyer around campus, and it clearly stuck out to me that this was kind of a unique experience that I couldn't get anywhere else on campus in terms of the ability to meet both people from the government side in DC and then the private sector of New York. So combining those two interests for me were truly unique. I personally was looking for an experience to kind of gauge my two interests in both the international sector of public policy and international business, and combining that with finance in the private sector to kind of figure out what roles there are at an intermediary level where you can combine these two interests to get both that international knowledge and combining that interest with the finance side of things. So I think this experience truly kind of opened up new experiences for me in terms of roles that people have been very successful in both DC and New York, to be able to combine those two interests of the international markets and the U.S. markets. One experience that really stuck out to me from the financial policy track was the dinner that we had with multiple officials in the government offices of key financial services firms such as Morgan Stanley and JP Morgan. And I was given the unique experience to be at a table with a Morgan Stanley official in their government relations office, where she mentioned that her interest in both financial policy and the international world combined through this role that she now serves in the private side, but working in a government role. So she's able to combine those two interests. And I was really able to relate to that experience from her coming out of university. For her, she'd always been very interested in all things happening in the world, but also wanted to use her strengths in numbers and finance to find a role that kind of meets those two. So for me, this kind of opened my eyes to a new role that I hadn't so much thought about as to the government side of these private firms. So I was really able to look into this more and continue my conversations with her privately through email. And she's really been a helpful resource in terms of expanding my eyes into this new opportunity. I think for me, I had a unique experience where I was very early in my career aspirations in terms of trying to figure everything out in just the end of freshman year. So now being a sophomore, I think I was really influenced by the Fin Policy Track to use more of that policy side. And I was able to see roles where I can really incorporate that policy side into a financial interest, which I wasn't as knowledgeable about. I thought that you kind of had to pick one side of the thing, whether it be serving on the Hill in DC or just going to the financial side of New York. And I think this financial policy track really found that middle ground that I was looking for. So I'll be forever grateful for that. I've been able to stay in touch with a lot of members of the financial policy track and the officers in the Psaros Center to continue this interest that I have. And because I have so many years left at Georgetown, I have a lot of ability to continue that interest in this unique new part of the business school where we have this combination between public policy and finance. And I think that is a relationship that I definitely want to continue and is going to be really helpful in terms of my career aspirations. So this new Psaros Center has really been able to open my eyes to the opportunities that Georgetown students have here on campus and with the resources that we have off campus in terms of connecting them with alumni and other people that have similar career goals.
My name is Holden Zarega. I'm a finance and international business regional studies major in the business school. I'm from Norwalk, Connecticut, and I was drawn to this program because of my interests in financial markets, specifically investing. First heard about the financial markets and policy trek was through LinkedIn, and I was really impressed by the itinerary. I saw that it was a week long, which was quite extensive, and I was not aware at the time of any other program that was similar in the extent of the in-depth, in-person experiences that it offered. I was drawn to the opportunity to travel to these profound locations and talk to really smart, motivated people on subjects that were near and dear to their hearts. The program was split half between policy here in DC and the private sector in New York City, and I really liked the duality of the trip in that sense. As someone who is more knowledgeable about private markets, I thought it would be a tremendous opportunity to learn more about the public sector. There were many moments that left a lasting impression. If I were to speak to a couple, I would say the opportunity to speak with senior members of Neuberger Berman in their corporate office was super impactful in that I gained a perspective on how institutional money managers and capital allocators thought about the various economic, political things occurring every day. I thought that opportunity was super cool and extremely informative. Another one I'll speak to is we had a chat with a senior member of Churchill Asset Management. He's actually a former Hoya, and he spoke about how he leveraged his unique educational insights from Georgetown to kind of branch out into a new market that was severely underserved, which was private credit. I thought this experience was unique in that as a Hoya, he shared many personal experiences that us as Hoyas could relate to and find encouragement from. I think my participation in the FinTrek trip was extremely helpful in allowing me to better evaluate the professional opportunities. I can better estimate which career paths and specific positions are best aligned with my strong suits, my interests. I think one of the things that this trip enabled students to obtain was diverse exposure to a range of different career paths. Additionally, of course, the trip helped me to learn new things. I mean, these students that accompanied me on the trip asked a range of really smart, probing questions. So I was constantly learning on the trip, and having completed it, I can say that I walked away a smarter, more knowledgeable person. The Psaros Center has done an excellent job of maintaining opportunities for the trip's participants to stay engaged and continue learning about the intersection of financial markets and policy. I've been lucky enough to attend several additional dinners. The Psaros Center actually hosts biweekly luncheons, which are another great opportunity to connect with the trip's alumnus and remain engaged. They've hosted luncheons with people in policy and in the private sector, enabling us as students to maintain an understanding of what's going on right now. What are the things that these economists, these capital allocators, these regulators are thinking about as they occur? Actually, just last night, I was at a dinner with Ernie Tedici, the chief economist at the Council for Economic Advisors. Having the opportunity to listen to Ernie speak about how he approached the economy was extremely enlightening. Having the opportunity to maintain access to these really smart, really motivated individuals who are leaders in their careers is not to be taken for granted.
Okay, we are ready to go on to our next speaker here. And let me start by introducing Arun Gupta. Arun has been in the venture world for a long, long time. And he's a partner at Columbia Capital. Before that, Arun was with Carlyle Venture Partners. And his focus is AI, cybersecurity, and a lot of emerging technologies. And most recently, in addition to being in the venture world, Arun has taken on sort of this new mission, and he is the CEO of Noble Reach. And I'm going to let Arun tell you what that's about. And combining his mission work with his venture work, Arun has written a book, Venture Meets Mission. And we'll tell you how to get copies of his book that the Psaros Center will provide. Most importantly, Arun is an award-winning professor here at Georgetown. He teaches courses in entrepreneurship. Arun has degrees from Stanford and Harvard, and is just involved with us in many different ways. He has known Senator Warner since a long, long time, and is going to do, we have this pre-recorded talk with Senator Warner, and Arun is the moderator. I'm going to ask Arun to come up and just say a little bit about what he and, with the help of Senator Warner, what they're trying to do with Noble Reach. Arun.
Thank you, Rena. Thank you, Rena. Wow, there's a lot of niceties, and it means a lot coming from Rena. I've known Rena for 40 years, so she's been a mentor, both a personal and a professional one for me. And I think that's what made this special. Of also, Senator Warner has been a professional mentor, having started my career at Columbia Capital, which is a firm that he started, and now collaborating with him on the policy and political side. So as Rena outlined, we wrote after teaching a class, we wrote a book called Venture Meets Mission. And the inspiration around that really came around trying to dovetail the two experience axes that I had, which is one being in the venture space, so being around entrepreneurs and the optimism that comes around entrepreneurs, but then also being on a college campus and teaching, and the optimism that comes around being these students. And what you started to notice is that what entrepreneurs have is knowing how to build a plane while they're flying it. And in a rapidly changing world that we're in right now, that's really what's required. It's hard to have 5, 10, 15-year plans because with emerging tech accelerating so much, geopolitical changes, societal changes, you need that entrepreneurial mindset. In addition, though, what you need is to get our best tech talent to come into government. And as we were writing the book, we came across a stat that less than 7% of tech workers in government are under the age of 30. We have 4 times as many tech workers over the age of 60. And the average age of Google is like 32, 33. And so this is a little bit red alert, because in great power competition, I think the theory we have is that you need to have better talent and better innovation around government. And so from the book, we were able to raise and start a foundation, which is called Noble Reach. And Noble Reach is embarking on taking that issue on. What we're doing is creating programs to kind of get tech workers, especially coming out of school, to go into government, think a Teach for America-like service, which restores a level of prestige, respect, but also having it be viewed as a career enhancer, so that they could go back to many of the financial services or consulting jobs if that's what they desire to do. And so, it was very apropos in this conversation that we had with Senator Warner, because as we talk about AI and the implications on financial markets, you can't talk about it without, also talking about the talent we need inside of government to be able to address these issues. It's difficult to be setting policy. It's difficult to be incorporating it into day-to-day businesses when you don't have people that really understand it. And so how we rebuild that infrastructure to attract that talent in, we talk about that a bit. And, Senator Warner talks about a little bit of what his biggest concern is for our country going forward, and part of that is generational apathy. We need this generation to be engaged. And that's what we're trying to do at Noble Reach. And as you'll see, as we talk through the implications of AI, and financial markets. Towards the end of the interview, we talk a little bit about that as well with Senator Warner. So with that, we'll go to the interview.
Hello, everyone. This conference is being sponsored by Georgetown Psaros Center for Financial Markets and Policy.
Senator Warner, thank you for your time.
Thank you, Ron.
It's been great to be friends with you for 25 years. Watched you as a tech entrepreneur, a venture capitalist, and then governor, and now a senator. Your work's always been focused on bringing technology into policy and leading with the nation's tech hubs, and most recently with your work in chips. And it seems that we're in a new frontier with AI now. And you have a unique role as both being on the Select Committee of Intelligence, but also on the Senate Banking Committee. And so I think you have a unique perspective to share with the audience about the intersection of AI and our financial markets. And I think everyone would love to get your perspectives on what you're seeing out there and what concerns you.
Well, I appreciate that, and let me also echo, I'm very proud of our 25-year plus friendship, and I'm proud of the work that you're doing as well. Before I get to AI and the financial markets, let me acknowledge at the front end that I can't think of a topic like AI where, candidly, the more time I spend trying to get educated, I'm not sure I actually feel like I'm always getting smarter.
Right.
There's no linear relationship, number one. And part of that because everything is happening so quickly. I think if we go way back in time to last November of 2022, the basic operating premise around at least large language models was who had the most data, who had the most GPUs, who could test that data in a way so that scale really meant something. And that from a national security standpoint in terms of competition with China, and it appeared that the OpenAI, Microsoft, or the Anthropic, Google, Amazon connections might kind of win the day. When Facebook released Llama into the wild, and you've started to see now models that say they don't have to rely on a large language model, some of the basic economic propositions around size, I think have been questioned. So let me acknowledge for everyone, I'm still learning and trying to get educated, number one. Number two, AI around the financial markets. One of the reasons why it poses such a problem is that many of the manipulation tools that AI can bring, not just deep fakes in terms of your image or voice or mine appearing in a way that's not true, but the ability to generate false consumer reports, to file false filings with the security agencies, the level of AI tools that could be brought to the table and at speed and scale are unprecedented. Much of the behavior, which is already illegal in terms of market manipulation, the reason why AI makes this potentially much, much more challenging is, again, the speed and scale which these tools can do that kind of manipulation. And candidly, Arun, I've been really surprised that the traditional financial markets, the big banks, the markets themselves, large corporates, that this is not higher on their level of concern.
As you lay out those risks, Senator, for the financial markets, what's the policy options that are available?
And that's where I'm surprised that I say this as a capitalist, that hardcore capitalists are not beating down my door saying we need to act here, because the ability to destroy public trust in the markets, we already know, and I'm sure we'll come to talk about this, AI could also, and has been destroying public trust in our elections, combined with certain political figures in our country. But the fact that this could happen in our markets at such a speed has been surprising to me. We've not heard more from our friends in the markets. In many cases, we are, at least some of the legislation I'm looking at, may not require a whole new set of laws, but it may require, because of the damage that can be done, a different level of damages. For example, we're looking at introducing the concept which already exists in the SEC of treble damages, because the damage that could be done is so extraordinary, number one. Number two, because this touches so many pieces of our financial sector, in my mind, another piece of legislation I'm looking at is really this would almost, AI seems like it's almost tailor-made for FSOC. FSOC is an entity that came out of the 2008-2009 financial crisis. The idea of let's put the regulators all together that see above the individual crises by agency. But since AI has the potential to be so dramatic in terms of change, it would seem to be that FSOC should take this on and do it in a way where they have to act quickly. And we're looking at legislation there. And then finally, and this is more kind of less the specific law and more of how to approach this from a kind of a political process, the sausage making of trying to get laws made. And I say this again with some unfortunately learned humility as somebody who's had a dozen plus ideas about putting some guardrails around social media and almost all bipartisan legislation. And we've gotten nothing done.
Right.
We don't have privacy, we don't have data portability, we don't have interoperability, I thought low-hanging fruit. So as we think about how we might get some rules around AI in the financial markets, I do think combining the interest of those who are concerned about integrity in the financial markets, potentially with those who are concerned about integrity in our elections, might be that kind of political alliance to get particularly folks in my party, some of the Democrats who may not be necessarily that focused on markets, to say, hey, there's an alliance. Both of these institutions, both of these institutions, public trust is declining already, and AI could exacerbate that decline in public trust. So there ought to be an alliance here.
And do you see parallels to the problems on the election side that you're seeing on the financial market side?
Absolutely. The same level of use of deep fakes, the fact of the notion of whether you could have watermarking so people could understand whether there has been AI tools manipulating the message you're seeing, although if there's not commonality and there's not an ability to implement actually standards here, if there were a dozen different watermarking standards and consumers just don't get it, or it becomes like the fine print on as we get new apps and we all just go to agree, it won't be meaningful. And I've said this to folks who are concerned about the election piece. Having seen our inability to put some guardrails around social media manipulation without AI tools, and we've been so unsuccessful, I've been encouraging the small d Democrats to get with the big C capitalists and see if they can find some common ground, because I think the tools, you don't need even a next generation AI model to cause this kind of disruption. It could happen tomorrow. We're seeing it already in some of the political campaigning. I've been amazed actually that we've not seen more of this manipulation in our markets already.
So President Biden had the executive order on AI. It's being quarterbacked by Secretary Raimondo. Can you maybe highlight anything in the EO that you think helps address some of the issues that you're outlining?
Well, I think the EO has been, it's comprehensive. I think it is a good effort, and it has urged our financial regulatory agencies to look at this. But the problem with any EO, not just Biden's, but any presidential EO, it doesn't really have teeth. It doesn't have an enforcement mechanism. It's guidance. So again, in a bipartisan basis, I'm working with my friend Jerry Moran, Republican senator from Kansas, and we've put together a legislation introduced this week that would say, as NIST ends up creating some of these standards around AI, that at least in terms of federal government procurement, those NIST standards would become mandatory. So can we use the purchasing power of the federal government to bring some order to some of these AI tools that's not as strong as actually legislating at a level above federal government procurement, but at least it would be a first step.
Given the work that you've done on Chips and Science Act, of also trying to recreate jobs here in America to address some of our technical difficulties or technology difficulties, shortcomings, how are you balancing that with AI? Incentivizing the best for the consumer while also trying to create jobs here in the U.S.
And that's one of the things that I feel like there is this pushback from the tech community. And I came from the tech community, we both did. And what I often hear from my tech friends is, oh my gosh, we agree in principle there ought to be some AI guardrails.
Yep.
But when words put on a page, we don't get them to agree. And then the immediate response is, well, and gosh, if we put too many regulatory hurdles, we'll slow down innovation. Now, that is at one level true, but at least so far, and if we take, again, social media, which bleeds into AI, and many of the tech companies that became the leaders in social media are now the leaders in AI, I don't think that potential threat should completely stop our process or progress. And I do think, in AI, with all the challenges, and we look at, again, China has made developments, but because they're not allowing the Chinese people to actually use the large language models because they don't want to be they don't want exposure to things like Tiananmen Square in terms of asking their models. The vast majority of AI innovation is still going on in this country. Actually, the French have done a little. There were some of the people who worked at Llama. There was a group of French scientists, but we still dominate the innovation. So this idea that any rules of the road will drive the innovation abroad, I don't think that will come to pass. And you make the question about chips. I think chips is really important. But as you know, even when you put the subsidies out there, if you don't have the trained personnel, we've still got work to do there. I'm still trying to make sure, and I've worked with Secretary Raimondo closely on this, to make sure that the large companies that are looking for the money for the fabs don't take all of the $39 billion in one fell swoop. We've got to make sure there's a supply chain. We've got to make sure an ecosystem. We've got to make sure, for example, advanced packaging, that we ought to have part of that supply here in the United States. So none of this is easy. But I do think, again, if you step back, both directionally what we're doing at CHIPS is the right thing to do from national security, from job creation, from innovation. I do think we've, again, got the lead in AI. And I just hope that we don't default to this is hard, and so we're not going to do anything. And I do fear, again, this is happening so quickly. 6 or 7 months ago, I could get dozens of senators to show up for anything that had AI around its title. I think you're already seeing senators kind of opt out, saying, gosh, this is too hard. Really? The number of people who show up, whether forums that I hold, smaller ones, bipartisan, or, I give Senator Schwimmer and his partners, Senator Young and Senator Heinrich and Senator Rounds, credit, but there's been a huge fall off on members attending their education sessions already.
And in that context, is that an education gap, Senator?
I think it's an education gap. I think it's hard. I think there is a recognition that there is no simple answer here. And the initial thought of, should we create a AI-focused agency, might make sense 30, 40 years ago. Right. But particularly with the House of Representatives right now, which is so anti-government focused, I think the reality of that happening becomes virtually impossible. So how do you create enough AI expertise in subject matter regulatory bodies, like the Securities and Exchange Commission or the Federal Election Commission or the National Transportation Safety Board? That becomes a conundrum. I do think we are going to need, and I think we could find this, and again, this I hopefully will get to some of the work you're doing. There are lots of folks who would love to come work with the government for mission's sake. And I think America got caught up in the Manhattan Project and Oppenheimer this summer. I think there's that same willingness to serve. So even if we don't create a AI-focused agency, the idea that smart people coming out of our schools would want to take on the mission of how we have a plus force that would of government workers that would help us with AI. We've got to make that sexy. We got to make that, we're not going to be able to match salaries with Silicon Valley. But I do think, if we make the call, people will come.
Look, I picking up on that point, couldn't agree with you more. Just as you know, and you were a thought leader in it, we just finished our book, Venture Meets Mission. And in it, we talk about, the need to inspire this next generation. And I recall sitting with you at a conference and you being asked, having spoke about China and AI, about what's your biggest concern going forward. And your response there was generational apathy. And it really struck a chord with me, and I think it struck a chord with a lot of folks. And I think, could you share a little bit about your concern around that?
I am concerned that
ties
whether
into what we're trying to
people
do.
will step up, whether people will believe that government can still have a positive effect in their life. And I applaud so much what you're doing, the work you've done, teaching at Georgetown, teaching at Stanford, and the notion of how you get those bright young minds to not just think they ought to go into the venture business the way we did, or go work for tech startup here, and how we make it easy enough for them to have part of their government career. It doesn't mean they've got to do it forever. And this notion of making it easy to move from the private sector to the public sector and vice versa is a great goal, especially when we need this talent for AI. I do think we've got lots of issues to wrestle with around security clearances and around the fact that how you make sure that there's not appearances of bias when you go back to the private sector, but those are imminently solvable and fixable problems. And I do applaud what you're doing in your book. I do applaud what you're doing in terms of the nonprofit you've set up to try to make this a reality.
Yeah, at Noble Reach now we have the foundation, we have a $500 million foundation to try to rebuild this infrastructure. And it's a talent infrastructure. And a talent infrastructure to take our top tech talent from universities and bring them into government service in a way that we're selling experiences. It doesn't need to be selling careers. As you're seeing the demand on the inside of government, what could we be doing from the outside to be helping place students into these agencies? Because I don't even think it needs to be all cleared individuals. There's so much more work to be done there.
Well, I do think we need a brand. We need something that if you've got that great graduate student at Georgetown, he or she needs to feel they're going to be part of something other than just going to work for the Department of Transportation. So how do you encase this experience, make it multi-year, but not, as you said, a whole career, give them some support so they feel like even if at the particular agency they may be the only computer scientist that's grappling with these issues, there is an ability for them to get together as a group. I think there have been past examples of this. We try, the digital services effort in President Obama was a good step. I think we need to make that much bigger around AI. And as somebody who's spent a lot of time working on, kind of in the weeds issues like security clearances, because one of the things we found, and not all of these positions need to be cleared, but when it takes a young person sometimes over 500 days, if they wanted to go join the CIA to get that initial clearance, we're chasing away talent, and that's going to become even more of a challenge as we try to recruit this talent into AI.
So on an optimistic tone, what can you talk about the positive of AI with financial markets?
It has huge opportunities. As we think about AI in terms of better honing some of the rote functions that we still perform and making people actually more productive. I think there's going to be an up and a downside on that. We're already seeing call centers in some cases being eliminated. Offers enormous potential. Speeding the path of innovation is hugely important. I know some tech friends now who are working on AI tools that would help Ukrainians, frankly, use their drones more effectively to help break through the front lines against Russia. I mean, these tools have a huge upside, but I also think one of the things we need to be is techno-realist. I think for a long time, we became such techno-optimists. First 15, 16 years of this century, and both political parties were part of that we did sometimes turn a blind eye that with every techno-optimism, with every social media positive, there was also a downside. And being techno-realist now is something that I think can embrace the optimism, but also put some guardrails in place so that we can at least be conscious of the possible downfall.
Well, Senator, on a personal level, on behalf of Georgetown and behalf of our audience, thank you for your leadership on these issues, on the Banking Committee, your leadership on AI, and please let us know how we can help.
Well, Arun, one of the most important things you can do is build out Noble House. Let's make that mission known across every campus in America, that there is at least part of your life can be done doing public service. And I think there are models. There's no matter how depressed I get, if anytime I get together with the folks who are the interns in my office here, they give me hope that at scale for folks who've got knowledge in AI, helping in various spots in government for a part of their career is a mission that I'm grateful for your leadership on, and we're going to get done.
Gratitude for your partnership.
Thank you.
So there's a fantastic message for our students in the audience there, that there's a real role for you to play in public service, and especially in these emerging issues. Next, we're going to have a presentation from David Leonhardt on his new book, Ours Was the Shining Future. It's the story of the American dream. And I'm going to ask Damien Duin to come introduce David. Damien is the founder and chief executive of Lafayette Square. Previously, he served as co-founder and co-CEO of Brightwood Capital Advisors. Damien began his career at Goldman Sachs in New York and in London. And before that, Damien was also at Credit Suisse. You know, what I'm really impressed by, I should tell you, first of all, that Damien is a former student. So it's such an honor to present my former student here. But I'm really proud of the work that Damien has been doing. He's a capitalist, but he's really become a thought leader on issues related to mass incarceration, and he's trying to use capitalism for good, right? And he's really become a role model on these issues. He's written for the Financial Times, for Entrepreneur, for Inc.com, and he serves on the board of several nonprofits and has made this his mission. He is a proud Hoya and got his undergraduate degree here at the business school at Georgetown University. So welcome, Damien. Damien is going to introduce David.
Thank you for that, Professor Agarwal. We're so pleased to have David Leonhardt at this year's FMQ conference. David Leonhardt is one of our country's preeminent journalists and writers on the economy and has worked at the New York Times for nearly 25 years. He currently authors The Morning, the Times' flagship daily newsletter, and writes for the Sunday Review. Prior to joining the Times in 1999, David worked for Business Week magazine and the Washington Post. David has previously been an op-ed columnist, Washington bureau chief, co-host of the Argument podcast, founding editor of the Upshot section, and a staff writer for the Times Magazine. He also led a strategy group that helped Times leadership shape the newsroom's digital future. In 2009, David won the Gerald Loeb Award for magazine writing. In 2009, for his New York Times Magazine article, Obamanomics. In 2011, he received the Pulitzer for commentary. He recently published a new book entitled Ours Was the Shining Future, the Story of the American Dream, where he examines the history of the American economic engine from the Great Depression to today's Great Stagnation. The book traces how democratic capitalism once flourished to make the American dream possible, but by the end of the 20th century, the dream evolved from one that promised prosperity for most into one that favors the individual and the privileged few. Please join us during the networking reception up in the Fisher Colloquium, where David will be signing copies of his book. But first, please join me in welcoming David Leonhardt to the stage to discuss his new book, Ours Was the Shining Future, the Story of the American Dream. David.
Thank you, Damien, for that generous introduction. Hello, everybody. Thanks for having me. I set out to write a biography of the American dream. And my basic idea about that was that, like some historical characters with famous names, almost everyone has heard of the American dream. But I think the backstory behind it is something that often is not well understood. The phrase the American dream dates to 1931. Before that, if you look through old newspapers, and I spent a lot of time looking through old newspapers when writing this book, you would occasionally find the word American next to the word dream, but it was sort of accidental. It's not the way we mean American dream now. The phrase that we use now dates to 1931, which is remarkable because the phrase American dream was coined really very close to the depths of the Great Depression by a historian named James Truslow Adams, who defined it as that American dream of a better, richer, happier life for all our citizens of every rank. And he said it was the United States' greatest contribution to the world, that idea. And even almost 100 years later, I love that definition because it contains so much about the ways that we still think about the American dream. Better, richer, happier life. Embedded in that is the notion of progress. Your life gets better over time. Your life is better than your parents' lives were. Your children's lives will be better than yours. It also embeds the notion of social mobility. He said it should apply to all of our citizens for every rank. And he noted that it was distinctly American, that in much of the world it was natural to stay roughly in the circumstances of your birth, but not in this country. And what I wanted to try to do was ask the question of how well are we measuring up to his definition of the American dream? My book is a book of stories. It's a book of people whose names are well known, but I think their full significance is not, like A. Philip Randolph and Robert F. Kennedy and Robert Bork. It's also a book about people who are much less familiar, like Ann Gorsuch and Grace Hopper and Carl Skoglund. I'm not going to tell you those stories in the few minutes I'm up here, but I just want to give you a brief sense of the frame for my argument, which is really an attempt to help people understand the biggest forces that have been affecting the American economy. And I would argue we have not been living up to the basic definition of the American dream, of a better, richer, happier life for all. You sometimes will hear pundits, people with jobs like mine, or politicians, including President Biden, say, why aren't people happier with the condition of the American economy? Our unemployment rate is low, our GDP growth is pretty good. By some measures, our GDP growth has moved the United States past the countries of Europe. We've opened up a bigger gap in recent years. But I think when you actually look at the ways that people measure their lives, if you look at the things that affect people's day-to-day living standards, life in this country really has stagnated over the last few decades. You can see it in the income and wealth measures. Income growth for the bottom 90% of earners has trailed economic growth in recent decades. Wealth growth has been very slow. Various measures of social well-being, like the percentage of children who grow up with two parents, or the percentage of Americans who suffer chronic pain, or the percentage of Americans who lived behind bars at some point in their lives, those have all worsened. If you look at polls and ask Americans, how do you feel about our country and our economy? It's not just now that people are grouchy. It's been almost 20 years since most Americans thought that our country was on the right track. And I know there have certainly been improvements. There are less of many forms of discrimination. We have these amazing computers in our pockets that let us listen to any song or read any book pretty much all the time. But to me, if there were any doubt about the idea that life expectancy, that living standards have stagnated in this country, it is life expectancy, which is in many ways the most basic measure of how well a society is treating its citizens. In 1980, which is really the beginning of the modern economic era in so many ways, the United States had a typical life expectancy for a rich country, similar to much of Western Europe, Canada, Australia. Today, and for most of the last 2 decades, we've had the lowest life expectancy of any rich country in the world, lower than all those countries I just mentioned, every country in Western Europe, Canada, Australia, Japan, South Korea. It's the first chart in my book. It's really not that close. We trail those other countries by a significant amount in life expectancy. And it was not ever thus. There's not something inherently American about having low life expectancy. Within the lifespans of most of us, the United States had a relatively normal life expectancy. So why is that? That is in many ways the central question that I tried to answer. And since this is a bipartisan conference, I will say some critical things about both parties. I think that the Republican Party, not all of it, but much of it has remained wedded to that same economic model we've had since the 1980s, which I think when Milton Friedman and Ronald Reagan offered it was a reasonable diagnosis for a way to restart the economy after the problems of the 70s. Get rid of labor unions, reduce regulations, reduce taxes, specifically on rich people, let companies grow very large and let them become very efficient. That's what they said they were going to do. That's what they did. They promised that would lead to greater prosperity for all Americans. I think through the numbers that I've just gone through, you know that I'm going to argue it has not led to greater prosperity for all Americans. It's helped lead to this era of stagnation that we've had. Now, I said not all Republicans. I think it's important to point out that there are significant parts of the Republican Party that have begun to question this laissez-faire or neoliberal model. You can see it in Marco Rubio saying that labor unions are important. You can see it in Josh Hawley questioning whether companies have gotten too big. And although Donald Trump's economic policy is not particularly consistent or coherent, you can obviously see it in Donald Trump's questioning of things like trade. And his really rejection of much of what we thought was the Republican Party. But for the most part, large parts of the Republican Party, including the current majority on the Supreme Court, including much of Congress, including many of the ways that Trump governed, still do take as faith this idea that this laissez-faire economy is good for most Americans. And I just don't think the record supports that idea. The Democratic Party, meanwhile, has managed to alienate so many working class Americans, who I would define roughly as the Americans without a four-year college degree, which is the majority of Americans, about 60% of adults. The Democratic Party has alienated so many working class Americans that while it claims to speak for them and claims to be in favor of an economy will help them, many working class Americans look at the Democratic Party and say, that's not a party I want to be a part of. They feel that the Democratic Party is deeply judgmental and often harshly judgmental on a long and growing list of things. So for a long time, Democrats said, if we reopen schools in the midst of COVID, we'll be killing people. It turns out in retrospect that we almost certainly kept schools closed for too long, and many Democrats were wrong about that. Many Democrats have told people that if they're concerned about crime, they're just wrong, and that crime and disorder are not actually problems in American cities. If you've been to any American cities lately, you can sort of emerge asking, who are you going to believe the Democratic Party or your lying eyes? Crime has risen, disorder is a problem. And on immigration, the Democratic Party has moved extremely far left, arguably farther left than any major party around the world. The Democratic Party is very uncomfortable with many ideas involving border security. For a long time, the Democratic Party said the only way people can't be with us is because they don't understand their own interests or because they are hateful. And it's important to say that the Republican Party has often engaged in race baiting and, in fact, outright racism in recent decades. And that has lost a significant number of voters from the Democratic Party who harbor these similarly alarming views. But I think it is a deep, deep mistake for the Democratic Party to say the only reason people could not vote for us is because they are ignorant or hateful. And I've thought this for a long time, but I think the last 5 years have really proven it out, in which large numbers of Latino voters and large numbers of Asian American voters and a few percentage points of black voters, more if you believe the recent polls, have actually moved away from the Democratic Party. And those voters are overwhelmingly working class voters, voters who do not have a four-year college degree. This is the same group of people whose living standards have stagnated in recent years. A recent survey of voters in Texas, specifically Latino voters, conducted by a progressive firm trying to figure out why they moved to the right in the 2020 election, identified two main issues. They're two of the issues I've mentioned. These voters were frustrated that the Democratic Party was against reopening the economy during COVID, and they were frustrated that the Democratic Party didn't take border security more seriously. And so I've just sort of laid out a somewhat grim litany of economic facts and the lack and our political system's inability to respond to them. But I actually emerged from the experience of writing this book deeply hopeful. And I did because I think the experiences of the last 100 years suggest that as a country, our political system is not completely rigged. It actually does have enormous capacity to change our country. And Damien mentioned this idea of democratic capitalism, small d democratic capitalism. I think it's a profoundly important idea. It's a version of capitalism that acknowledges the many, many things the market is good at and also the things that the market is not good at doing. And when you look at our country over the last century, you see that small d democratic movements have transformed this country again and again. The labor movement transformed this country and created an economy in the 40s and 50s and 60s, really did produce prosperity for all. And by the way, in the 40s and 50s, the black-white pay gap and the black-white life expectancy gap were falling, even before the great victories of the civil rights movement, in large part because unions were beginning to allow black members to join them. The civil rights movement is another democratic movement that changed this country. The women's movement, the disability rights movement in the 1970s. Those examples tend to come from the political left, but there are also examples from the political right. The anti-abortion movement did not respond to Roe v. Wade by saying our political system is hopelessly rigged and give up. It organized. It basically took over the Republican Party. It got laws changed in local areas. It got friendly politicians elected, including in Washington. And it eventually got the Supreme Court to overturn a law that it did not like. More recently, if we were sitting here in 2000, how many of us would have thought that marriage equality, same-sex marriage, would be legal as quickly as it has become legal in this country? So when I look at recent history, I see enormous reason to believe that actually our political system and our democracy can be responsive to change. It can create grassroots movements that change public opinion and change the law. To me, the problem is not that our system is totally broken, is that we have not had a political movement on either the right or the left that has been devoted in recent years to lifting the material living standards of most Americans. And I actually, despite all of our problems, emerge optimistic that if we did have that movement, if we did have a movement that spoke for working class people, that appealed to them, and that tried to put in place policies that would improve their lives, the same way the lives of many college graduates, like me, have improved in recent decades, I still think this country has the ability to create an economy that works for all its citizens. Thanks so much for listening.
Thanks.
Good. All right. Hello and welcome to the Regulatory and Policy Roundtable, a conversation with CFTC and SEC commissioners. My name is Mike Pivovar, and I'm a proud member of the advisory board of the Psaros Center for Financial Markets and Policy. It's my pleasure to moderate today's discussion with three members of the two federal agencies charged with regulating our financial markets, the Commodity Futures Trading Commission and the Securities and Exchange Commission. Christy Goldsmith-Romero and Summer Mersinger have been CFTC commissioners since March of 2022. And Hester Peirce has been an SEC commissioner since January of 2018. So let's get right into our discussion. One of the nice things about this annual conference is that we discuss emerging issues that are out there. Over the years, we've talked about things like financial crises, flash crashes, development of digital assets, blockchain technology, just to name a few. And currently, one of the subjects of the topics that have been discussed at a number of the sessions earlier today is the development of artificial intelligence and new applications in finance and how that's affecting things. We had earlier today, we had the CEO of the London Stock Exchange Group, David Schwimmer, who pointed out on the one hand, there's a lot of opportunities to do some responsible innovation and gave some examples. On the other hand, there's some risks. And he pointed out the fact that AI just allows you to make the same mistakes, but with a greater confidence than you had before. Related to that spectrum of the opportunities and risks, President Biden recently signed an executive order to, quote, ensure that America leads the way in seizing the promise and managing the risks of artificial intelligence, unquote. So I'd like to get our panelists' views on what they see as the opportunities and risks from a financial markets regulator's perspective to the financial market. So Commissioner Goldsmith-Romero, let's start with you. How are you thinking about AI developments in the commodities and futures markets?
Well, first, let me say thank you so much. Thank you, Mike. Thank you, Rena. It's so great to be here. I'm on the panel here with three good friends. So this is really terrific for me. I'm going to give the standard disclaimer that we're all going to give, that the views I'm about to give are my own as a commissioner, do not necessarily reflect the views of the commission or my fellow commissioners, no matter, sometimes I do try to convince this one. So I work a lot on responsible AI for the CFTC, because I sponsor the Technology Advisory Committee. And so that is a plug for students that we are working on responsible AI and doing cutting edge stuff. I have gotten through the entire EO, but I've been coordinating with the White House and a lot of other regulators on this area. So when you think about AI, it's really a consequential technology. If you think about the idea of the tremendous opportunities of sort of how it could address all these kind of bad things that we think of, just think about potential for healthcare or national security. But then there's this idea of like, there's one side of the coin is promise and there's one side of the coin is peril. And so how do we manage those risks? And I think as financial regulators, we shouldn't be scared of technology. I mean, otherwise we would be still trading in the pits and not having electronic trading that transformed our markets. So we really are kind of looking at this and saying, okay, how do we get the promises of it while avoiding the perils? AI has been around for a long time in our financial markets, for a long time in a lot of different areas. And it's really generative AI that has caused a lot of conversation. And really, when you look at it, you're just not sure where it's going to go. And so I sort of start with this. Well, we have to increase our capacity as the government to be able to understand that. We need to be in a lot of dialogue, as I am. I'm in a lot of dialogue with people who have talked here before, and our exchanges and our clearinghouses and our brokers and our financial institutions, asking them about what do they use AI for, how they think about using generative AI. When we sort of look at what responsible AI is, this is essentially, it's going to be aligned with the interest of many stakeholders. You're going to use it in the logic and the decision making and the outcome need to be transparent, need to be explainable, need to be audible by humans. You want to make sure it's unbiased data. You want to make sure it's used in a way that minimizes harm. We just heard from the senator about the potential for market manipulation. That would obviously be a harm that you would want to minimize, along with sort of issues with bias that have come up in our financial system. So as I think about it in terms of financial markets that we look at, there's a lot of discussion that I've had with our market participants and our registered entities about the use for automation, efficiency, accuracy, transparency. If you think about back office functions, if you think about regulatory compliance, I think about what it could do for anti-money laundering, as I've conducted a number of money laundering investigations. And so when you think about other things, and you think about that promise and peril, you think, okay, if someone says, well, I want to use it to speed up trade settlement to T0. Okay, so then the question becomes, what are we losing potentially in those speed bumps that will then be gone? And so then we have to really sort of analyze that and figure that out to see where there's risk. Or if you look at, we're just going to use AI to make margin calls. We're going to maybe potentially lose some of that human judgment that goes into making that decision, and you could potentially knock someone out of their hedge and potentially increase risk and potentially financial stability. When you look at models, I think a lot of people get super excited about models, particularly in the climate area, but also in like looking at exposure, looking at risk, trying to see where risk could bubble up. You've always had model risk, right? It's always about where you get the data from, what are the assumptions in the data, and then when you look at things like giving investment advice, solely using AI, you're going to say, well, are there fiduciary duties or other regulatory duties that you have to do? And then it's really the government. I mean, I've got an enforcement background, so what we could do in terms of surveillance, market oversight, finding fraud, market manipulation is pretty excited. But then we have to like practice what we preach, right? Like we also have to do it safe and secure and responsible.
Good. So thank you. So Commissioner Mercinger, your fellow commissioner, put up a lot of good things on the table. How are you thinking about it?
I'm actually very similar to what Christy said. I'll start with my disclaimer. Yeah. Sometimes I forget. I'm glad I have you here to remind me of my disclaimer. But the views I expressed today are my own, and they do not necessarily reflect the commission or my fellow commissioners. But I think Christy's doing a great job of digging in on this issue through her advisory committee and really looking at AI both, within our markets and where it could be helpful, but also within our agency. We are a congressionally funded agency. We're a small agency. We need every opportunity we can get to be able to, make our resources go further. And I think AI could really help us do that. So, I also am thinking about where can this be of use in our agency? How can we use it in a way that helps us better do our job? As she said, AI has been around. This isn't brand new technology, but sometimes you get technology that's maybe wrapped in new terminology that we haven't seen before. So we need to just make sure we are thinking through that and that we're understanding it and engaging with the public and stakeholders so we don't get frightened off by the new terminology and, suddenly just say, no, we're not going to allow this in our markets. Because that would be just tragedy, because I think it has so many opportunities. Yes, there are a lot of downfalls, but there's a lot we can do with this technology in the financial services markets, both from a market efficiency standpoint and then on the flip side from a transparency standpoint and the work we do, trying to make sure that those markets are vibrant and reliable, and also they're not subject to fraud and manipulation.
Yeah, so let me pick up on that. So to your point about, it's been around for a while. It's a new terminology. It's a new technology. Commissioner Peirce, your colleague, Gary Gensler, tends to focus on the risk side of the equation and argues that an AI-caused financial crisis is, quote unquote, nearly unavoidable without strict new regulations. How do you think about balancing that? Are you more in the camp of Commissioner Mercinger, which is, hey, this is new technology, or Commissioner Goldsmith-Romero, we need to dialogue more with folks, learn more about this, think about responsible innovation, or do we need a whole set of new regulations in this space?
Well, thanks, Mike, and thanks to Georgetown. It's wonderful to be here. I, too, will give my disclaimer, which is that my views are my own views as a commissioner, not necessarily those of the SEC or my fellow commissioners. And this is an area where I don't see the world exactly the same way that Chair Gensler does in terms of seeing the inevitability of a crisis based on AI. I do understand his point in the sense that if you're using AI technology and there are only a few providers of AI technology, and there's something wrong with it, then it could affect the whole market because everyone's using the same few large providers of AI technology. So I think that's something to pay attention to. The interesting thing, though, is that when you think about regulatory solutions to that, you have to be very careful because your regulatory solutions could end up making it even more likely that these three providers, or however, this handful of AI providers ends up becoming the go-to set of providers for everyone in the financial industry. So, for example, we have a rule proposal out around predictive data analytics that would cover a lot of technologies. AI is roped into that. And I think one of we're proposing to build a lot of processes around how people in the financial sector use those technologies, broker-dealers and investment advisors specifically. And by building so many processes around a decision to use one of these technologies, you actually could make it much harder for a new provider to come in and compete, because people are going to want to use the same ones that everyone else uses to sort of say, look, we're doing what everyone else is doing, so don't come focus on us with your enforcement lens, because we're just in the same pool with everyone else. So I think keeping barriers to entry low in terms of AI service providers is a really useful way to prevent us from ending up in the kind of circumstance that Chair Gensler is talking about. That said, I think it does make sense to be vigilant. As Christy and Summer have both said, there are opportunities and there are risks. We need to think about new technologies, thinking about what the unique opportunities and risks are, and that then informs how we regulate the new technology and how we use it ourselves.
Yeah, and to your point about making sure we don't entrench sort of the incumbents in this space. In the earlier panel, on the market structure panel, Jeff Davis from NASDAQ said that his point was that the SEC was deviating from its longstanding approach of being technology agnostic and sort of tipping the balance. It sounds very similar to your concerns in this area.
Yeah, I think we really are sort of taking a new approach to the technology that would potentially even throw aside tools that we've traditionally used, such as disclosure, and say, no, that's not enough.
Okay. So Commissioner Goldsmith from Maryland, let me come back to you. So you talked about the importance of having dialogue with folks, and you talked about your advisory committee. Can you spend a few minutes explaining what an advisory committee is for folks out there, how you get this information, and then with the caveat that you're still gathering information, have you identified any areas where you think your agency needs new authority, would need new authority to come from Congress for you to do what you want to do in this space?
So the CFTC has advisory committees, the SEC does too, and so we have, we need a broad, diverse representation of stakeholders who come in and advise us on things. So this could be industry in some way, it could be academics, it could be all kinds of things. What I did when I took over the Technology Advisory Committee, which was really a lot of the same lobbyists and lawyers, was I just wiped it all clean and put actual technology experts on. So we actually have experts in responsible AI. They are not experts in responsible AI in financial services, because I'm not sure that exists yet, although it will. But I think they're just experts from Brookings, from IBM. And then we have others who are fintech experts, like CEOs and founders of technology companies, that kind of thing. So what we have done is we have held 2 public meetings already about responsible AI, what that means, and what are sort of the standards or principles that are being discussed out there that could potentially guide it. A lot of this may be very high level. The senator talked about NIST, right? NIST is a principle-based standard. I'm a proponent of NIST applying in the space of AI. It's very flexible, but it does create certain standards like governance, which you have to look at and say, governance means who's making the decision on the deployment of AI and who determines whether that's responsible and what the parameters are. I think there's going to be a lot of existing regulations that already apply, and this is always the case when we're talking about tools, right? You're going to have risk management, you're going to have oversight over third parties. There's going to be operational resilience requirements, but I think the idea of saying, this is what we need to have is really tough right now. This is changing constantly. We don't even know all the use cases. We don't know the stakes. We don't know everything that's happening is being, it's interesting. The senator was saying that he was surprised that when he was talking to some banks, he wasn't getting like, here's our plan. I'm getting the same thing. Like this is how we're starting to think about it, but it's very broad. And so I think if I'm invited here next year, the landscape will have changed entirely, right? I mean, that's what I think. I think as as people and companies and industry and regulated entities start to actually implement it, they're going to come up with their own concerns, their own controls. They might say we're going to implement the NIST framework or something like that. And I think this is a really good situation where regulators need to just continue to be in a dialogue with our registered entities so we have an understanding. And if we need to issue clarifying guidance, we can, but I don't know yet on new laws, but high principle frameworks are something that I'm very interested in, like the NIST framework.
Okay, so too early to tell. Commissioners Mercinger and Peirce, are you in that camp, or have you identified areas already?
I completely agree with Christy, and I don't ever like to say, yes, we need more regulations, yes, we need more laws, because that's just not my nature and what the approach I take to things. But it's just too early to tell. We have a lot of education and understanding that we need to do as regulators before we can really decide what steps we may need to take.
And I don't think we need new authority. What I do worry about in this space is that people are a little scared, and so I think they want to move to a model of permissioned innovation. I'm very much a fan of permissionless innovation. Let people try things. You obviously have to comply with the existing regulatory structure, but we don't need to set up a new gating mechanism for AI technology.
All right, great. All right, let's move on to another very topical issue, climate. The Biden administration from the beginning has prioritized climate risks as a focus, not just in other parts of the government, but for financial regulators like no other administration's ever done. So it's just as one example, the Treasury Department, the Treasury Secretary, who acts as a coordinator among the financial regulators, among other duties, appointed the first ever climate counselor and established a climate hub in the office of the Secretary to set the strategic direction of Treasury's climate work and coordinate information sharing across the agency. So Commissioner Mercinger, let me come to you first. What's the proper role of the CFTC when it comes to various climate issues?
Well, I've always found this discussion interesting. I grew up on a farm, and I always say, I grew up in a situation where there was climate financial risk all the time. I mean, my parents' livelihood was growing crops in the ground, and you could have a hailstorm or a tornado come through and wipe out your entire, everything that you could possibly, make for the year. So, and there's a lot of tools in place that farmers use to, kind of manage this risk, whether it's crop insurance or hedging in futures markets. So I've always been interested in when people are saying, this new financial risk that comes from climate, I've always said, I don't know if it's new, because given my background, we've always had this financial risk, and it's very real risk. So when I look at our role at the CFTC, I think about how our markets can be used to manage and hedge that risk. Like I said, farmers have been using our markets to hedge risk since the beginning of our agency. That's not going to change, and really, as we see more extreme weather patterns, I think that just means our markets are going to become more important, and a tool that we really need to make sure is available and provides the mitigation resources so that farmers and ranchers can hedge those kind of volatile times in their production. So I really look at it as, making sure that our markets do what they're supposed to do, offer price discovery and hedging opportunities. And we do have climate-related products that are now trading on a number of our registered exchanges. There are futures products on voluntary carbon markets. Again, our job is to do what we do with all of our products. Make sure that the products are not, susceptible to manipulation. Do what we can to make sure that they are liquid and that they are able to help with price discovery, and again, allow people to hedge. So that's really, I don't think we have any new
responsibilities. I think that our markets were designed to help manage risk, climate risk included.
Commissioner Goldsmith-Romero, your views.
So let me tell you how fun it is to work with Commissioner Mersinger. So this year,
I don't know what story she's
I don't know. There's so many stories.
I'm scared.
This year, no. This year, the two of us, we went to a grain elevator that was on the Missouri River. And, there's a chute that shoots the grain from the elevator out into the barge on the river. But because of drought, the water levels were low. Now, just so you know, the Mississippi had such drought that barges were stranded this year. So that's like food rotting, right? And then they can't get it through. So we're talking to, and this is a registered entity with us, and they're explaining to us the difficulty. Like, look at the line on the barge; it's only at 4 feet. We can't fill this barge, right? We're going to have to half fill the barge, then we're going to have to truck grain, then we're going to have to move this barge downriver to where it's deeper. Pay to have the trucks, find another way to shoot it into. This is real world, right? And this is what we've been learning in this role, which is really fascinating. So then the next question becomes, okay, so what do you do? How do you hedge that risk? This is a very real risk. And so, look, I'm a markets person, right? So when I was confirmed, I said my number one priority is make sure these markets are working well. These markets are there, to help manage this. As Summer said, these markets have long been used by agriculture. Energy also use it. Winter is coming, not to quote Game of Thrones, but there's going to be issues that come up with things like our power grid and storms and all that come with that. And so, my priority has been ensuring that our markets are resilient to climate risk. And a lot of that is really kind of understanding what that risk is. One of the things I did was I worked for more than a year with the National Futures Association to go to their largest members, a lot of banks and brokers, and understand how they are accounting for climate risk. And what we learned in this special project was it wasn't a standalone risk. It was just embedded in all the traditional risk: credit risk, market risk, liquidity risk, counterparty risk. And then I have spent time talking with our exchanges and our clearinghouses about their stress testing that they do related to climate. I've called for more stress testing for scenario analysis of our largest players so that we can understand this more. But, we spend a lot of time with our economists. Each time there's a climate event saying, okay, what are the impacts on the market? Let's track it. This is very real for us. On top of that, so that's physical risk, right? On top of that, you've got transition risk with the transition to a lower carbon environment. And our markets are being used for that. Number one, we have metals and minerals markets. So the electrification of America depends on that. Story two, the two of us standing on the edge of a copper mine in Utah, and then meeting with traders in copper, and then meeting with one of our large exchanges who just released some different lithium and what's called molybdenum futures contracts, and that all relates to batteries and all that. So these are things we're actively looking at, along with just our regular derivatives products that can hedge things like interest rates for investments in the IRA or that. And so these are the types of things we're doing. On top of that, I do have an enforcement background. The market integrity part of this is important. We are in this space, and so I advocated for, and we just launched an environmental fraud task force. I've been working very closely with them to bring integrity to the market. So we have a really special area, I think, that we're doing, and it is very real, and it's been really terrific to work with Commissioner Mersinger with her background, to understand it, and then to get out to real people and see, okay, well, how are you using the market to help with that?
Wow, so when I was at the SEC, I always thought it was cool going to a trading desk or an exchange, but you guys get to go to like grain elevators and copper mines and stuff, and put on hard hats and everything?
I was a little worried Christy was going to tell a story about the time when you inadvertently kidnapped a senator in Arkansas, but
we
that was. But she also set up.
We did.
It's a story for another day. But she
story for another day.
Yeah,
set up
this is how you get
really
invited
good,
back next year.
Yeah, exactly.
You'll have to wait, Mike, next year for the story.
She set me up for my advisory committee, the energy and environmental markets, and we are looking into metal markets and also physical energy infrastructure and how that will impact the derivatives markets. So thank you for that.
Good. So before I come to Commissioner Peirce to get her views on the SEC's proposed climate risk disclosure rule, earlier this morning, Chair Behnam made news. In fact, right after his panel, Politico came out with a story on this. Commissioner Mercier, you mentioned the voluntary carbon markets. He made news saying that the long-awaited guidance may be coming out at the end of the month, and that you all had just gotten the guidance recently. Any comments on that?
So, I mean, I've been working on the voluntary carbon market area for a while. I talk a lot about this. It's a market that's very fragmented. It doesn't, there's not really standards. It doesn't have a lot of investor confidence. And so you're seeing the demand really drop as opposed to it being used as a tool or an opportunity in the transition to a lower carbon environment. So I've been calling we have voluntary carbon credit futures contracts that trade on our exchanges. I have met with the exchanges to discuss with them what are the standards that are in place. This is a long-standing issue that I've had that I do think we need to have some guidance on exchange listing standards in that. I'm looking forward to seeing that and commenting. There are standard-setting bodies out there like the Integrity Council for Voluntary Carbon Markets that former SEC Commissioner Annette Nazareth heads up. Spent a lot of time talking with Annette about that. But it's a tough space, but it's one that we are in and we are regulating it. And so if we're going to be in there and regulating it, I do think we need to work with the exchanges on their standards. So it's been really another one where there's a lot of dialogue.
Commissioner Mercier?
I'm still reviewing it. I think what's most important to me is that we need to remember that, yes, we regulate the exchanges who are offering derivatives on voluntary carbon markets, but we don't regulate the underlying spot market or cash market for those voluntary carbon credits. So any guidance we are giving needs to be directed at our registered and our exchanges versus to the voluntary carbon market itself. And we also need to make sure people understand that we are not regulating that spot market. We do have fraud and manipulation enforcement authority, but we're not looking at that spot market day to day. And that, that's something that people need to just be aware of, that, I don't want us to somehow say that we're going to be policing this space now. Because we have futures products trading on it. So that's kind of the way I'm looking at it.
Great. All right. So Commissioner Peirce, so we mentioned the SEC has a rule proposal outstanding, the so-called climate risk disclosure rule proposal that would require certain public companies registered with the SEC to provide certain climate risk disclosures. There's a lot of people who have been critical of that rule. You are one. And so why do you think this rule is not an appropriate use of the SEC's regulatory authority?
I just think it's unnecessary for us to look at a particular area and have a particular risk area and have particular disclosures tied to that. So while CFTC commissioners are at the Mississippi and visiting mines, I'm over in Europe talking to European bureaucrats about how we should use our capital markets to channel capital toward the transition, right? And my view is that this is really a way of, it's a really, really interesting thing to watch, right? It's central planning through climate change disclosure regulation. And look, I have no qualms or no problem with market participants looking at interesting new technologies and ways that we can deal with climate issues and other issues that we're confronting as a people. But the best way for that to happen is for capital to flow voluntarily based on decisions made by private market participants, not decisions made by a regulator like me saying, here's how I think boards of public companies ought to be thinking about climate. And I think we need to be really careful that we're not falling into what is happening in other parts of the world where government regulators really are using a disclosure framework to shift capital flows toward technologies they think will be transformative, rather than allowing it to flow to the technologies that we can't see now, but actually will be transformative.
So your fellow panelists have given some examples of how the CFTC does have a proper role in some areas. And is there any area in which the SEC does have a proper role?
I mean, look, companies are already making climate-related disclosures, and our staff and in our Division of Corporation Finance looks at those disclosures along with other disclosures. Companies that are facing risks that are related to climate change or climate transition are already, if those are material risks, they're already telling us about those, and that's disclosure that our staff reviews and sometimes pushes back and asks questions on. I don't see the need to do anything else. Now, obviously, we have this proposal out in front of us. A lot of market participants have come and said, yeah, we'd like to have just tell us what we have to disclose. And there have been certain representatives of investors or often it's large asset managers who come in and they want climate data from public companies because they've made promises to be part of net zero efforts. So they want the information for their use. And look, I get the desire to have just one set of rules you have to answer to when it comes to disclosure around climate. But one, private climate standard setters are probably not going to leave. And two, just because you stick something in an SEC rulemaking doesn't mean that you'll get comparable and accurate information. So I think the rules that we have work, but I'm open. We're wading through a lot of comment letters. And so we'll have to see how the final rule comes out, and then I'll assess whether that's the way to go or not.
Great. So we have a couple minutes before we open it up for questions from the audience. I want to switch to digital assets, cryptocurrency. So there's been some discussion in some earlier sessions today about the two big bills that are working their way through Congress. So one is the broader digital asset market structure bill, which would deal with the vast majority of digital assets, so-called cryptocurrencies. And then a second bill, it would focus just solely on stable coins. So Commissioner Peirce, let me start with you, since you are known as Crypto Mom, based upon your interest in this, literally Crypto Mom, and you have thousands of Twitter followers because of this,
yeah,
right?
But most of them now call me evil crypto stepmom.
So it sounds like a Disney movie, right? So,
could be.
Yeah, there you go. So I'd love, there's been so many calls to provide legal clarity for digital assets. What's your view on both of these bills?
Well, I'm happy that Congress is looking at whether they think, where they think authority should lie around crypto assets. We at the SEC have not handled this area well. And as a result, I think you've seen more people get harmed than otherwise would have if we had had a framework in place. There's some things that we could have done ourselves without having a new statutory framework. There are other things for which a new statutory framework would be helpful. But I'm really enthusiastic to see that Congress has taken this on. It's a bipartisan issue. You've got a lot of people on both sides of the aisle who are seeing the value in having some sort of a regulatory framework in place. And so I'm excited to see what comes of that. But in the meantime, I think we're continuing down the track of trying to use our enforcement authority. And frankly, I think the CFTC is doing some of this too, using enforcement authority to try to mark jurisdictional territory. And those are the kind of situations where it really is helpful for Congress to come in.
Good. Commissioner Mersinger?
Yeah, this is one of those areas where I will say, we do need some legislation. We do need some new statutes because there is this kind of lack of clarity, and I think the only way to get there is through the legislative process, and I'm more comfortable with the legislative process. Those are elected officials who have, a responsibility to the constituents to take all sides into consideration and hopefully come up with a compromise. Unfortunately, the way we've been approaching it to a certain extent is we are
making these decisions through enforcement cases, a lot of times settlements. And that doesn't provide the market any clarity. That's it doesn't help, continue to, the innovators pushing them forward, but in a responsible manner. So this is an area where I do think we need legislation. I think there's been a lot of really smart people looking at this on the Hill for years now. I think at some point we'll see a lot of this legislation maybe kind of come together in one bill. And hopefully it does have some sort of framework where we can work with the SEC and with other financial regulators to maybe lay out some parameters, because anything can be tokenized, and even traditional assets that fall under regulators, it could be tokenized. That doesn't mean that it needs to go through a new regulatory regime. So how do we define that? How do we do that? So I think we'll get there. It's just there's also a lot of fraud in the name of crypto. We had our enforcement results out at the end of the year, and there was this discussion about this large number of crypto-related fraud cases we brought. I would say a lot of those involved no crypto. They said they were going to buy crypto. They just took your money and left. Mm-hmm. So, is that crypto fraud? Not really. That's just run-of-the-mill fraud. So I think we have to also remember that, when you have a new area where there's not a regulator looking at kind of what we call the cash markets, it's a lot easier for the fraudsters to take advantage of that. And people want to put their money here, and unfortunately, there's a lot of people getting taken advantage of. So hopefully we'll see something from Congress in, maybe a year or so. I don't know for sure. I never try to guess what Congress is going to do, but hopefully it's coming.
Yeah. So Commissioner Goldsworth, real quick, we're going to go to Q&A, and if we give priority to students first, that would be great.
I'll keep it really short. I'm glad Congress is looking at it. I certainly think that there is a need for some legislation. There are some regulatory gaps. I mean, I think the federal government as a whole needs to also do a better job at trying to work together on this. I just don't want people to get hurt. And so, I welcome legislation. I don't want to comment on any specific legislation. The other thing is I think we can do better on issuing some guidance ourselves. One of the areas that I've called for that is related to affiliated entities, and we have a real serious issue with this. FTX is a perfect example, right? You have all of these affiliated entities, and sometimes they want to be they want to be the broker, the exchange, the clearinghouse, the market maker, the custodian. And at some point, obviously there's conflicts of interest, but there might be other risks or things like that. And so rather than take those up on an application by application basis, I do want us to lay out a regulatory framework, a guidance, or clarifying what the rules are that apply and how we're going to take a look at that. That's just one area, but that's a really, really important area. On legislation, I would like to see Congress give us a little more authority to be able to look into affiliates to the extent that they're going to impact our registered entity. Obviously, we had a FTX affiliate as a registered entity with us and had no visibility into the affiliates that cause so much damage. And that's a very difficult situation to be in as a regulator.
Thanks. All right, so we got time for one question.
Hi, my name's Ashita, and I'm an undergraduate student here at Georgetown. Thank you so much for speaking with us today. But I was wondering, so there are, of course, many businesses that operate internationally as a result, are required to disclose financial reports to various international regulatory agencies, especially if they're traded publicly. When developing climate policy, are your agencies looking at creating your own objectives, or maybe aligning your objectives and reporting standards with other nations? Thank you.
Yeah, I mean, I think that is a really important question. As I mentioned, Europe is kind of in a different place than we are. And it's not only Europe, but I think Europe has been quite aggressive at trying to apply its regulations extraterritorially in this area, because they're putting so many requirements around climate-related disclosures. But it's not only climate-related disclosures, it's a whole other set of for lack of a better word, environmental, social, and governance issues that they want disclosures on. And it's costing their companies a ton of money to gather and produce this data. And so I think from a competitive standpoint, they're looking and trying to see how they can make sure that US companies also have to comply with those. So we have to think about that. I don't know what the solution to that is. But I think it's also important to remember that when I look at our disclosure obligations, my job is to get financially material information to investors. In Europe and some other places, they've made a decision that they want not only information that's financially material to the company, but also looking outwards, what is the effect that the company is having on the world around it? That's something called double materiality, and that is not, that's just not part of our mandate. And so there we're unlikely to come to the same place.
Yeah. Commissioners, any comments? International coordination.
So that's where I defer to Hester on that.
Okay, good. All right, well, we're out of time, so perfect. So please join me in thanking the commissioners for giving their time today. Great, thank you all.
Senator Lummis, thank you so much for being at the Georgetown Psaros Center for Financial Markets and Policy today. I know you have a very important vote coming up, so we will try to make sure to let you get out on time. Senator Lummis was sworn into the United States Senate on January 3rd, 2021, and she became the first woman to serve as the United States Senator from Wyoming. She was first elected to the House in 2008 And prior to serving in the House, Senator Lummis, you spent 8 years as Wyoming State Treasurer and 14 years as a member of the Wyoming State House and Senate. You founded the Financial Innovations Caucus, and Senator Lummis, you serve on the Senate Commerce Committee, on the Banking Committee, on Environment and Public Works. So but thank you for all your public service. I want to start with, how did you get interested in crypto?
Well, first of all, thanks for having me. This is my first visit to Georgetown, and it's a beautiful campus. I have a daughter and a son-in-law who were interested in digital assets, Bitcoin specifically. And they started explaining to me about decentralized finance, and eventually I got the bug, and they helped me buy my first Bitcoin for $330 per Bitcoin, which is a nice buy. But this was like 2013, 2014, so these were very young assets at the time. And I had served 8 years in the House. They coincided with the Obama presidency. I chose not to run after 2016. And so I was invited to speak at the Satoshi Roundtable, and not about Bitcoin, because I didn't know enough about it, but about how Congress works. And so I went to their session, and I, as they say, went down the rabbit hole and got orange pilled and learned a lot about Bitcoin. And it was an interesting year to be at the Satoshi Roundtable because there at that time were some of the first forks in Bitcoin. There were discussions about whether or not the 21 million that will definitely be issued will happen on the time schedule that was designed by the white paper that Satoshi Nakamoto wrote, or whether it would be expedited. And so there was all kinds of debate among people who were the core developers and the miners and the investors. So I got exposure on a year when the debate was very critical. They had this event on a beach town, and I never went outside the room, and there were no windows in the room. And I was there for 2 days just listening to all these debates. And so that's how I developed my interest, and it grew from there.
Well, you're a great investor. You know what the emerging investment opportunities are. And how has Wyoming become such an innovator?
Mm-hmm. Well, Wyoming became the state legislature that drafted the first set of legislation to include digital assets into their state regulatory authority, recognizing them, creating through their state banking division a set of bank regulation manuals for the special purpose depository institution legislation that Wyoming enacted, which was the first in the nation. And that bank examination manual had been vetted by US Treasury and other federal agencies to make sure it complied with Know Your Customer, the Bank Secrecy Act, the Anti-Money Laundering Act, and a lot of federal regulations that are and laws that are designed to protect consumers with regard to traditional financial assets. So we were the first of our kind and have continued to try to advance legislation and regulatory authority to integrate decentralized financial assets into our state assets, both as stores of value and now more so as means of exchange.
So, Senator, there's a lot of confusion and uncertainty about the regulatory issues around digital assets.
Yeah.
So at least the market participants who come to our events, they express frustration with that, while certainly some of our regulators feel like, oh yeah, there's plenty of certainty. There's no uncertainty. You just need to come register with us. And so I want to ask you, do you think there is uncertainty?
There's definitely uncertainty. You know, if you talk to people from companies like Coinbase, they will tell you that they've gone to the SEC. They've said, help us understand how we can comply on a regulatory basis. We want to comply. And they didn't hear back from the SEC and subsequently were slapped with enforcement actions. Regulation by enforcement action is not the way to go. So, you know, when I came to the US Senate and realized how little was known about digital assets and that there was no regulatory framework in law, I drafted legislation, then teamed up with Senator Kirsten Gillibrand of New York. She had been a securities lawyer in private practice before she was in the Senate, and New York is a state that also has had some advanced work on digital assets. So we teamed up. We have the Lummis-Gillibrand Responsible Financial Innovation Act, which is a comprehensive framework for integrating digital assets into the US economy. And there are parts of it that are starting to move, but the most important regulatory part has not moved yet. We've had some setbacks. A year ago, we had FTX and other failures that made senators really uneasy about moving into this space. Unfortunately, instead of saying, these assets need a regulatory framework, they said, wow, we don't want to touch this with a 10-foot pole. They were conflating the asset itself, the digital assets, Bitcoin and cryptocurrencies, with the fraudulent organization structures and people that were using them. You know, you can commit fraud with art, fiat currency, yachts, anything, basically. But unfortunately, when the fraud was committed with cryptocurrencies, people were saying, let's ban cryptocurrencies. So fast forward, Senator Gillibrand and I have been working for the last year to try to explain that there are companies like Chainalysis who do a lot of forensic detective work in the digital asset space, and that they've testified before our committee that it's easier to solve crimes that are committed with cryptocurrencies than with fiat currency. But it's just so hard for people to grasp. And the attention span, I hate to say this, the attention span to try to understand this asset just takes too much time for most people. And so it set us back when FTX and some of its other consequences occurred. Now, our problem, as we were getting closer, is that companies like Binance and Tether, their platforms were being used to send cryptocurrency to Hamas. And so now there's a big concern about its use in illicit finance, that the use case for cryptocurrency is only for illicit finance. So we're trying to get, news is, Senator Gillibrand and I sort of retuned our bill after the FTX debacle to provide more consumer protections. And we did work with two real cryptocurrency skeptics in the Senate, Senator Marshall of Kansas and Senator Elizabeth Warren of Massachusetts, to sponsor legislation that was incorporated into the National Defense Authorization Act that the Senate passed on illicit finance specifically. So that passed the Senate. Now, either today or possibly tomorrow, maybe as late as after Thanksgiving, will hopefully pass a motion to instruct the Senate conferees on the National Defense Authorization Act to include the illicit finance language in what is ultimately negotiated between the House and the Senate and becomes law on the NDAA with regard to illicit finance. So pieces of the Lummis-Gillibrand bill are starting to move. Another piece that's starting to move is the piece on stablecoins. And we'd been working, Senator Gillibrand and I had been working with Patrick McHenry, who chairs House Financial Services, and Maxine Waters, who's the ranking Democrat, on the stablecoin piece. And Treasury was involved. So we even had the executive branch on this one. And we were so close. And then, of course, Patrick Henry got distracted to become the pro tem of the House during the whole 3 weeks where they were selecting a new speaker. So that set us back there. But we might be able to get back on track on the stablecoin piece. So as we get some of these pieces of the bill moving, hopefully we can set up the most important part, which is when does the SEC have control? When does the CFTC, the Commodity Futures Trading Commission, have control? Sorry about the acronym soup. And that hopefully will come early next year. Now, one of the reasons I'm optimistic that it might is because we understand that some of the financial service providers in traditional finance may be applying early next year with the SEC to conduct a Bitcoin exchange traded fund. We're talking companies like Fidelity and BlackRock. So you're talking about reputable traditional financial institutions getting into this space.
And do you think that's something that's going to get approved? I mean, that'll be a huge step, right, moving forward, because there are like 6, 7 asset managers who have filed for a Bitcoin ETF. That'll open up a whole new venue, especially for retail investors.
Absolutely. And so I'm very hopeful that it will, but because it's understood, I think, on Capitol Hill finally, as well as in the regulatory world, that Bitcoin is a commodity, but the approval of an exchange-traded fund would have to go through the SEC, you know, and but the entry of traditional finance into this space is a compelling case for the SEC to move forward. It's also a compelling case for Congress to see that traditional finance has accepted Bitcoin as a store of value that has a consumer base that wants to invest in it. So we have to protect those consumers with adequate legislation that's compliant with asset protection laws and international laws. So it's time to move. It's time to move on a regulatory framework. And since Senator Gillibrand and I have continuously updated our bill in response to some of the ideas and concerns that have been raised, we think that our legislation is the correct framework that is the most understood and that should begin to move forward early next year.
So on the AML front, things are moving along. On the stablecoins front, you're pretty optimistic about things moving along.
I am.
But this whole area that you're talking about in terms of what's a security, what's not, how likely is that going to get clarification?
Yeah, well, that I think should be part of moving the package forward about SEC jurisdiction versus CFTC jurisdiction, because you have to know what's a commodity and what's a security. And our bill uses the Howey test, which is pretty well understood. I mean, there are like 130 federal appellate cases that have defined and redefined how the Howey test works. And so it's a well understood, highly documented in case law test to say what's a security and what's a commodity. And then we also create something called an ancillary asset. Right. And the ancillary asset space is something that, you know, involves, if there's an investment contract, you know, it's probably a commodity. Anyway, we create that kind of a category for things that don't fall neatly under the Howey test as a commodity or a security.
So it's interesting you say that after the FTX blew up, the reaction was more about crypto is a bad thing and we should just ban it, rather than we really need regulation in this space and we need clarity, and maybe at least some aspects of FTX might not have happened if we had that clarity and we had proper regulation. Do you see that mindset changing now? It'll take some time? Or?
Well, that took Senator Gillibrand and I by surprise a little bit. So we had to replow old ground that we thought we had already nurtured to the point that it was ready for our legislation. But it set us back a whole year. I'm convinced that that alone was something that caused people to just back away from the table and address things that they understood better. We've got a myriad of things we're trying to juggle and work on all at the same time. So if something requires a deep dive, and this does, because it's a brand new type of asset with all new terminology and the involvement of federal agencies and trying to figure out what the appetite is of the Treasury Department, the SEC, the CFTC, to be involved in this. And then you've got people who think it's only use cases to finance terrorism. There's so much. It requires a deep dive, and so few people have time to take that deep dive. And everybody knows that Senator Gillibrand and I have, so they just go, oh, talk to Lummis and Gillibrand about that, and then end of discussion. And so it's been a challenge to try and address it. So when I first realized that this was a truly misunderstood asset class, Senator Kyrsten Sinema from Arizona and I put together something called the Financial Innovation Caucus. And so we have speakers come in and try to educate and inform mostly staffers so they can inform their bosses about how this asset class works, what the issues are, how it can benefit society, what the use cases are that are highly legitimate, what the use cases are that are illegitimate or illegal. And it's been well attended. We had an event today that was extremely well attended by staffers. So we just continue to try to educate and inform and get people trying to look at this piece of legislation.
So, Senator, it's interesting. We at the Psaros Center have also been doing that education. And actually, staff and members of Congress have reached out to us.
Oh,
that
good.
I need my staff. Here is the person who needs to be on top of this. Can the Psaros Center help them? And of course, we are happy to do that, and we have been doing that. So please feel free to reach out to us if we can help in any way here.
Oh, fabulous. I know you can. And I'm so delighted to know you're here. The Psaros Center is a place where people can take deep dives into conversation on financial markets without bias. And
that's the main thing, right? We are completely unbiased, and we try to present all viewpoints. And we are educators, so people can ask us dumb questions, any kind of questions. There's lots of information out there, but I think what we bring to the table as an educational institution is we're not an advocacy group of any kind. So we bring that unbiased aspect. And so we've been doing some of that education. So please lean on us if we can help.
Thank you. And one of my lead staffers is a graduate of Georgetown and has been very helpful in moving this dialogue along in the U.S. Senate and the U.S. House and with the executive branch.
So let me ask one other question about this crypto accounting bulletin, 121, and you have concerns about that. Maybe first talk a little bit about what that is and how it impacts banks and other financial institutions and what your concerns are.
Well, this bulletin, it was put out as a bulletin at the SEC to require that you would account for digital assets on your financial institution ledgers as belonging to the company that's holding them, not to the customer. And that to me is completely backwards. The crypto assets are property. The token that sort of embodies the crypto assets discussion is property. And so we're trying to define property as belonging to a customer. So why would you put it on the entity's balance sheet? It seems to me then if you have a bank failure, that the asset would be deemed not to belong to the customer. And so I was very pleased when it was determined that this was not a bulletin but rather a rule that failed to go through the Administrative Procedures Act rulemaking, and that it should have and needed to. So I think that's right. I think that this is something that should have been put out for public comment, as is true under the APA for all rules. So we could have had a discussion about whether you treat an asset that is held by a custodian as an asset of the custodian or an asset of the person who actually owns it.
So what is the status now?
Okay, so now we'll go through a process where we use a Congressional Review Act to force this bulletin through a APA process, or invalidate it as having been implemented without going through the legal process.
Okay. I want to be very sensitive to your time, but we'll open it up for a few questions, and I'd especially invite our students to ask Senator Lummis questions. Please.
Hi, I'm a freshman in the business school here at Georgetown. And I was wondering, so why do you think support for crypto legislation has been so bipartisan? And if what I've heard is that because of high-profile crises like FTX, that's really highlighted the need for regulation. And if that is the case, if you agree with that, do you think that we need to rely on such crises and other emerging technologies like generative AI to establish such bipartisan consensus in other fields?
Well, I wish we didn't wait until there's a crisis to establish bipartisan consensus and work on these things. It is true that under AI, the discussions that are going on around Capitol Hill, at least on the Senate side, are very bipartisan. Because I don't think artificial intelligence has a partisan hook to hang your coat on. And there are people who want to take a wait-and-see approach to AI, others who want to begin to regulate in a very soft manner, and others who want to regulate in a more heavy-handed manner. So there are like 3 pieces of legislation already floating around Capitol Hill on AI that are a light touch regulation, a medium touch regulation, heavy touch regulation. And the set of players that gravitate towards each is bipartisan. So it's very interesting. I do think because Web3, AI is dealing with the larger issue. So cryptocurrency is sort of a component of Web3. And it is the property component of Web3. And so it also is very bipartisan because we're dealing with decentralized finance. And so where it tends to shake out is not on Democrat-Republican lines, but people who are comfortable with decentralized finance and people who want centralized finance. And that, so you see people who are more libertarian-ish, whether they're Democrats or Republicans, being comfortable with decentralized. For example, Ron Wyden, a Democrat from Oregon, who currently is chairman of the Senate Finance Committee, comes from a state that is very liberal/libertarian. I come from a state, Wyoming, that's very conservative/libertarian, but where we meet is in that libertarian side. So Ron Wyden and I sponsor lots of legislation together that involves personal privacy and that involves a greater trust in decentralized finance. Whereas there are other people, you see Roger Marshall from Kansas, a Republican, and Elizabeth Warren, who's very liberal, tend to go together because they're more comfortable with a government-controlled financial system. So it shakes out in really interesting ways on a partisan basis. And I've always found that it's fun to, I like the strange bedfellow stuff, because people tend to, if you've got people that you normally wouldn't put together as co-sponsoring something and advocating for something, it's more apt to pique your interest. And you're more apt to think, wow, I'll bet this is kind of balanced, because those two don't normally agree on much. So this might be a balanced piece of legislation. So, I think that's working out really well in the Senate right now, where you have a Senate that is almost 50-50, where you see those strange bedfellows get together. It's fun. Makes for a good piece of legislation.
Thank you. Mm-hmm. How about we'll take one more question?
Senator, thank you. My name is Andrew. I'm a graduate student in the Court School of Public Policy here. You mentioned the need to educate policymakers who have a lot of things to work on and a very little amount of time to do it. If I have a new product or a new technology or a new something that's going to require educating policymakers, in your experience, what is the best way to do that? Who do you think does a good job of that? And who do you think does a bad job of that? As many specific examples as you can give me is very helpful.
Wow. It's consumer products, the Commerce Committee. So I think what you need to do is identify who the right audience is. So you're not trying to get widespread, really broad knowledge that is a mile wide and an inch deep. What you really want is just the opposite. It's narrow, but it's deep, because those are going to tend to be your advocates. And as I mentioned earlier, in the US Senate, regardless of whether you're a Democrat or Republican, if you come to a Senate office and start discussing digital assets, whether it's stablecoin or Bitcoin or non-fungible tokens or CDBCs, central bank digital currencies, everybody says, oh, go see Lummis or go see Gillibrand. And it's because everybody knows that we're the ones who've taken the deep dive. And so I would say identify what you're marketing. Let's say it's a consumer product. Pick people on the Commerce Committee that tend to have expertise in consumer products, and go in and meet with them and give them a lot of information, give their staff a lot of information. If you can demonstrate your product with them, even better. Example, the University of Wyoming is working on new uses for coal because coal has fallen into disfavor as a thermal source. So University of Wyoming is making asphalt out of coal. They're making bricks out of coal. And I am just thrilled out of my wits because Wyoming is the largest coal producing state in the nation. And it's something that has value. And maybe as we turn to other uses other than as a thermal source, I'm going to be all ears. So I think the most important thing is identify those people who are most likely to have the same intellectual curiosity that you have and focus on them. Did that answer your question?
Wonderful, thank you.
Thank you.
Fantastic, Senator Lummis. Last year we had Senator Lummis and Gillibrand on a pre-recorded video talking about your very comprehensive bill that you had introduced. This year we are delighted to welcome you on campus in person.
Thank you.
And we hope to have you here in the future also. So thank you.
Go Hoyas. Thank you. Thank you.
That is fantastic. Thank you so much. I know you're so busy. I want to welcome our congressional panel next. Please come join us. David Leonhardt is going to moderate it. David, welcome back. And we're delighted to have Congressman Jim Hines, Congressman Brian Stahl, Hoyer, I have to mention that, and Congressman Lawyer. So, David, take it away.
Thank you so much. Good to see you all again. We're saving the best for last. 3 members of the United States Congress. Thank you all for joining us. So we're going to start broad, then we're going to talk a little bit about financial markets, and then actually we're going to kind of lift up and talk about the state of the world, because you don't always get 3 members of Congress in one place. And we were having a really good conversation in the green room before. We're going to talk a little about American politics. We're going to talk a little bit about the Middle East and take advantage of having these folks here. So let's start with kind of the big broad question of the American economy. And Congressman Lawler, I'll start with you, and then go down. A lot of people are frustrated today. A lot of people feel like the American economy isn't serving them well. When there's a Democratic president, Republican voters tend to be angrier, or vice versa. But basically, a lot of Americans have been unhappy for most of the 21st century. How do you think about this? Why is the American economy not delivering results that most people feel satisfied with?
Because I think we tend to get caught up on the wrong issues. To me, when you look at our economy, we have over 6 million units underbuilt in this country in terms of housing. So when you talk about housing affordability, part of it is a supply issue. When you look at energy, we have a horrifically bad energy policy in this country. In New York State, where I represent the 17th Congressional District of New York, for instance, 70% of New Yorkers rely on natural gas. 70% of electricity is generated by natural gas, and yet we're trying to prohibit the use of natural gas. And so energy costs go up. You look at government spending, it's reckless. In New York State, they've increased spending by $50 billion in 3 years. It's unsustainable. They now have a nearly $6 billion budget deficit heading into next year. They're looking at a $36 billion revenue shortfall. They lead the nation in out-migration. So it really comes down to the policies. And I think if we want to have a more robust economy that is focused on affordability, that's focused on employment, that's focused on wages, then we need to allow for the private sector to flourish. We need to allow for the free markets to work. And that really revolves around having a coherent energy policy, a strong housing plan, an immigration policy that works, and really allowing our financial markets and institutions to flourish. We need regulation, but we cannot stifle the innovation and the opportunity. And so I think part of it really, in my estimation, and just in being in Congress for the last 10 months, I think a lot of the things we focus on are not the issues that actually will resolve the economic challenges that we face.
So Congressman Hines, my guess is we get some bipartisan agreement from you there and maybe some bipartisan disagreement from you there. What do you see as the fundamental issues that are keeping our economy from doing what it could?
Yeah, I think I would agree with a lot of what Mike said. I'd disagree on a couple of points, but I think what Mike didn't say is that the American household has been through just a brutal 20 years, or let's say 15, right? So 2008, the crisis of 2008, $17 trillion of household wealth has evaporated. That's bad enough in and of itself as an objective matter, but what does America see at the time? In 2008, what they see at the time is that a bunch of financial products that they don't understand, collateralized mortgage obligations, traded in ways they don't understand by firms that they don't really know much about, Bear Stearns, Lehman Brothers, that tanks their economy, zeroes out their 401k, makes it impossible for them to pay their mortgage, huge unemployment. And then they see the Congress engineered this, thank God, the year before I got here, a bailout. We bailed out the firms that were at the core of that problem. That is not just terrible economically, but in terms of sentiment. I trace a lot of the populism that is in this country to that moment where Americans said, wait a minute, the government isn't looking out for me. They're looking out for J.P. Morgan and Morgan Stanley. So there's that. And that's, of course, on the heels of the Iraq War. Then we have the pandemic. There's just the American consumer has been through an immense amount of pain. Underneath that, tectonically, I think people think about their parents' lives and their grandparents' lives. Look back to 1950. Right? Unionization made sure that there were, in the industrial Midwest, you'd leave high school and you'd get a union job down at the plant and you were middle class, right? You didn't need to go to college. That world is largely gone. Now, the economy is changing and being disrupted, as the sort of venture capitalist community likes to say, so rapidly, so much less secure. And so I just think there's a lot of both tectonic and more short-term things that have created a lot of pain for the American consumer. Mike's not wrong about the deficit or about energy prices. I mean, somebody probably has the idea to forbid natural gas. The reality is the United States is producing far more oil and natural gas today than it ever has, and energy prices go up and down. The debt and the deficit are a serious issue that we have not yet felt, right? The way we're going to feel that is when interest rates rise. Now, interest rates have risen, but they've risen as a deliberate choice of monetary policy. So I wouldn't say that he's wrong about that. I'm just saying that, the deficit, in the 15 years I've been in Congress, everybody has been saying this is the year that the United States collapses because of our debt and deficit. And it turns out this is not the year.
Yeah. Well, it's fun. So in Congress, you may know this, that depending who controls the chamber, that party gets one or more than one extra seats on the committee. So on our panel here, since we have House members and Republicans control the House, the Republicans have the majority. So Congressman Stile, you get the last word. How do you see the big things holding back our economy?
So I'd take what we discussed. I think it's cost of living. But I'd also add in our media ecosystem. Let me hit cost of living first. We look at the drivers that are driving family budgets. The cost of going into a new home in 3 years has doubled. What I mean by that is home prices have risen and interest rates have risen. To purchase the median home 3 years ago, your mortgage was $1,200 a month. To purchase the median home today, it's doubled. It's now $2,400 a month, which actually says most people couldn't sell the home they live in to themselves, meaning you couldn't sell it at market rate and get a mortgage and pay your mortgage. That's problematic. Costs have gone up for energy. We could discuss why. Costs have gone up for childcare. We could have conversations. And Jim Himes and I served on a select committee on economic disparity and fairness and growth. I think we both reached the conclusion that childcare is a huge problem. We have divergent views in some ways on how to solve it. Same way we may have on energy. But I think recognizing that these are real drivers of people's frustration, I think is real. And as policymakers, we have to find ways to address it. The other thing just to build quickly, is I think we also don't spend enough time thinking about how the media ecosystem has changed. I don't offer a solution to this, but I think it's worth recognizing. And I think back, we're about to go to Thanksgiving, and so I think about a family sitting down 55 years ago in my hometown of Janesville, Wisconsin. There's probably an uncle and a nephew screaming and yelling at each other about the issue of the day. Should we be in Vietnam? Yeah. Right? Domino theory, draft deferment, was the Tet Offensive successful, not successful? And you can envision that debate in two people who could barely stand each other. But the night before, they probably both watched Walter Cronkite. In a week from tomorrow, there'll be families sitting down having Thanksgiving dinner, probably at the same family, at the same table, a generation and a half removed, that'll have a similar robust fight over some policy issue of the day. One will have watched a cable TV channel, and the other will have read their neighbor's Facebook page. And you laugh because you kind of know it's true. And the challenge, right, is that if you're not starting a policy debate from a similar set of facts, is uniquely challenging. And I combine the struggle families are facing with affording the things that they need. And I combine that with the media landscape that we have. And I think that's a unique challenge.
And so, that's such a fascinating point. Can we just spend another minute on it? Do any of you have thoughts about what can we do about that media landscape?
I would jump in. So I don't know that I don't have a silver bullet. I don't know that anybody does.
Yeah.
But I think we all have to recognize the challenges in a sense that social media has great benefits. It has great challenges. I don't offer a solution to it, but I think it's worth pausing and reflecting that everyone is now a publisher. I mean, you're with the New York Times. It wasn't that long ago that if you wanted to have information dispersed, there was a smaller number of individuals that controlled that mechanism. There's pros and cons to every system. It is now incredibly democratized. There's great positives to that. There's some challenges. And I think we're in this transition period as we become accustomed to anyone can post anything on X or on any other social media platform that you want. true or not true, right? Not vetted by an editor. There's benefits to that. There's challenges with that. So I don't offer a policy solution as much as I think it's worth all of us kind of pausing and reflecting that that is a significant issue that we face in the landscape.
I think you obviously have, all of us have our own biases, our own viewpoints, but we're living in a world of echo chambers, and everybody wants to hear something that affirms their perspective or point of view. And if somebody offers an opinion that is different than them, we immediately ascribe an adjective to them and demean their motivation or or their position, rather than engage in robust public debate. And I think, we talk a lot, and certainly on universities, there's a lot of focus on diversity and the need to respect diversity, but we don't respect diversity of thought anymore. And that is a big problem, because you can't actually solve problems if you're not willing to engage in robust debate. And I think the media, frankly, has played a terrible role in this. I think, you can read almost any news article, and it's got a lot of opinion in it. It's got a lot of adjectives in it, rather than just statement of fact and action. And this is what this individual said or did. They ascribe an adjective to what this individual said or did. And I think that is destructive because it just layers on more biases as we're trying to work through these problems. And social media, I will tell you this as somebody who was in college when Facebook came out and really took off. If I'm not in elected office, the first thing I will do is delete all of my social media accounts because it's destructive. I mean, you sit and read this nonsense every day. I have the same 20 people. I'm sure you have the same 20, the same 20.
They might literally be the same 20.
sit and tell you what an awful human being you are on your social media accounts. But it's like, it's all drivel. It's all drivel.
I want to interject here because I have an unintuitive thing to say as probably, left of my friends here. I don't think there's a policy solution here. I don't. And you're going to hear this from a Democrat, which is, and in every town hall meeting I do, this is something for the American civic body, for American citizens to solve. I, as a Democrat, will be at the forefront of saying, no, the United States government or state government is not going to get into the business of determining what is disinformation, misinformation. Let's not go down that road. Now, is there a narrow space around hate speech, the things that the exceptions to the First Amendment, right? Fighting words, hate speech. There's probably a narrow exception. If you go on your Facebook page and indicate you've got plans to kill somebody, maybe my argument falls in that case. But I regularly tell my constituents, don't look to us for the answer here because that comes with more negativity than you doing what you need to do as a citizen of a democracy, which is consciously develop the critical faculties that allow you to identify bias. I mean, Mike's right. There's a lot of bias in stuff, but I read the Wall Street Journal editorial page because I want to see that bias because otherwise, I'm just listening to you. But my point is that there is not going to be a policy solution except in the narrowest of alleys. And honestly, and I close my little rant here to my constituents just saying, look, you're going to get the democracy that you want. If you see the critical act of being a citizen as entertainment, meaning you just read those 20 guys and you just love it or you hate it, you'll get the democracy you deserve. Soon it won't be a democracy, but if you don't take seriously the duty to reflect critically, we're collectively not going to deserve a democracy.
And I think,
I agree wholeheartedly with what Jim is saying. The other thing I would say, and I think it's important as elected officials, I go talk to every news outlet. I'll talk to the New York Times. I'll talk to MSNBC. I was on Morning Joe this morning. I'll go on Fox. I'll go on Newsmax. I'll go on CNN frequently. You have to be willing to engage the broader public and the broader conversation, and not just go where it's comfortable, or you may not get asked tough questions, or you may only be able to spew the talking points. You actually have to go where the public is. And coming from a district that Joe Biden won by 10 points as a Republican, where there's 70,000 more Democrats than Republicans, where Bill and Hillary Clinton are my constituents, I have to go talk to a broader population. Otherwise, I don't win my election. And so I think part of the challenge here is that a lot of members don't do that or aren't willing to do that anymore because it's just so confrontational. Everything is so theatrical. But you have to be willing to do that to change this narrative a bit.
And I mean, it's connected to this idea of you said robust debate. A part of robust debate is respectful debate. Hey, I think you're wrong about this. I don't think you're a bad human being, right? And it feels like we've often lost the ability to have that kind of debate, which is absolutely crucial to a democracy. A democracy is not a country where everybody agrees, right? It's sort of baked into the idea.
That's a totalitarian.
Yeah,
that's the
exactly.
definition of totalitarian.
That's the thing. Everybody says they don't want a totalitarian government. They don't want dictatorships, and then they're like offended that there may be an actual disagreement in the public discourse.
So let's talk about financial markets. Specifically, what kind of changes do you each want to see to our financial markets so that they serve ordinary Americans better? We'll go in reverse order.
I think we have an opportunity on democratization inside the markets, in giving people on Main Street the access that people have on Wall Street. That's easier said than done, right? So that's a simplistic phrase. How do you give people those access? I think we have to continue to look at avenues to make sure people have access into the markets. The other side is making sure that the capital is being distributed throughout the country. So not a heavy-handed approach, but looking at the regulatory barriers that are preventing those funds from coming into places like Southeast Wisconsin, rather than simply being concentrated in some of our nation's largest cities.
Or Greenwich. What do you want to? How do you want to see the financial markets change to serve people better?
First, it would be helpful to do something unnatural with 3 members of Congress, which is to let's have the real discussion rather than the partisan discussion. Because nothing brings up quite as much animus, frankly, on both sides of the aisle as political monikers like Wall Street, right? So let's start from what I think is a defendable premise, which is that we have the very best, most liquid, most capable, growth-oriented capital markets on the planet, bar none, by a long shot. And so, again, maybe in my party, the typical thing to do would be to start from a very different place from that, but that is a fact. So, but what? Let me outline. I was 12 years in the industry, so I will say this with some knowledge. I think there's at least 2 big problems. Number one, I think Brian is exactly right. The availability of capital has a lot to do with geography and access. And I think there's all kinds of amazing businesses, not just in the rural Midwest, but in the Bronx, that don't get funded because there's no mechanism for capital to get to people who aren't connected or in certain geographies. Brian covered that really well. I do think that the industry is beset by a lot of barriers to entry, oligopoly behavior, non-competitive behavior, everything from the way gross spreads are priced on IPOs. This is what is paid by young companies that want to go public. Lo and behold, they have been 7% for about the last 50 years, and they don't move from that. To the brand value of the JP Morgans and the Citibanks and the Goldman Sachses, that's a barrier to entry. I would like to see, as much as I benefited from a long time in one of those institutions, I would like to see the full brunt of disruptive innovation cut loose into the financial sector. Everything else has been disrupted. Media, medicine, well, not so much medicine, but media certainly has been disrupted. But this, Wall Street and the big banks have somehow been insulated from the competition and the innovation that I think would bring down pricing and make for a more competitive capital markets.
Yeah, Congressman Lawler.
So when you look at our economy, obviously small business is integral to it. And to the point, Brian, access to capital is critical. And if they don't have access to capital, if these businesses cannot get the loans or the initial investments, that obviously makes it difficult for the economy to grow, for job creation, economic opportunity. That is what has set America apart from so much of the rest of the world, is that economic opportunity. And bringing people into the middle class. The unions have played a role in it as well. There's a broad swath of reasons why we've had so much success over the last century. But I think access to capital is critically important. I also, and I serve on the Housing and Insurance Subcommittee, and I think housing is important. I don't agree with some of the policies that have been enacted in New York with respect to rent control. For instance, there's 50,000 vacant units in New York City. Now, there's a housing crisis in New York City, but there's 50,000 vacant units because of rent control and the fact that it costs more to upgrade the apartment and get it to code than you can charge on rent. And so they're taking the tax write-off instead. So we have to think about how we are actually enacting policies. There may be a well-intentioned policy, but if it's not working, we have to reevaluate that. So I think housing is critical with respect to our financial markets. And I think energy policy is critical. We've done a lot of work on ESG in this Congress, in committee. We've done a lot of work on data privacy, digital assets, and cap markets. That's been the main focus of the first 10 months or so. But there's a lot more work to do, and I think if we want an economy that is robust, that is growing, that is thriving, I would again reiterate it's the access to capital, it's housing, it's energy, and it's immigration policy.
So the deficit we've already talked about is a real problem, and it's going to become a bigger one as interest rates rise and the government has to pay those interest rates. When I look at the numbers, it seems pretty clear to me that the biggest budget items going forward are Social Security and healthcare, Medicare and Medicaid. And so it's really hard for me to see how we address our deficit problem without making some cuts to those programs. We can call them something other than cuts if that helps, adjustments, or increasing taxes. Do you disagree with that framing? I'll start with the Republican members.
Well, I would start with the other piece of the framing that I think is really important is economic growth.
Yep.
And so as you look at tax revenue, right, simply raising rates is one technique, and you may or may not end up with more revenue at the end of the day. The other is to grow the pie.
Yep.
And so I don't think you want to walk away not focused in on economic growth. And
Yep.
so if you go before we hit COVID, you saw economic growth increasing dramatically, and you saw wages increasing across the board above inflationary numbers. And as a result, federal tax revenue was increasing. That, I think, is a critical piece of the puzzle that can't be lost in the broader conversation, because you can't simply cut your way out of the problem. Then I think the other piece that is really important to look at inside the buckets that you're talking about, 25% or so of the federal budget is what we call discretionary spending, meaning Congress is appropriating it every year. 75% is on autopilot, the two biggest buckets you mentioned. The third bucket that is going to take up more and more of our time, I think was previewed by Congressman Himes, and that's interest payments on the debt. So interest payments on the debt are increasing dramatically as a result of higher interest rates. How long those higher interest rates stay will be a factor. But I think most people are looking at this and saying we're going to go from $450 billion a year now, just over a year ago, that was the year-end number, to north of 600 this year. In the not too distant future, we'll be at $1 trillion of interest payments on the debt. You don't get anything for that. And so I think that also needs to be a broader piece of the conversation. And then the final piece is people will reference cuts. I think we can also look in particular on the healthcare side as to how we deliver the ultimate product. So as we look at north of $1 trillion being spent on health insurance, I think you can maintain the standard of care being provided. In some ways, I think you can improve it. And you can look at efficiencies on how you deliver that product.
Yeah, many other countries figure out different ways to do it more efficiently than we do.
There's no question when you look at our national debt approaching $34 trillion that we have a crisis. When I was in high school, 20 years ago, our national debt was in the single digits. So in 20 years' time, it has exploded. Now there's a lot of reasons for that, but it's unsustainable. And I think when you look at revenue, tax revenue, we have the most tax revenue we've ever taken in. So it's not an issue of, hey, we don't have revenue. We do. We're just spending at rates that we cannot sustain. And a lot of that is driven by mandatory spending. Now, Social Security and Medicare are critically important programs for our senior citizens and for our future. And we want to make sure that those programs are sustainable for the long term. If we do nothing right now, they're both going broke within the next decade. So if we leave it just as is, they will both be broke. And that is a fundamental problem that we have to address. As a member of the Problem Solvers Caucus, one of the things we talked about during the debt ceiling negotiations and again during the lead up to the potential shutdown in September was this need for a debt commission. Both parties, it's a third rail. It is, the political third rail. I was getting attacked at the beginning of the year that I wanted to cut Social Security and I wanted to cut Medicare. Not true. Don't want to do that. Want to make sure they're both sustainable. And how do we deal with that for the long term? So both parties are going to need to be part of the solution on that. It cannot be a one-party solution. It's not going to work. Because it'll just be political and it'll turn into, a piñata. And it won't go anywhere. So it's got to be a joint effort here by both parties to deal with the long-term ramifications. Does that mean lifting the cap on payroll tax? Does that mean raising the age for those that are, some of your age, 25 and younger? Maybe, but it's all got to be looked at, and it's got to be a joint effort, or it's never going to go anywhere.
Or potentially reducing benefits for higher income people. That's another option.
Means testing.
Yeah.
I mean, there's a lot of different options you can look at.
So, do you want to endorse Social Security or Medicare cuts or tax increases?
Well, put that way. So I've been through this once. I went through a debt commission once before in 2009, 2010.
Bull Simpson.
The Simpson Bulls. And in 2009, the National Security Advisor, Admiral Mullen, said the single biggest strategic threat to the United States is the national debt. The national debt at the time was about $7 trillion, or about a third of where it is today. I'll come back to that because we have a huge cry wolf problem here, which isn't to say, by the way, everyone who says it's unsustainable, at some point they will be right. The question is when. But the point I'm making is that I went through a debt commission. I was one of 33 votes in a 435-person body in favor of the Simpson Bulls Commission, and I still get beat up for it. But we know with that as a model what is going to happen. This is politically brutal. It is mechanically not that hard. There will be reforms to Social Security and Medicare. There will be cuts to discretionary spending, and there will be new revenue. And yes, growth is important. The point is, if you're saying that any one of those three things are not on the table, you're not serious about the math. And you can go back and look at Simpson Bulls. It's important that we start because this stuff is really hard with people really understanding what it is that we're talking about. The best one sentence to understand the federal government, which many of you have heard before, is if you want to understand the federal government, it is a social insurance program, Medicare and Social Security, guarded by a military. That is what the federal government does. So please don't talk to me about foreign aid, which is less than 1% of the budget, or food stamps, which is 0.7%. It is a social insurance program guarded by a military. That's where the vast bulk, by the way, interest, of course, is now becoming a meaningful thing. But all of that stuff is going to happen. The question is, when does the political will come together? I, over the many years, after seeing the Simpson Bulls failure, have rolled around to the notion that sadly it's going to take a market signal to get us there, because that stuff is really, really hard. In the meantime, I wish we could focus on win-wins, right? So many people will know this. Medicare, of course, provides health insurance for people over the age of 65. It also pays for every single American to get dialysis, regardless of your income, to get dialysis. Dialysis is something that you generally need to get when you have diabetes in critical form. Much of that, if it's type 2, is preventable. It's preventable. And I forget the exact number, but it's something like $70 billion a year of dialysis in Medicare. It's preventable through things like nutritional counseling and hotspots where there isn't availability of healthy food. That as long as we're not, and we're not, as long as we're not going to be courageous about tax increases and adjustments to Social Security and Medicare, let's at least focus on these immense win-wins that will actually move the needle.
So we have only a few minutes left. I want to get to the sort of lightning round of topics. We were talking backstage about this fascinating class inversion of American politics. You've all seen it in different ways in your districts, in which people without college degrees have moved to the right and people with college degrees have moved to the left. So I'm going to ask each of the two parties a different version of this question. What is it that the Democrats could do that would make both of your lives harder to win back more working class votes? If you were advising the Democratic Party, which you're obviously not, what is it that they could do that actually, and then I'm going to do the same for you on Republicans. So basically, how does the Democratic Party most hurt itself with working class voters?
My hot take is looking at cost of living. If I go out and talk to 500 people anywhere in my district, it's going to be cost of living, cost of living, cost of living. They're going to use different terms for it. They're going to talk about different things. Right? Somebody's going to talk about what it costs to fill up their car with gas. Somebody's going to talk about childcare. Somebody's going to talk about housing. Somebody's going to talk about their children's education. If they go to Georgetown, you know what I mean. And as we go through that, each one of those is hitting people. And so if we're talking about, I think sometimes we see, in my view, this administration miss that as it relates to the impact that it's having on people.
So my district is just north of New York City. 50% of households in my district have a cop, a firefighter, or a veteran living in the household. 50% of adults in my district have a college degree or higher. So it's highly educated, yet working class, 65% white, 19% Latino, large Jewish community, one of the largest in the country. Diverse district. It's got different needs, different issues, different challenges. I won because I talked about affordability, public safety, and education. And I think where the Democratic Party has kind of lost its way with a lot of folks in maybe the blue-collar working class world, if you will, is the affordability. They don't care that they're increasing the cost of groceries or energy with some of the policies that are being enacted. The cost of housing gone up significantly. The challenges surrounding public safety and the failure to enforce the law. I think a lot of people who would consider themselves a little more common sense would just be like, you broke the law. Enforce the law.
Yeah.
So it's issues like that I think cut across the border crisis. People are looking going, seriously? Eric Adams is taking in over 100,000 migrants and then trying to ship them up into our community because he has nowhere else to put them. People are looking at these policies going, they don't make sense. And I think that's where there's a disconnect with kind of the working class person that the Democrats used to have a very strong handle on, especially because of organized labor.
And some of it is really in your face. It's not the biggest deal in the world, but you take the New York City subway or the Washington Metro and you just see people jumping the turnstile in ways you didn't a decade ago. And it's just right in your face. It's, wait a second, the rules don't apply to everybody. Right. Okay, so whether it's your district, a lot of college graduate professionals have moved away from the Republican Party. We see it in the suburbs of Phoenix. We see it in the suburbs of Atlanta. What could the Republican Party do to win back more of those college graduate professionals that it has lost over the last several years?
I think there's a very clear answer to this, and we've seen it now in multiple elections. And the very clear answer is, you framed the question differently to me. You said, what could the Democratic Party do to help you? So tell me again.
What could the Republican Party do?
To win back
the college graduate professionals.
Super clear answer. Turn around the approach you're taking with respect to women's reproductive rights and associated issues. Not these Republicans, but there are some, and there are certainly thinkers who say not only are we going to win on abortion, but we're going to reverse birth control availability, et cetera. That is unbelievably toxic. If they could find a way to learn from what happened in Kansas and Ohio, that would be a huge problem for us electorally. And the second thing, which I think is clear as day, is figure out some way to tamp down the MAGA stuff, because I'm here to tell you from one of the wealthiest suburban districts on the planet, that is absolutely toxic.
And what is the MAGA stuff? It's Donald Trump personally, and it's the election denial?
It's all of the above. Yeah, it's certainly the election denial, which gets to people's fears about the foundation of our democracy. Yes, it's stylistic. You were talking about country club Republicans. Country club Republicans don't much like this, the President Trump style. It's the dysfunctionality of that administration and stuff. So it's quite a witch's brew of stuff.
Yep.
But if they could get those two things right, my party be in a heck of a lot of trouble.
Last thing, let's talk about the Mideast, which is obviously such a terrible situation. And can you just each give us a brief sense of both how we should think about the next several weeks or months in Gaza and in Israel, and what you hope will happen out of all this?
It's always so hard to talk about what you would hope for in the Middle East because inevitably it doesn't come to pass. I hope for a couple things. I hope we can do a lot better in this country around issues of moral clarity. I've been appalled, quite frankly, my own alma mater and the way too many universities, too many people, too many political parties have gotten the moral question wrong. And I think if you get the moral question wrong, it's hard to do the policy, whether that's being full-throated in your condemnation of a hideous terrorist attack, whether it's acknowledging that the Palestinians themselves have lived under immense suffering for a very long period of time. I wish we could get the moral thinking, the moral clarity better. Number two, my own view is that the Israelis have every right and should do all they can to eradicate Hamas. My hope is that they will do that in a way that doesn't create a larger problem. That's why the president is pushing for care and humanitarian aid, et cetera. And then finally, we could talk for hours on this issue, but this problem in particular will haunt future generations if the Israelis and the Palestinians chiefly, but the rest of the world doesn't get back to where we were 15 years ago, where there is some commitment to solving the underlying problem. In my own view, that's a two-state solution. In my own view, neither the Israeli nor the Palestinian leadership have been in any meaningful way committed to that idea for at least a decade. But the idea that persisted in Israel for a long time, and I say this without any normative judgment whatsoever, that the country would do fine, we would have a wall, and those 5 million-ish people, you don't need to think about them. You need to think about them. Yeah. And if we don't come up with a just and lasting solution, we will deal with this tragedy for another generation or two.
Congressman Style.
Let me touch it in two parts. One, I think it's important that we're standing with Israel, giving them the resources they need to defend themselves to eradicate Hamas. Uniquely for this conversation, I think it's worthy of talking about the United States has the most substantive and robust capital markets, as Congressman Himes noted, also insurance markets as well. And so we're uniquely positioned as it relates to address sanctions and capital flows. And we have that liberty because we are the greatest capital markets in the world, bar none. And then leveraging those sanctions to try to drive forward U.S. foreign policy objectives and doing so thoughtfully. And there's two pieces here. One is putting forward the sanctions, but two is enforcing them. And so as we look at Iran as having being the largest state sponsor of terrorism around the globe, we continue to see Iran finding access to financial markets. I have concerns with what this administration is doing in that regards. But in particular, I think we could look at this as an opportunity to build and work with our allies to truly enforce many of our sanctions. So Iran right now is selling oil on the illicit market to Syria, to China, possibly other locations. I think we have an opportunity to look at that and really dive in on the financial markets. And just because of the setting for us today, I think the fact that the United States has the most robust capital markets gives us that luxury to do that. And I think it's imperative that we act upon that.
Congressman Lawler.
So I just came back from Israel on Monday. I was there Sunday with Chairman Mike McCall, Ranking Member Meeks, and a number of other members. And we met with Prime Minister Netanyahu. We met with Defense Minister Gallant and U.S. Ambassador Jack Lew, as well as families of some of the hostages. And we watched a 21-minute video with the Prime Minister of the raw footage of the attacks on October 7th. And after watching that video, it reaffirmed my position that there cannot be a ceasefire. Hamas is a terrorist organization that has been funded and backed by Iran for decades. Iran is the biggest state sponsor of terror. Most of their money is derived by the sale of Iranian petroleum, which is why my bill, the SHIP Act, passed through the House last week to enact secondary sanctions on China, the biggest purchaser of Iranian petroleum. And we need to be very clear-eyed here. There is no moral equivalency. Hamas targeted innocent civilians, butchered, brutalized, raped, beheaded women, children, babies, and they did so with glee. And when you watch this 21-minute video, you see it. No one after 9/11 would have told the United States to engage in a ceasefire with al-Qaeda. So Israel has a right to defend itself. They have a right to defend their citizens. And I will not equivocate on that. Now, Hamas, on the other hand, has oppressed the Palestinian people. They are the governing body in Gaza. They have oppressed the Palestinian people. They have used these people as human shields. They have set up military operations in hospitals, in schools. And as Israel set up a corridor for Palestinians to move from the northern part of Gaza to the south, Hamas is shooting their own civilians that are trying to escape. The death toll that is being reported is not accurate. It includes the thousands of Hamas terrorists that have been killed. And so I think, number one, when we're dealing with this conflict right now, we need to be very clear on the facts and what is actually happening. And we need to understand the difference. Israel is not targeting innocent civilians. Israel is prosecuting a war in defense of its sovereignty. And there's a big difference. And so I agree with Brian about the sanctions enforcement. That is critical, and that is something the United States can play an important role in. But we need to provide them with the aid, the $14.3 billion. And we need to work not only to get the hostages released, including 9 Americans who are being held, but we need to prevent Hezbollah and Iran from opening up new fronts in this war. And I think it is critical that we continue forward with the Abraham Accords and get Saudi Arabia to the table. Saudi Arabia is going to be critical when all is said and done here, not only normalizing relations with Israel, but ultimately in rebuilding Gaza, because when this is all done, Hamas will be no more.
Well, I could talk to the three of you for a lot longer and dig into all this and ask you things, but let me just end by thanking you for this discussion. You talked about robust debate, and I really appreciate the kind of discussion and really respectful engagement that you all did here. So thank you very much.
Thank you.
So thank you very much for coming. Just a couple of housekeeping items, and then we're going to invite you all to come up to the reception up on the 4th floor in the Fisher Colloquium. So first of all, David Leonhardt will be signing copies, complimentary copies of his book up on the 4th floor during our networking reception immediately following this. And so please join us for that. We also have food and refreshments. Also, I wanted to let you all know that Arun Gupta's book, Venture Meets Mission, the Psaros Center has purchased some complimentary copies for everybody in attendance. So there are QR codes on a flyer. All you have to do is do the QR code with your camera, type in your own mailing address, and when the book comes out in January, it's not out yet, so when the book comes out in January, your copies will be mailed directly to you. And so finally, I just want to thank some people. I want to thank Mike and Robin Psaros and the whole Psaros family. I want to thank Reena Agarwal, our founding director. I want to thank Ellie DeAndrea, our Assistant Director, Drew Devine, our Program Coordinator, and Taya Anderson, our Marketing and Comms Coordinator, as well as Lee Pinkowitz and Claire Liang, our Associate Directors for Student Engagement, and Umit Yilmaz, our postdoc student. We also have student assistants Pavlos Tentamas, Kelly Grace Richardson, Haley Walker, and our Psaros FinTech scholars. And finally, I want to thank the McDonough Marcom team, Teresa Mannix, Sammy Kraus, Rachel Ellis, Teddy Wansik, Emily Dixon, Evan Fossen, Patrick Burrett, Martha Holland, as well as all of our student volunteers. So with that, I want to thank you all for coming and just ask you to join us up on the 4th floor in the Fisher Colloquium. You don't need to register, just go on in, and David Leonhardt will have his book signing. Thank you very much.